Hello and welcome to this morning's Market on Close. My name's Will from The Officials. I'll be taking you through today's Singapore window. So the big mover today was Brent flat price. We saw Brent flat price break a key support and plunge about $1.50 throughout the window. So we've been trading in this kind of relatively supported range here after the news of sanctions broke last week. We rose pretty aggressively. Well, we've eroded a good chunk of Friday's gains now, and it looks like Brent flat price is starting to consolidate around that 64.45 level. If we move on to time spread structure, well, it's the same story here. We have seen what was a very tight range be broken this morning as the front spread has broke below 70 cents a barrel, even went into the 50 cents a barrel range during the window. And I think, you know, a lot of this is the market's being pulled between two forces here. We have the new sanctions package from the US and the EU on Chinese entities and Russian entities. There's been a lot of talk about how much oil that might bring offline. Well, I mean, if the Iranian sanctions package were anything to go by, it's probably not going to mean that much. So the market's waking up to that. The oil will still flow if it's competitive. At the same time, we have concerns of supply glut that's really dragging on any sort of move to the upside. The market seems very tentative here, but with time spread structures this backwardated, that's not screaming supply glut to me. But moving on to Brent Dubai. So Brent Dubai has rallied here to this morning. So we've gone from trading around minus 170 on the 24th of October up to 95 cents this morning, minus 95 cents. So Dubai is really lagging here. And that was reflected into this morning's physical premium too. So if we pull up the physical premium chart, we can see that our Dubai physical premium has been absolutely crushed this morning. We've traded down from around $2, just shy, around $2.80 to $1.21 this morning. And it's still more of the same. Mercuria is now on the buy side. They scooped 2 upper Zacchums from PetroChina and an upper Zacchum from Hengley and Exxon each to net themselves another 4 convergences. It's fair to say the activity in Dubai has been heating up. Reliance also flipped buy side, so they've been a stalwart of the sell side for much of October's calendar sessions. So it will be interesting to see if they decide to remain on the buy side. That's everything from me this morning. Thanks for listening, and catch you for the European window this afternoon.
Hello and welcome to Macro Mondays, coming to you live from flux-news for the first time today. I'm James Todd, Trader Performance Manager here at Onyx Commodities, and today I'm joined by
Will Cunliffe, Research Analyst here at Flux.
And Ed Hayden-Briffett. I'm also a Research Analyst at Flux.
So, as always, on Macro Mondays, we'll be taking you through key market data, charts and risk. And there's been a good amount to sink our teeth into in this past week. So we saw US equities making new all-time highs, both in the S&P and in NASDAQ. And in the precious metals space, commodities have been selling off like crazy. It's been a very bad week for gold, silver, palladium as well.
Elsewhere in commodities, we've seen Brent spike on fresh Russian sanctions. But we've also seen US CPI come off a little bit, coming in softer than expected.
Yeah, so let's start with that as our story. The headline news on Friday was US CPI, and it came in softer, as you say, than people had been anticipating. It was the first CPI print we'd had in a while due to the government shutdown. But what do we make of this?
Yeah, well, I mean, at 3%, it's clearly still well above the Fed's mandated target. And what's concerning as well is core remains sticky. So yeah, expectations were about 3.1%. So coming in at 3%, it's a little bit softer. The 0.2% month on month is that the Fed will welcome that. As we get to more like 0.3% month on month, that's a little bit more concerning in an annualized term. But 0.2%, that's pretty good, although still hot. I think it's undeniably still hot. It should be noted that the OAS is currently pricing 50 bips by year end. So that's two cuts. The cut up, the meeting coming up next week, we have a full cut priced.
Yeah, I mean, we're in a high inflation environment. They've come slightly below expectations, but I suppose the significance of that is not going to be directly in terms of Fed expectations. To have such a near miss is not going to change anything, and I think people are anticipating that we're going to be having to face cuts at the next meeting.
I think also we've got to consider that the market is pretty starved of data at the moment because of the shutdown. And there were already, prior to the shutdown, there were concerns about the quality of the data being put out and being used to make these decisions. So I think that with the shutdown, it's also natural for everyone to focus intensely on any piece of data that we do get. So this is analysed within to the nth degree by everybody involved. So.
And yeah, what did we see happen with equities on the news of this CPI?
Well, they're up again. They're again at all-time highs. It seems like a broken record at this point, but and you're constantly seeing raised price targets, expectations from the banks and the big forecasters. So I think 7,000 points on the S&P 500. That's kind of the next real target level, and I think that's going to drive a lot of the sentiment around it. Whether we can get to that point or if we're going to find a ceiling there and then maybe roll over.
I mean, it's a flow story as well, right? So a lot of people will be getting a bit concerned about their gold positions, as we'll discuss later. They might be rotating into equities most likely. And as long as the flow is there, I don't think this bull market's going to stop. It's going to need a pretty significant catalyst to derail it.
Yeah, and I think looking at this, if we look at the chart in sort of good detail here, it's one of those interesting breakouts where, we had a sell-off from the previous all-time highs. We've been lingering slightly below that for most of September and October. But then on the CPI print, we've actually just seen it kind of break through to the upside. So to that extent, you might still just see this retail buying and the somewhat sophisticated, somewhat unsophisticated retail buyers, they seem to love it.
Yeah. I think the other main factor is the US-China trade deal. That was one of the main reasons, or that was the reason for the sudden drop that we had a couple of weeks ago, was Trump saying that he's annoyed with China, they're not playing ball. And then over the weekend, the meetings that have gone on seem to have produced some kind of framework, seems to be the term they're throwing around for a deal going forward. So when Trump and Xi meet in a week's time in Asia, I think if we get a deal, you can see the reaction this morning in the futures already. If we get a positive deal, that could actually boost us a bit further again.
Definitely. I mean, the over the CPI print, yields on treasuries barely moved as well. So I don't think the market's really responding to that as this implying any change to the path of federal funds rate. But nevertheless, we've seen a pretty big response in equities.
And yeah, in terms of the profile of the traders, both on the buy side and sell side, it seems quite similar. Retail buying, funds selling. But in terms of the profile of the key performers within the S&P and within the Nasdaq, that's also the same. We're seeing, this Mag 7. We're seeing tech just really, really supported here, which I suppose may not be. It's not against the current and the flow, so it can't be a surprise to anyone. But it just makes you think, in an environment where price to earnings historically are absurd, we are getting into more and more absurd territory.
Definitely. I mean, the kind of the fundamental drivers don't seem to be there in the markets at the moment. From a fundamental perspective, zero revenue driving 34% of the Nasdaq returns is that should be ringing alarm bells. But it's people are buying the index funds there, and the flow is there.
I think it's similar to, we talked about this when we were talking about the precious metals rally, is that you can buy, effectively, like you say, the index, the basket of commodity or of equities, and that does drag up the others. So we saw that with palladium, with platinum getting dragged up by the gold and silver move. And I think the same is basically true for the no revenue companies that we're seeing here.
And I theorize, and I think it's not too unrealistic to expect that when people look to, say they have a few $100 spare in their savings at the end of the month, what do? Well, they're worried about inflation, so they don't necessarily just want to save at current interest rate levels, especially if they're going to be falling. So they say, okay, well, I'm going to put it in equities. They've done well for the past 10, 20, 50 years, that sort of thing. And particularly, the conversations that people will be having, the casual retail investor will probably just look at some of these tech baskets, bundle them all together, and just because you have a short run sell-off on Chinese trade deals doesn't necessarily mean that the people are going to stop their buying. And it's been a historic performer. People are slightly numb in the short run to these bits of news.
Definitely. And at the end of the day, we are currently in a easing cycle from the Federal Reserve. And as far as I'm aware, recession is still not quite there in the US, although it is a contentious topic.
Well, let's talk about that immediately, because UBS came out saying there's a 93% chance of a US recession.
Yeah.
Are we calling rubbish on that, or are we agreeing with them?
I mean, it's very difficult to tell with as Ed pointed out, the lack of aggregate US data due to the shutdown. So, but 2 quarters of contraction after Q2's very strong GDP print, I personally don't see it from the US. I think, the federal funds rate is becoming more and more accommodative. That will pass through with a lag. And I still think, unemployment at 4.5%, that does not scream recession. The labour market is cooling, but it's not caving.
Yeah, my take on this, and the headline thing that I think I would look at for a recession, because if you're just going to take a recession at face value, 2 consecutive quarters negative GDP growth, to my mind, the big the swinger on that will be tariffs, and whether if Trump were to actually impose proper hardline tariffs, I would have thought that in the short run it would be inescapable that you would have a recession. So regardless of price to earnings ratios of the S&P and all of that noise surrounding it, if we look at face value what a recession is, hardline tariffs would be the biggest deal maker or breaker there. But he's chickening out at every opportunity. So I don't see any reason why we would look at the tariff environment and think, okay, well, he's really going to commit to this, and this is really going to hit US short-term growth.
Yeah, I mean, the one most, I suppose, slightly more concerning is the gradual cooling of the service sector. Manufacturing is often a focal point in the rhetoric at the moment, largely because of Trump's political targets, right, to boost manufacturing. But it's actually a relatively small proportion of the broader US aggregate economy. The cooling in services is I think a greater risk, and that is what I think will be prompting easing at the Fed. I think that's what Powell will be looking out for. But like I said, the market as well is not really pricing recession. If we look at the 2s 10s, that's steepening. That's at what, 55 bips or something. So that's not pricing recession. I struggle to see it.
I suppose another thing, though, that you could look at is contextual recession. So if the US were to be sort of flatlining in terms of growth, but the world was growing at a steadier rate or a lower rate than before, then you could contextually say, well, the US isn't performing outright, but it's, not underperforming compared to the rest of the world. And if we look at some of this international data, like let's discuss China's deflation. It looks as though the Chinese economy, in terms of growth, I mean, they will probably by the end of the year, from under the carpet, find 5% growth somewhere, according to the official rate. But it looks as though Chinese deflation is worrying, and the Chinese economy is not being all that supported in demand.
Yeah, I mean, a lot of this is to do with the overcapacity. You can kind of see PPI in the chart leading CPI there. That's pretty typical. And obviously PPI is a function of the spare capacity in the Chinese economy. They have huge inventories. We've seen that in terms of oil, broadly raw materials as well. And that's hit industrial profits. So coal mining profits were down about 51% year on year in September. And that's going to pass through. Partly it's strategic. They want to have that onshored supply chain. They want to be able to have control over every step of that supply chain. And a result of that, I think, is overcapacity, which is now translating to soft inflation.
But you mentioned as well the 5% GDP target. And I think unlike last year, where it was really a story of the first half was weak and then the second half they pulled a rabbit out of the hat, they've had a very strong growth, I think probably 5.3% in the first half.
Yeah.
So, and then 4.8% in Q3. So it's not like disaster is immediately knocking on the door for that target yet. So they can have a weaker Q4 and still hit the target, but I think they'll still want to avoid it looking too fragile.
Yeah, I mean, also what you've got to remember, I think, is there was a few factors kind of boosting China's start to the year. So if we move on to the next slide, you can see we started the year pretty strong, between 5 and 5.3% GDP growth. There was a lot of front loading in that first quarter of exports. People were scurrying to kind of get goods out of China before tariffs were implemented. That obviously boosts Chinese GDP. We also had stimulus pass through. So last year in Q3, there was a pretty aggressive
stimulus and
exactly, and that kind of takes like 6 months or so to pass through, especially in China with traditionally a high savings rate. If you do look at the kind of the underlying data there, it's still they might be growing at 4.8%, but China's fixed asset investment, for example, decreased by 0.5% year on year in the January to September period. I mean, markets were expecting a 0.2% rise for that period, and just the month prior is a 0.5% increase. So that's a pretty dramatic downturn.
Yeah, I mean, and of course that's going to be affecting things in the slightly longer term as well. These investments, similar to how forms of stimulus can take a while to pass through, like forward investment takes even longer ultimately. Yeah. But so if you were a trader of Chinese government debt and forecasting, looking forward, would you anticipate more stimulus coming soon? If they're going to be Q1 26, where are they going to be? Are they going to be having to support that artificially?
I think a few months ago everyone was definitely expecting a lot more stimulus. I think that's changed a little bit. From the Politburo, we didn't really see any kind of aggressive rhetoric coming from Xi Jinping, but I think at some point they will. The PBOC have been reluctant. They don't really want to step in, but I think the continued targeted fiscal measures, like boost loans for EV and things like that, I think they're going to probably make a comeback towards the back end of this year if we don't see a reversal from the trend in growth.
Cool. I mean, switching continents, let's go and talk about the UK now. So UK retail sales, we saw a bit of support there, which for the average investor might be a positive sign, but bond market prices are weakening. Why are we having one and not the other?
Well, I think a lot of it comes down to the expectations over the autumn budget, which is coming up fast in November. And really, where Rachel Reeves can go, where she can like pull the strings and find a bit more room to maneuver, because she can't really cut welfare spending. It's too politically unpopular, and she can't really borrow anymore because we've seen how the bond market has reacted to previous attempts to increase debt. So really, I think the UK is working on a very thin margin of what the government can actually do in terms of policy decision making, and frankly, I don't see a really easy way out of it for them except spending cuts, which they can't do for political reasons. So they have to choose one or the other.
Yeah. I think they've also had a bit of a headwind from the Bank of England. They've been slowing their QT, right? So they've been reducing their asset sales. Unlike the Federal Reserve, the Bank of England is actively selling, or was actively selling gilts in the open market. It wasn't just balance sheet roll off where you let securities mature. And they've said they'll stop this, or at least reduce those sales going into the back end of this year, which is obviously sort of constructive for gilts. You also have a more dovish panel now, I think, at the Bank of England. I think we're seeing OIS price more, about 56 bips or something this morning, of cuts by in the next 12 months. So a more dovish outlook on monetary policy will be helping yields drift lower as well.
Cool. All right, let's move on to precious metals. The big loser of the week. We saw gold having a really, really disastrous week, off about 5% Monday to Monday. Silver, palladium, platinum, similar. What's the explanation? Why did we see such a sharp sell-off?
I think it's largely what Will said, is basically profit taking and rotating into different assets, because you've seen this, what is it, like 40-45% year-to-date return on gold. If you're sitting looking at that, you're looking at the gradient of that graph, particularly in the last few months, you're thinking, how long can this go on for? And it becomes unsustainable at some point. There does have to be a bit of a correction. And I think this morning coming down to nearer 4,000 per ounce again.
Yep.
But I think that's quite maybe more of a comfortable zone for it. And I think largely it is just that profit taking off the record breaking rally.
Yeah, I think there's a good amount to be said for the sort of herd mentality. Herd mentality was part of the shift upwards. You had this theory about central bank buying and a hedge against inflation worldwide, and a hedge against US sovereignty to some extent. And so you saw this breakout from about 3,200 up to 4,000, 4,300 sort of levels. But on, number one, herd mentality and profit taking, as you say, that provides a bit of cooling at the top. And secondly, if I get that the CPI print wasn't necessarily much below expectations, but if people are not looking at things in a particularly high inflation environment, and people are less worried about, the US government and everything's sort of like dissipating, you have seen the fact that we had a CPI print, let alone that we had a CPI print below expectations, shows that the world hasn't quite turned to mud absolutely yet.
Well, I mean, if we move on to the next page, this kind of shows us gold's volatility term structure as priced by the options market. And we've seen that that's kind of reverted upwards into a more backwardated structure, implying markets are pricing immediate volatility. Now, to me, that doesn't look like a safe haven asset should look like. If you want value, if you want safe value, going to an exponentially appreciating asset is probably not wise. So I think a lot of portfolios which were kind of using gold as, like you said, as an inflation hedge, but also as a diversifier of risk, they suddenly it wasn't performing as expected. So it makes sense that it's correcting lower a bit.
Yeah, I think that's a good point. And similarly, for reasons that a lot of people don't want to get involved in some crypto things, even if you can have a fundamental belief that cryptocurrencies are going to be the future, you can often be scared out by the volatility, and so people scale in. And to see that happening to the sort of more traditional asset classes, you saw S&P volatility, but even compared to gold in percentage terms, the S&P hasn't been anywhere near as volatile as as the safe haven, as you speak of it.
Yeah.
So.
And I mean, the call put skew as well is now in favour of puts. So I think slowly the options market is getting more nervous on gold.
Cool. Yeah, I would expect it to have a top around this level for a good while longer.
Yeah.
But then also, let's talk about the dollar, because typically gold is traded in dollars per ounce. And if you're having a weak performing dollar, that says one thing about the price of gold in a dollar denominated term. But so how are we looking at the dollar this past week?
I think basically it's proven that it's stuck on that floor, which is if you have the DXY just below 100, say 97, 98, that looks like a pretty kind of safe floor at the moment. We've had a lot of attempts to break lower and it's bounced back every time. And I think that with the rotation perhaps out of gold a bit, out of precious metals, but also maybe the lower inflation expectations based off this CPI print. Again, it's only one data point and it is during a shutdown, so the question of the data can be questioned. The quality of the data can be questioned. But I think that has reassured markets a bit about the US, the state of the US economy, the state of their inflation situation. So I think that's encouraged somewhat the trust in the dollar again.
I agree. And I think also saying, it's only one print and that sort of thing, I get it. And we haven't seen a huge skyrocket, but we are, we're kind of in the doldrums here. Like if you look at the chart, we've come off a long way. So I don't think it necessarily needs that much to get a bit of a decently sized move to the upside. People have had a lot of their beliefs about the dollar, eroded over the past 10 years for sure, but especially over the past 12 months, 8 months. So we've seen some really detrimental price action there. So I don't think it necessarily takes a lot for people to start getting excited to the upside.
I think people also want to be optimistic about it, because the US has been that safe haven for so long, and you don't want to give up what you see as the pillar of security in quite a volatile world.
What's the alternative as well? Like holding euros, holding pounds. These economies seem genuinely terrible as well.
Yeah, I think that's a big factor as well. Political stability in France is poor, and that's been hitting euro. But I think also, it was a very concentrated short trade dollar, and that sort of unwound. And now at these levels, I'd be avoiding going short again, I think, and I think many people will be.
And then let's move on to Japan and the yen. So the yen has been supported. What's the explanation there? Because the economy's had a bit of a mixed time of things.
Yeah, well, I mean, we've seen the Nikkei has just smashed through the 50,000 mark. I mean, and that's obviously that's going to lend support for the yen, partly due to, again, US-China trade agreements. That's obviously going to be helpful for the broad Asia region. But also the new Prime Minister, Takaichi, is a clear proponent of free markets, a big fan of Margaret Thatcher, and Japan's first female leader. I think markets are getting excited about her entry.
Yeah. Okay. So we're bullish the Japanese economy, are we? Or do we think it's overextended?
We also have, we're in a hiking cycle in Japan, we're in an easing cycle in the US, so that would be bullish yen as well. I think we're pretty supported at 153, although if we do break higher, then that could send the yen closer to that 160 level. But then I think we're pretty safe at 160 because that's where the Bank of Japan like to step in and start buying yen again. So I think there's upside for yen.
Nice. Okay, cool. And let's talk about quantum stocks. So we're getting more and more, by the week, by the day, we're seeing more and more support of AI, new, these open AIs and everything, producing new platforms, and they get a lot of support on social media, but it seems to be passing through a bit into equities, doesn't it?
Well, yeah, you've got one example here. I think it's Rigetti Computing, and you've got that huge rally all the way up towards what is it, mid-September kind of time, and then it begins to fall off. And as it begins to fall off, I think Trump knows that a lot of his supporter base is putting money into this, and he has some power to support them with his own comments. And then last week we saw him say that he wanted to buy some as they were coming down, and you see a bounce. So it's, I think, another case of the Trump comments driving a market. And of course, in the scheme of things, it's quite a small recovery. But these are basically generally companies that trade on future expectations. Again, they're a lot of them aren't revenue generating, but their prices and their stock prices is surging throughout the last year or two. And the hope that is being put on these companies is then immediately undermined when you get something like the Google Willow breakthrough that we saw the other week. And as soon as the optimism, because that's effectively all that the share price is built on at this point, as soon as that optimism is rattled, you see a big flush of people running to get out of their risky position. And I think the Trump comments are just trying to reassure that market, really.
Yeah, I mean, it seems very much to be, an arms race between different companies and that sort of thing, and OpenAI versus I don't know who, and they all seem to be, high risk equities to be involved in, for sure. But what seems to be the case, to my mind, is that if it is an arms race, in the Western world, all of these companies are based in the US. It's so dominant in the US. So if you are a Trump supporter or a potential swing supporter, you would want to be long a lot of these AI equities, wouldn't you? But, yeah, and then if we're talking about, well, we've seen some pretty scary news in European banks over the past week or so, but also subprime bankruptcy. Are we going back to 2008? We've seen some alarm bells there.
Yeah, well, I mean, it's tough conditions out there, right? Like we are not getting the easing that the ECB should be, I think. I mean, the Eurozone seems in a pretty difficult place. But at the same time, as Trump would say, Powell's been pretty slow on the cutting cycle there as well. And obviously that will pass through to credit sustainability and firms' abilities to service their own debt. Credit spreads are super tight. And that just tells me that yields are really quite restrictive. We've seen Premier Lend Capital Partners file for bankruptcy, and subprime bankruptcies are ringing alarm bells.
Yeah, one of the other concerning features, I think, is what we have on the next slide, which is about the car loan delinquencies. Because in the US, car debt is such a massive market. It's something like $1.66 trillion worth of car debt held by Americans. And those subprime loans are beginning to show signs of more and more delinquencies. So we're now well above the kind of pre-COVID levels. And I think the amount that Americans owe on their cars and their monthly payments are incredibly restrictive to spending in other areas. And the delinquencies that we're seeing are a symptom, I think, of the excessive costs that Americans are putting into their cars.
If we put our Michael Burry hats on, do we think that this is going to be extended into, yet again, housing or other asset classes? Is there going to be a breaking point that really has ramifications, or is it just going to screw US car demand domestically for a long time?
Yeah.
And if so, will Trump intervene?
Yeah, well, I mean, we saw in the kind of COVID era, there was a lot of concern about subprime auto loans, kind of, and default rates on those. And yeah, it is concerning. It's concerning that they are collateralized in asset-backed securities, so they're tradable instruments as well. But I mean, at 6% to 7%, it's a much smaller pool of credit than say the housing market. Like it's not really. It's a completely different scale. Will it transfer to mortgage markets? Hopefully, the Federal Reserve comes out and cuts this week, and that should help. But in the US, you have a situation where the 30-year fixed rate mortgage, that's a function of the 10-year Treasury note. That's not in the UK. It's linked to the base rate, right? Your mortgage rate typically, not the same in the US. So it's tough to say. And mortgage rates have been high for a long time, and that will be squeezing incomes.
One of the other kind of consumer issues that is coming up, particularly in the US, is the amount of consumer debt and credit card debt that they have. I did some basic calculations last week and worked out that the average American has something like $3,500 worth of credit card debt. And that's even including like children, anyone who doesn't even have a credit card. That's just taking the overall population and how much each person would have to hold in credit card debt. So there is a huge market of debt there. And I think credit cards are 24% on average interest. And I think that the car market is kind of encapsulates the consumerism that is so prevalent in the US. And if you see them begin to be more delinquent on the car payments, I think the credit cards will follow suit pretty quickly as well.
Yeah, it'd be interesting to look. I mean, cars are also quite a sophisticated purchase. Like you can just go into an auto dealer and get one, but there's more thought and there's more of an initial capital requirement required for it. I mean, some of the memes you've been seeing over the past year about something like 50% of Coachella tickets being purchased on finance.
Yeah.
You know, we're in an environment where it's easy to lend and easy to borrow, but that borrowing doesn't just disappear. So at some point, people are going to have to pay back their debt. You'd have thought. Definitely. But, yeah, we'll see. And, you know, talking about Coachella and some, in my opinion, woke nonsense, let's talk about Beyond Meat.
We'll talk about memes as well. As a meme stock, I mean, you look at a graph and that is a telltale sign of nothing fundamentally driven. So Beyond Meat obviously is a kind of vegan and non-animal based food production company. And they had some news from Walmart that they were going to increase shelf space. And the share price went absolutely crazy. I mean, it went from 70 cents on Friday before last to over $7.50 on Wednesday. And it like trading was halted because of the volatility, because there were too many stop loss, too much chaos being
well, I mean, it screams, you know, AMC or GameStop. It feels like another one of those Wall Street bet short squeezes. I think a lot of funds had been pretty aggressively short on Beyond Meat for a while, so it was kind of primed for a squeeze, and it just needed that one bit of good news, and off Reddit went. Yeah,
I mean, I would look at this, you know, any the headline that Walmart's increasing its shelf space for Beyond Meat, I would not look at as a buying opportunity for.
You wouldn't
Beyond
give it a second thought.
No, I'd probably look at it as a good opportunity to get short Walmart, because if they're making more space for this rubbish, then there's something deeply wrong there. But yeah, I mean, I suppose it goes to show anything can have volatility put into it. And despite the environment that we're in, where I think, you know, the ultra processed food seems to be something that there's a lot of media coverage going on these days saying, you know, that's the thing that's really bad for you. Don't worry as much about meat as was their sort of 2010s agenda. And it's now ultra processed and high glycemic index foods are bad for you, supposedly. So I can understand why Beyond Meat has sold off in the sort of 6 months, year before this. But yeah, anything can blow up to the upside or the downside. Speaking of things that can blow up to the upside and downside, let's talk about Brent, because that's been a very volatile market over the past week or so in particular. What have been the drivers?
Well, I think clearly the main thing is the sanctions, right?
Yeah.
So we had a double whammy of US and EU sanctions on Russia and then China as well over Russian oil purchases. So Rosneft and Lukoil, they both got targeted by the US for their role in the Russian oil industry. And then a few Chinese buyers and traders got hit by the EU as well for buying Russian oil and processing it. So we saw Brent jumped from like the low 60s towards the mid 60s, towards $66 or so. And there is a lot of talk at the moment in the market about redirection of flows. Is China going to keep buying Russian oil? And I think today we've had a little bit of a consolidation, but there is still a lot of nervous energy in the market about where this will go. I think Reliance is particularly, the big Indian refiner, is one of those that people are worried about because they have a lot of exposure to US banks. So the question is how they kind of navigate the new sanctions.
Absolutely. And yeah, as you mentioned, you know, petrochemical companies in China being hit with them. But for a lot of the viewers, you may not, you know, if you're not an oil trader or surrounding yourself with oil specific news a lot of the time, It may be surprising that on this round of sanctions you had such a jump, because you would have thought maybe there's market fatigue regarding the headlines. But a lot of the headlines regarding sanctions are very non-oil specific. So I think that's one thing to note about what we saw last week and last weekend was, this is pretty much as specific as things have come since the initial thing where he was talking about LNG and LPG being the ones that are applicable to China in terms of the tariffs. But sanctions and tariff news quite often have been, a bit general and a bit broad. So this is a clear sign of intent, and to see, because the EU was very, very active on these as well. So
yeah, it's also worth noting the EU sanctioned nearly 120 new vessels. So there's something like nearly 600 tankers are now sanctioned by the EU and can't enter EU or any other ports, and they will sanction people who, with secondary sanctions, who accept them. So the shipping market has taken a hit as well.
Any other thoughts, Will? Or
Well, I think it's one of those where, the market leaps on the headline. We've already seen Brent come off this morning. I think a lot of that kind of bilateral Russia-India trade will continue as it has done. We've seen India kind of say, but for a long time, they buy Russian, it's competitive, we buy the most competitive. So I don't think Modi's gonna nudge India to kind of stop that. But no, definitely, I think that there's definitely been an escalation in the rhetoric. Whether that actually bears any fruit, I
personally, I don't see any reason that either China or India, after they put up such a fight against the US on the tariffs and sanctions, etc., I don't see why they would fold now. It would be a bit of a betrayal to their previous efforts.
And I don't think, China does not need to, right? China holds the rare earths card, and it's a bit of a checkmate.
It's a trump card.
Yeah, exactly.
Cool. And then moving on, let's talk about some political uncertainty going forward. We saw that prediction markets, the likes of Kalshi and Polymarket, the trading on the 2028 election has now surpassed volumes of the 2024 election. Is this surprising?
I don't think so. We got that big investment from ICE. It's become much more easily traded. They've opened up to, at least Polymarket's opened up to the US markets recently, whereas it was a little bit less accessible before. I think it's only going to grow in popularity as a means of trading events.
I entirely agree. And before the election, I think basically no one had really heard of Polymarket. The Polymarket boom and seminal moment was the 2024 election. So that's really put its stamp on the map. But you see more and more volumes going through on all sorts of things. And I think in terms of actually betting on the elections, it's no surprise that you didn't see an immediate follow up on the 2028 election straight after. People wanted to see how things were and what's happening. But volume's ticking up.
And I think it's one of those as well where it becomes a self-fulfilling prophecy. If you're kind of trading Polymarkets in early 2024, you're going to be concerned about liquidity, right? Are you going to be able to get out of your position, or are you going to have to hold this bet to expiry? Whereas as volumes grow, you're going to be more able to enter and exit positions, and that's going to be conducive of more volume.
Yes, I think also the kind of range of subjects they cover is so broad as well. There's always scope for more growth and development of certain areas.
I personally find it, fascinating, and really, really like logging on and seeing what the live markets are anytime. You could have got a 3% return on the French robbers being caught on the Sunday. Then, that's mental. But all right, and back to slightly more mundane and regular programming. So let's talk about the OIS pricing for the next 12 months. What are the big movers here, or most notable stories?
It's been pretty steady. We've had a little bit of an uptick from the Bank of England, as we mentioned. Bank of Japan, pretty steady as well. We're still around that 110 bips level from the Fed over the next 12 months. Again, it's lacking data. I think if you look at OIS pricing over the past few weeks, it's been a pretty much flat line. The ECB 12 bips of cuts. That's a little bit lower than last week.
Yeah, it was 8 bips last week, I think. But yet again, it's not huge.
It's not a huge move. And then New Zealand 34, Australia 55, and Canada 42, with Bank of Japan at 47 bips of hikes.
Cool. All right. And then looking forward to the week ahead, key data. What are the main things that we're going to be looking out for in the headlines this week?
So on Tuesday, we've got GfK consumer confidence from Germany, and we've got India's industrial production, and then we have a whole host of Euro GDP. We've got Spain's GDP on Wednesday, and the rest of them on Thursday. We've got US pending home sales and FOMC on Wednesday. I think the FOMC is going to be particularly interesting because that might give a bit of a glimpse as to, what the situation is in America from a data perspective, because obviously the Fed has a whole host of proprietary data sources that aren't really public information. So that could give a bit of a glimpse there. We also have the ECB interest rate decision on Thursday. We have some China PMIs on Friday and some inflation data from Europe on Friday too.
Yeah, I mean, I would expect the ECB interest rate decision will keep things flat. It won't be particularly. I would be surprised if we see more cuts there. But yeah, as always, there'll be daily updates on LinkedIn, on Flux, and yeah, delighted to be up and running live. First show for us live on Flux News. So thank you very much for joining us, guys, and thank you for.
Hello, welcome to the officials North Sea window update. Now, the trend of the recent sessions in the North Sea has been consolidation after this extreme downward pressure on the physical differential. There's been a lot of quiet sessions that we've seen recently with just a few, one or two maybe bids or offers in the window, and even some without at all. So what we've seen really is this very steep decline in the physical differential from its highs that we've seen in early October. In mid-October, we've dropped deep into negative territory. And in the last few sessions, as you can see, we've been kind of steady in the mid to low minus 30 cents range. And that looks like today will be a little bit stronger, given we had a bit more buying activity, bidding activity, interest in from the buy side. And on that note, let's have a look at the bids and offers that we got today. So today in Midland, we saw Exxon was the bidder. They were bidding for a couple of cargoes for 10 to 14 and 14 to 18 November, but there was no sell side interest on Midland. Likewise, 40s, Vitol was bidding for a mid-November cargo at dated plus 10 cents. However, again, no sell side interest, so no trades there. Ecofisk, however, we saw BP was offering. They were offering a 7 to 9 November cargo. However, they did withdraw that a while before the close, and Phillips was bidding the same dates, but they were quite a long way from the BP offer, even before BP had withdrawn. So that's really the rundown of the window today. And the other more interesting things that we've seen today are particularly we've seen the trend of consolidation in flat price and in the prompt future spread for Brent has just kind of continued through today, as we've seen, like as you can see on Flux here, the real upward momentum from the sanctions, which came out around this level in the low 60s, has kind of worn off, and we've been trading in the mid 60s, around kind of 65, 60-ish since kind of early on Friday after the sanctions came out on Thursday morning. So that's really the news on the flat price. Is kind of not too much going on. Likewise, if you look at the spread, the prompt futures spread similarly has just been kind of sideways for the same kind of time period. What is more interesting today particularly is gas oil, and there are a couple of reasons for this. So this is the Sing 10 ppm prompt gas oil crack, and what you can see is a phenomenal rally. So from all the way down here at $20 a barrel, we've now risen in the last 4 sessions to over $28 per barrel. And that is a monumental increase driven by refinery outages. So the Al Zour refinery in Kuwait, which is a major producer of diesel, particularly sent to Europe, has seen an outage due to a fire. And that means that they're only running at 150,000 barrels per day, according to our sources. That's down from the nameplate capacity of 615,000. There are other also small refinery outages and problems in India, like HPCL's Mumbai refinery has hydrotreater and reformer issues. However, the big story is this Al Noor refinery. And it isn't yet clear how long that will be out of action. And we've even seen or heard from the market that the Kuwaitis have issued 2 tenders for 800,000 barrels of crude. So they are clearly trying to offload the excess that they have that they would have been running in the refinery. So this market, the distillates gas oil market, is really the one to watch at the moment. And we'll make sure to keep you up to date of any North Sea updates as well.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined once again by two industry veterans, Harry and Julian. In today's show, we wanted to talk about end users and specifically diesel consumers. So we're thinking kind of hauliers, bus companies, heavy industrial users, really anyone, whose business consumes a lot of diesel and where that's an important component of their bottom line and where they're trying to kind of, remove sensitivity to the price and be able to kind of budget with certainty out into the future. I guess, going back to first principles, Julian, what actually makes up the road diesel price? Because it's not just as simple as kind of gas oil, is it? There's quite a lot going on there.
Yeah, there are a few components. I like to think of it as the fuel stack, how you stack the things up to get to pump price. So first of all, you've got the sort of main raw commodity, the diesel itself, and absolutely the sort of like industry-wide term for that is gas oil. And here in this country, you take that gas oil and you need to then blend in under the Department for Trade and Transport, the civil servants that run the Department of Trade and Transport, the RTFO, which is the Renewable Transport Fuel Obligation, and that obligates every supplier of size, that's basically every supplier in the country. It forces them to blend in, or if not blending in, equivalent to blend in, around about 14% of the fuel they're supplying as biofuels. So it's a process to decarbonise the diesel grid effectively, or the diesel network. And that, of course, has a cost to it because biofuels tend to be more expensive than gas oil. Different biofuels have different costs, but sometimes double, sometimes treble the cost, sometimes even more than that. So the game there is for them to blend the cheapest that they can in, and that typically, that formula, however they go about commercially doing that, that formula has a kind of set supplier, a commercial process, and they take FAME, so fatty acid methyl ester, which is a generic term for all biofuels of a certain category of biofuels methyl esters, and they'll take FAME 10, so winter grade FAME, and take the percentage under the RTFO formula. So that today, cutting through all of that, means that the price, the diesel price, you need to add on around about 9p to the diesel price. So the diesel price is around about 45p today. You then add on another 9p. And you can see that if you logged on to Flux Markets today. So we've got the diesel price there on the left-hand column. Balmo is the balance of this month, all the way forward to, I can't see it there, it's maybe April next year and beyond. So you've got the monthly prices there on the left-hand side for diesel. Then you've got the UK diesel with the RTFO blended in, which is about 9p more expensive. And then, of course, in this country, you've got two forms of additional taxes. You've got duty, depending on the fuel use. If the fuel use is for road transport, that's just a fraction under 53p. So we have that marked in our system, and duty can change. It used to be just under 60p and it dropped down, if I remember rightly, just during COVID or just before COVID, just during COVID, I think. Or it might actually have been in 2022 during the Ukraine crisis. To cut down the cost of fuel at the time, that duty dropped down to 53p from almost 60p. But generally, duty is an upward trajectory, like all taxes, of course. So it may well go up. Again, there's no indication of. We'll have to wait for the budget at the end of November on that. But that's something that's outside of control. It's not something that financial markets can control and hedge. So that price we've got here is an ex-rack price. So that is the raw cost of diesel plus that biofuel mandate plus duty. And then actually the pump price that you ultimately pay has what I call a supplier margin. And that varies for every petrol station you go to fill up. But broadly on average, we've got the average across the country because we're monitoring the government data. And that therefore, that plus the VAT differential gives us the ultimate price. And what we can see here briefly is a breakdown. Again, this is available on our website, freely available. We don't need to subscribe to our website. You can log on and see that forward movement. And really what I want to point out here is the pump price £1.43, and we're breaking down to the extract price of 102. And then we've got the biofuel mandate compliant fuel cost of just under 50p. And then you've got the raw diesel cost there at 42p. And we can see that price in the future on our system, which is totally tradable and hedgeable for customers here, actually dropping down in the future. So if you're budgeting now for a diesel cost, whatever your business, whether you're a retail person, small, medium business, even a large business, you can come on and actually properly budget and identify your risks. On the next slide, really, if we just put a pie chart, put all those things together, what I really want to point out is that green is that raw commodity cost. The yellow there in the bottom quadrant there is that biofuel mandate. That's the cost of decarbonising the diesel network. And then the other three sectors, well, the other two sectors, the purple one I should deal with next is the supplier margin at the pump, right? So it's quite a big chunk. It's about 12, 13p a litre. And then the orange and the sort of red-orange quadrant there, those are essentially taxes. And actually some people consider the yellow, the orange and the red as taxes. So almost 2/3 of the pie chart is effectively a tax in inverted commas, duty, VAT and that biofuel mandate. So, all of that, you can get all this information. That's freely available on our website. But again, if you want to control that cost and think about it, you need to come to Flux Markets.
Yeah, exactly. And it's really just that sort of bottom third, isn't it? The raw sort of diesel price and the and the biofuels, which is driving the whole pence per litre price.
Absolutely.
And we're actually doing an even earlier kind of calculation to make life a bit easier for people. We're taking those commodities which typically trade in dollars per ton, and we're converting those into a pence per litre price.
Yeah.
And that's how we end up with those four prices you saw on screen, which are a lot more translatable and easier to understand for the average consumer, whether they're filling up at the pump or whether they're kind of buying on a wholesale basis.
Yeah, absolutely. I think that's a really key point to make out there, that we have decomposed the price back into pence per litre from dollars per tonne. And yeah, the green and the yellow ones are really what's driving the price. Bear in mind the VAT piece there, that red sort of quadrant there in the northeast part of the pie chart. This is a percentage. So if fuel price is £1, this is 20p, because VAT is 20p on diesel fuel and gasoline. But if we were at £2, this is now 40p, right? So it also changes, but it's being driven by the green and the yellow, essentially.
So, Harry, I think you were going to give us a bit of a sort of background about what's been going on in the diesel market recently. I mean, there's certainly been a little bit of weakness, but I mean, sort of weakness in lots of areas.
Yeah, so careful how I word this. So the outright diesel prices, which you can go right back to gas oil, but gas oil is largely a driver of the kind of outright diesel prices, and by that I mean just the wholesale diesel price with nothing else attached to it. So global outright prices have been weakening, especially over the last month or so. But that, I would say, is being led by a kind of broader sell-off across kind of Brent crude oil, WTI crude oil, and European gas oil. So these kind of futures contracts, which we talk about a lot, they are where a lot of liquidity is driven, and the kind of diesel prices that we have on our platform are derivatives of these kind of top line futures. So it's almost a bit misleading though to say that means that the market is weak, because it's more of a kind of correlation thing. So you could kind of argue that crude oil has been weak, which has been driven by like narratives around kind of China and US trade tensions. There's a real narrative building, a kind of like a global supply glut that we're going to see a lot of next year. And that's kind of been driving outright prices lower. And as a kind of consequence of that, all these kind of oil derivatives, whether it be kind of wholesale gasoline, wholesale naphtha, diesel, these kind of just get dragged down because of the correlation, and they're all derivatives of these products. So there is a link, obviously, you know, refinery margins, refiners buy crude oil and refine it into diesel. So it's supposed to be linked.
Yeah, because the gas oil crack has actually kind of held up relatively well, hasn't it? Which is a proxy for the refinery margin.
Yeah, so when we say a crack, we talk about the refined product versus the raw crude oil feedstock. So in the late spring, there was a real kind of panic in the market, in the kind of global market of diesel, that there was like a real shortage globally. That, you know, European stocks were drawing and were very tight. The Middle East was very tight. The US was very tight. There just wasn't really any diesel like freely available. And there was a kind of real panic, and we saw diesel, the difference between diesel and crude, the kind of crack price, go quite like kind of hyperbolic around late May, June. And then since then, the market's been pretty elevated. And even on this kind of broader sell-off, if you see on the chart, the daily price trends chart, you can see how the kind of on the that bottom chart there on the second half of it, you can see how they kind of start to diverge, the blue line, which is the diesel price, and the orange line, which is the Brent price. So on this kind of sell-off, the cracks have actually held up quite strong. And that is indicative that the market is still quite tight. We're going into winter with not like a whole lot of supply around. So, generally traders have been bullish, have been positioning bullish, and are kind of expecting that to continue. But yeah, I think it's important to note that just because the outright price is lower, that doesn't necessarily mean that it's a weak market.
So it's not a diesel specific problem.
It doesn't mean that diesel is driving it. And actually, one thing you see a lot of is people saying, well, Brent crude is lower. Why is my diesel not cheaper? Everyone just associates it like, if oil is lower, then diesel.
They move one for one, but they don't.
One for one, basically, right? They don't. And what we've seen this year is the difference between, I think when we looked historically at the difference between diesel and Brent crude has increased by about almost like $10 a barrel for the kind of prompt month contracts at the moment since the start of the year. So you think that is a kind of divergence, that's over a 10%, that's almost a 20% move lower in crude oil prices, for effectively no loss in the diesel price. So it's an enormous difference. So if you're just looking at the oil chart getting frustrated, why is my diesel not cheaper? the reason is because the market is tight and diesel prices don't move one for one with Brent. There's a big correlation, but they've held up a lot better than Brent crude prices.
The other thing I would add to that actually is just thinking back to during COVID, the raw diesel commodity price, which is roughly, just now, I think it's about 45p. Correct me if I'm wrong on the screen later, roughly. But that's been down to 9p before in the past.
Wow.
And that's been as much as £1 in the past. Going from memory, don't hold me to that, but roughly. So we can see how volatile that is. My view, what I would add for this is I think, for me, looking at diesel or Brent, the Brent chart is a really good gauge of the sentiment generally, but to your point, diesel may not follow one for one. So for me, I think the market feels weak generally still. That doesn't mean to say it's going to continue that way at all.
Yeah.
As we know, as you mentioned, during the end of the spring, the market really shot up. $20 a barrel,
Massively,
almost.
yeah.
On the back of that was the Iranian strike, or was it Israel at the time? I can't remember.
There was a big move up and then a sharp move down, wasn't it? During that 12-day war period, where
it was.
All prices kind of went up together and all prices came down together.
It was the US attack on Iran, wasn't it? Yeah, the nuclear sites, wasn't it? Yes. It really, literally, it just shows you how unpredictable it really is at the end of the day, which is the point, isn't it?
And that's, we talked about it a lot on this show. It's, the whole point of hedging is just removing that uncertainty.
Absolutely.
Which is, something that, you're exposed to these things that are outside of your control.
Yes. Yeah, it is.
I'm very prone to volatility on kind of unexpected global events, which seem to be happening 3 times a week now. I don't think volatility is kind of going anywhere, and diesel is, because it's such a sort of core part of industry. Diesel tends to react like very, very sharply to a lot of these events because there's often a lot of implied consequences on the sort of supply and demand balance, and especially at the moment when you've had a tight market, people are very wary that it's tight. And generally the kind of global news that we're seeing, kind of geopolitical news, tends to sort of be more sort of war driven and, very less than rosy. And quite often that can affect refining capacity.
So obviously there's refining capacity issues in Russia. There's Dangote.
Correct.
But then there's also the kind of seesaw, whereas, you're also getting these stories coming out about, trade tensions and things like that, potentially reducing demand. So it kind of,
and gas oil, the kind of futures can often be a sort of proxy trade for people expressing a view on the sort of global like economic health, like index futures. It can be a bit indicative of kind of the sentiment around that. But I think at the moment it is being driven by fundamentals quite heavily.
Okay. So then, sort of taking a step back, I think we kind of mentioned this a bit earlier, but who are the types of companies that should be looking at whether or not they need to hedge their exposure to diesel? So we're talking, hauliers, large fleet operators, bus companies, if their buses are still running off diesel, corporate fuel cards, basically anyone who's got, large overheads that they're consisting of diesel, and they want to, take away that volatility from their earnings. So I think, Julian, this is sort of one of your
definitely got a lot of experience historically.
So I guess maybe, in fact, if we just sort of skip ahead, actually, if we maybe just talk about kind of how you might design a hedging policy, and then we might actually go and then look at one sort of worked example.
So I think that's a really good question, because I think if we just helicopter out that a bit for a second, in my experience, this is not always true, of course, but oftentimes, maybe in a very small business it might not be true, but in a medium-sized business with maybe 1, 2, 3, 10, 15 million litres of consumption a year, and some businesses are quite easily at that level, Royal Mail, and the bigger ones are more like 100 million litres a year, National Express, these kind of things. They're really very large consumers of fuel, so 3PL, logistics companies, so on and so forth. But what will happen is they sometimes don't always have sight of what another department's paying the invoice. So not necessarily collecting that information, understanding the volume and how exposed and how changeable this market is. You know, we were just looking at impact markets going down, but there are risks, and it just jumped up 20, 30% earlier this year. That impact on your budget for this year, next year, that's a risk for your business. And, you know, if you're running a business and it's well managed, you want to manage those variable costs. And there are lots of different ways of doing that, and Flux Markets can help you with that, and we can certainly help and guide you with that. But first off, it's really understanding what your consumption is monthly, how consistent it is, right? So so I liken it to, if I was driving down the motorway and I couldn't see the speed, it would be very difficult to stay within the speed limit, right? It's kind of the same thing. So understand what your volume is. And from us, if we're filling up a petrol car or a diesel car, we know it tends to be 50 litres and it costs me £70, right? Because we're actually paying the bill. But for larger companies, there can be a disconnect. So it's first off understanding your consumption. Then it's not just about the invoice and the Platts price, it's about that forward market we've got on Flux and those different elements and what they look like. So when that had that slide earlier with prices falling away, if you were just using today's price you've paid, you would probably be budgeting at that or some percentage higher. But what we can see is an advantage of looking at Flux Markets because prices are falling away. So if you were to not only assess that forward cost, but think about controlling it, you could probably lock it in below your current spend. And that's really useful for many businesses.
Yeah, it's a great opportunity, isn't it? To, you know, I guess A, you've got the sort of current weakness, but B, you've got that curve in steep backwardation. So you've got the opportunity to not only buy cheaply today, but buy even cheaper, you know, out for the next 12 months.
You use the word backwardation. Let's just make sure, give everyone the context. Backwardation is where prices today, that Platts price you might be familiar with if you're a procurement expert at your company, that Platts price is getting cheaper and cheaper the further forward you look. So that's what backwardation means. That's all it really means. So future prices are cheaper than today's price.
Yeah.
And in cost of living crisis for people, if they're buying your goods, if you can purchase your diesel cheaper, everyone's a winner, right?
Yeah, absolutely. And I think it's worth mentioning as well, lots of these companies that are heavy consumers are operating on very tight margins as well, aren't they? So they you know, they don't want the price of fuel to be going up by 10p a litre. And I think you made a very good point earlier. I think, you know, the first step of designing that hedging policy is they work out how much fuel am I consuming? Is it, you know, 1 million litres a month, 10 million litres a month?
Yeah.
And then how much is it going to cost me for every penny a litre that the fuel price goes up by, and can I stomach that?
Yes.
And even if I can stomach it within a certain range, you know, do I want to? You know,
and more importantly, does my boss want me to?
Exactly. Yeah, exactly. Because I mean, we've had this ourselves, haven't we? Where we've been talking to some of these companies, and you know, sometimes it's being managed by a procurement manager, sometimes it's being managed by the
Treasury.
the treasury, sometimes it's the finance director, sometimes it's a kind of a combination of all three, and it's sort of, you know,
could fall between, exactly.
And they don't all have, you know, full oversight of it. So I think, you know, that's, you know, step one, work out how much you're using and you know what your exposure is. And I think obviously in this example, you know, it's pretty clear you're worried about the price going up. But in some other businesses, you know, you're worried about the price going down. If we were talking about suppliers. And then once you can kind of measure that risk, then it's time to, you know, get buy-in from the rest of the business, get people signed up, and then sort of start designing a policy around it, thinking about how you're going to execute that hedging strategy, saying, okay, well, I know I need to buy 1 million litres a month. Do I want to lock that in now? And if so, how far forward do I want to start locking that in?
And you use the word policy. It might be as simple as we're going to budget and set the budget unit spend, and if the market's below that, then we're going to fix in up to 50%, or it might be 80%, it might be 100%, right? But that, I mean, the policy doesn't need to be more complicated than that. It might be that I need to get approval before I do this, but what you need is size of your volume and data that you can bring into a spreadsheet and share internally. And that's the great thing about Flux Markets. You can suck that data straight in via into your Excel spreadsheet very simply and monitor that cost, right? So it's really, really straightforward.
I think as well, like a policy gives you, and what we've even discussed with like the airlines in the past and generally is that there is like an accountability chain needed
Yes.
and discipline.
Who's
as well.
responsible and accountable? Yeah.
Yeah, because discipline is often like thrown around when people talk like professional traders, but you've given us loads of examples of hedgers who aren't disciplined. They don't have kind of a proper accountability chain, and then whatever hedging policy they have tends to start veering into what's the word? Discretionary trading, basically, where they're not necessarily sticking to a plan. They're reacting to results.
I guess it's a bit like if when I've gone in the past, I've decided to purchase, or I'm looking at purchasing a house, and the next thing I do is, what's my mortgage going to cost me?
Yeah.
What's the interest rate? The base rate? What's the mortgage offer from the bank? And there's always a difference. And then the next thing is, can I cap, fix, or do I want to be floating? It's exactly the same thing. And I'm budgeting for my monthly spend, right? Because I know my salary's X, and I know my mortgage is going to be a big chunk of that, but I don't want it to be 100% of it, right? Because I need money to live. It's exactly the same process, but you're putting that now around fuel and getting sight of those prices real time as they change, because they do change a lot, right?
Yeah, and I think that's the key point, isn't it? So I think the policy itself doesn't have to be overly complex.
No, it doesn't need to be complex.
You just need to be sort of
Agreed.
programmatic and just adhere to the policy. You can't just start going rogue because all of 1 month the hedge loses money. The point of the hedge is that it's P&L neutral across the business. For every penny you lose on your hedge, you're kind of making a penny when you're purchasing the physical. You're not trying to outperform the market. You're just trying to lock in today's prices,
like a minimum price, a maximum price paid.
Yeah.
Sorry.
I think the other thing that a lot of companies, in my experience, sometimes struggle with is, how does it work? It's complex, it's trading, that's risky. The reality is, if you are a business that's buying energy, in this case diesel or gasoline, if you're buying that and you cannot ship that on, move that cost onto your customer, it is a direct cost, as you said earlier, Tom, that hits your bottom line. If you decide not to control that cost, that is a decision. That is a hedging policy, right? And actually you need buy-in from the business that is the decision. If market doubles, our cost doubles, we're happy with that. Now, if I was running a laundry business here, and you often see those trucks running around here, or the food distribution business, Breaks is often going past the office here, they're consuming a lot of diesel. And of course, they're on very tight margins. So they want to think about controlling it because they can't just immediately change their price to their customer. That's going to impact their bottom line. So not hedging is a decision. That's fine. But do it with agreement. And I think the other thing there is, once you do decide to do it, it's just a procurement process. Right? You want to go somewhere where you're going to get efficient prices, consistent prices, and really effective prices, and we think Flux Markets gives you that.
And you almost want to be able to see those kind of hedges and also your kind of physical purchases on the same on the same kind of balance sheet, don't you? And especially if you're saying, okay, well, we budgeted for 50p a litre, okay, I've locked in at 45p a litre, and either physical goes up or physical goes down below that number, but it should all just net out to zero effectively, shouldn't it? And as long as you can see those two P&Ls in the same place, then you can sort of see the value of it.
The other thing that, in my experience, that customers in this space, this is agricultural companies, you listed some of them earlier, it's food, drinks manufacturers, big heavy industry manufacturing businesses, dairy farms, dairy producers, dairy distributors, those kind of companies, and many of them, waste management companies, they will often want to keep things as simple as possible. So they'll go back to their supplier of physical and say, please provide me with a fixed price. And that kind of passes all that risk of hedging back to their supplier. And because, my experience, if something's easy and simple, it tends to carry a cost. So when we were saying earlier, that forward curve is getting cheaper and cheaper by about 5p, and 5p doesn't maybe not sound like a lot, but it's a lot if you're buying 20 million litres, right? That's £1 million difference in spend over a year, right? So if it's important for you to capture that, well, I can probably tell you from my direct experience, is that the physical supplier won't be looking to pass that on to you because they've kept it simple. They're in fact going to try and get as much margin as possible. So doing what you're suggesting, tracking your physical purchases on a Platts plus price, whichever one it is, whether it's that raw diesel, whether it's the RTFO, or if it's something else, tracking that, or indeed pump price, and then financially hedging through flux markets is going to give you the best savings in my.
And I think it's worth saying probably a lot of these, suppliers or other people within the industry will be, a little bit reliant on some of this jargon being a bit complicated and perhaps putting people off, constructing their own hedges.
Yes.
But I mean, I think you can sort of bet your bottom dollar that those suppliers will be hedged themselves. And I think we'll probably go on to do a future episode about that, because that's kind of looking at it from the
internally.
From the other end of the perspective. But I think that's definitely a good sort of future topic we can explore as well.
And just being able to see that data in itself for us seems like a small thing, but to kind of give the power to, like you say, dairy farmers, food companies who would never have access to this kind of forward curve data where they can see future implied prices. That's very powerful for them, and it kind of gives them the power back. So in terms of creating a hedging policy, they don't have the excuse to be like, well, we don't know where things are. Whereas now you can say, well, look, this data puts the power, this flux data puts the power back in your hands.
It's accessible, it's there. I think you were saying earlier, Harry, that the company's here to also sort of nurture them through that process if they need it. Some of them will be very experienced, others may need some support, right? So
we can absolutely sort of coach them how to use that data. If they need it in a hedging policy or whatever, then we can kind of show them how to really utilize it properly.
Yes, absolutely. And maybe that's a good point. We should just say, from a Flux Markets point of view, you can access it and subscribe to it, just use it for information. You don't need to trade on it. So you can set your budget, monitor your budget, and use your current supplier, however you do. You can clearly trade on it too, and it's really easy and quick and simple to do. And you can come and get learning and development here, training from people that are very experienced in the market and used to training people. And when I've seen some of the responses of people that have been on that, actually right in the centre of the market, it's incredible the feedback it gets.
And that's where you'll be getting direct exposure to Julian, in fact,
and James.
And
James is probably.
But that's a good point, actually, isn't it? Because the Flux offer is kind of modular, isn't it? So if you just want the data, you just want the education, or you just want the trading, you can kind of pick that bit, or you can take it all as a package as well. Good stuff. So I think just as a final thought, we thought we'd just kind of look at a fairly typical example of a hedge and how that might be constructed, Harry.
So I just use some pretty arbitrary prices and months for an example, but we use the example of a bus company, and Julian, feel free to step in if any of these notes. So
you carry on.
But a bus company who wanted to lock in, let's say a bus company that wants to lock in a million litres, the price of 1 million litres of diesel per month for the first half of 2026. So that's January to June. So 6 million litres in total, 1 million litres a month. So in terms of hedging, so there is, as we said earlier, on Flux Markets, there's a variety of contracts they can use to hedge. We've got just kind of the wholesale gas oil. We've got the kind of UK diesel wholesale price, the price with the RTFO component to it, and the ex-rack price with the some of the tax associated to it. Have I missed any of that?
No, I don't think so.
Okay, so in this example, I just said, if let's just use the example that they hedge with the ex-rack price of diesel for 1 million litres a month, and the Flux Markets quoted them a price for the total volume of 100.5 pence per litre, so just over £1 per litre. So on this chart, what we look at is, as the kind of life cycle of the trade evolves, how the kind of the payout on the swap would work, sort of basis where the contract settled. So the dashed line is the price they entered the trade, so that would be 100.5 pence per litre. So anything that settles above that, so any months, because we work it on a monthly settle, so any month that settled above that price.
So they're the green dots.
So
on
the
chart.
green dots and the red dots are the sort of monthly settlements values. So again, these are just examples. So in January, if the January contract settled at 100.6, then
They're 0.1 in the money.
they're
right?
0.1 in the money, and the swap pays them out. So
Yeah.
even if the physical fuel costs them more, the swap payout effectively makes up for that 0.1p. So they're locking in a maximum price paid at 100.5p. So again, when you see the red dots which are settling below 100.5p, any kind of loss on the swap is made up from the fuel being cheaper.
Yeah.
So they're always just paying the maximum price basically. So yeah, any kind of gains or losses from the swap are offset with the physical fuel. And this is kind of a typical kind of payout curve. So some months will settle above, some months will settle below. But the point is that the actual kind of budget is set on that horizontal dash line. That's because it's removing the P&L volatility.
Yeah, just complete certainty from a budgeting perspective.
That is the max price they're paying across the kind of paper hedge and the physical product.
Whereas the market's just doing its typical kind of roller
And it's
coaster
volatile
move.
here, moving. Yeah, and we haven't. It's not that extreme, but yeah, it's moving, isn't it?
Yeah.
I think the other thing that I would just add to this, just why would the bus company do that? And this is so true of many businesses. The bus company pays a fixed, typically bus companies are given a contract by the local council, and the council says, well, what's your fare going to be to customers? Because they're worried about locals not paying too much. So the contract's awarded the bus company based on the fare. The bus company with the cheapest fare gets the contract, but his fare can't change now. So if diesel prices go up, right, where the green dots are, that's eaten into their bottom line.
Yeah.
So they need to hedge. And that's so true of all those other businesses we mentioned earlier, where they can't pass on that difference to their customer. Right. So hence they really need to hedge, and they do hedge, of course.
Yeah. And if you need to give certainty to a council, then you need certainty on your costs. So that certainty needs to kind of get passed down the chain.
And I can't pass it on to the customer.
Yeah,
right? I can't.
exactly,
Tomorrow, the ticket price can't be £1.10.
Yeah.
It has to be £1 or whatever it is.
Exactly.
Right?
Yeah.
Yeah, and and those deals are sort of typically signed, way out in the future.
Yeah, 1, 2 years. Or,
at least a year or two. And it's probably worth saying as well, isn't it, that if diesel prices go up, people are probably driving less and probably more inclined to get the bus. So you're kind of you've got even more incentive to
your demand's likely to go up, isn't it? Yeah. Good point.
Up rather than down.
Cool. Yeah, and this bar chart was just that was just a sort of P&L profile. But this is just on the paper. So if we kind of looked at the reverse on the physical,
you have the inverse.
The green and the orange will be swapped round, right?
It'd
It'll be net flat.
and you'd have a net flat. But yeah, this is just to kind of make the point of that it's normal on the life cycle of these trades for there to be some months in the money, some months out the money, and it's not something you should be afraid of because everything would be offset by the kind of physical fuel price. That's the point of hedging. So even though they have green months and red months, that's not the actual impact of that's not you making and losing money. That's just one side of the trade, and the opposite side is the physical, which would be the complete inverse of this.
Yeah, it's a really good point, I think. So yeah, I think that's about all for this week. But yeah, one final thought is we'd love to hear from you on this show. So if you've got any questions or you've got any topics that you'd like us to do a deeper dive into, then absolutely email in or give us a tweet, and we'd be very happy to answer those questions on the show.
Absolutely.
But yeah, for now that's all from us. Thank you very much for joining.
Hello, welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar, it's all here in the next 30 minutes. Welcome then to the UK Energy Show. This week, the aftermath of Storm Amy. What are the consequences for your energy bills at home or at your place of work? Ukraine is claiming more success in destroying or damaging Russia's fuel resources, with strikes at major oil refineries and storage depots thousands of kilometres from the Ukraine border. But what will this all mean for global energy prices? And Ed Miliband tells a UK energy conference of sector delegates they represent hope, as he insists he's going to stick to his plans for clean energy by 2030. Well, joining me to discuss this week's events are Greg Newman, the chief exec of Onyx Capital Group, and Julian Keats, who is a senior consultant with Flux. Gentlemen, welcome as ever. Let's start with the politicians, shall we? And let's play you some clips from this conference that took place yesterday. We'll hear in a moment from both the Eds, both Ed Miliband and Ed Davey. But first, here's Claire Coutinho explaining why the Tories have had a swerve in their plans.
So when people argue that we need to get off the volatility of fossil fuels, the thing that I would say, when you talk to any consumer, is that no one in their right mind would sign up to a 20-year fixed rate mortgage at 10% if there is a 4% variable on offer. So if it is the case that you think it's worth paying a premium for a fixed price, then you should be honest about what that premium is, and you should make that case to the public.
Energy bills are too high, and they've been too high for too long. The typical family is having to pay £60 a month more than they were 5 years ago, and British businesses still face some of the highest electricity prices in the OECD. Now, while that's a statement that has rare cross-party support, the answer to the question, how do you do it, certainly has no consensus.
There are two roads opening up for Britain, and we need to be candid about that, in a way that hasn't been true for 2 decades. One road is a sprint to clean power, a partnership between industry and government, which I've talked about. The other road is doubling down on our exposure to fossil fuels, and I believe, I submit, turning our back not just on the progress in clean energy of the last 15 months, but actually on the partnership of government and business over many, at least 2 decades in the UK. So I think this country wants hope, and this country wants optimism.
Claire Coutinho, Ed Davey and Ed Miliband there speaking at a conference in London during the last week. Interesting, Greg, that there had been a sort of unanimity of purpose across the spectrum in UK politics. There isn't any more. Is that significant, do you think?
It's hugely significant because there is an acknowledgement, I guess, that net zero and its costs and its general direction for the economy is potentially not as clear as it was before. And now there's a bit of a dichotomy in arguments because it's easier now that the kind of pressure, I guess, if you like, or the peak pressure on needing to be net zero has kind of diminished a little bit, right? So therefore, it's quite easy to bring in this other argument, which is saying, more oil and gas licenses, more of the stuff that's in the ground that we can get more immediately will give us more money and more jobs, and that's starting to be a little bit more compelling, which you probably couldn't have said even a year ago. And then now it's hard for the voter and the general UK public because for the first time, as you say, there's now actually a choice to be made about which direction we go in.
No big decision, of course, an election for another 4 years. Yeah. But Julian, there are some decisions for this government right in the next couple of months, aren't there, about more electricity generation in the North Sea, and in the North Sea, whether or not more oil exploration is actually licensed. And they're coming down the pike, before the end of the year?
Yeah, you're absolutely right. And, it's a really interesting one. It's local. Do we expand that production here? It would contravene our current legislation completely. So from a legislative legal point of view, it's a no. It really doesn't sort of sit well with this net zero process. And I think, I, as everyone in this room and anyone listening to this in the UK, is going to be acutely aware that power prices, when I've got my kettle on, when I've got my TV on, probably it's a bigger TV than I used to have. So I'm probably consuming more than I used to. And bills are driven by the price and the consumption. But actually, if we wind back 20 years ago, we had a price for electricity that was broadly in line with Europe. The key issue why prices are much higher now is actually underinvestment in our grid over those 20 years. And the other factor is that's really important, and I find it interesting that Ed Davy's comments I really, really agree with, lacked a bit of substance, and Ed Miliband's comments, hope, I don't think it's about hope. I think it's about gas is driven prices much higher. So during the initial Ukraine crisis in 2022, prices went up 20-fold during that period, right? And it was capped. Government Liz Truss stepped in and capped prices beyond the energy tariff. And the real argument is, and Ed is right, both Eds are right, solar now, recently, I think Ed mentioned that he's approved the Tilbridge solar and battery plant.
Yeah. Another controversial development, we have to say, don't we? But he's given it the go.
Absolutely. Controversial from the locals, understandably, aren't necessarily that happy about it. I get it. If it's in my backyard, I'm not sure. That's totally understandable. But from a greater, wider perspective, if we have solar with battery, so the sun's out midday, I'm storing the battery, I release it when peak prices kick in. And what we need to understand, really what drives the price in the United Kingdom is the system marginal price, the last megawatt that is needed to balance the system. And that invariably is gas. So gas sets the price. Yeah. That Tilbridge, not Tilbury, that's a port in the Thames. The Tilbridge solar plant was approved in 2012. It has a cost of 5p a kilowatt hour. Right. Okay, that is cheaper than anything that we have today that you consume. Even if I'm on a floating variable tariff, it's very cheap. So the tariff prices are 26p. Of course, we're talking that 5p per kilowatt hour is before it's transmitted and distributed.
And the transmission is a story in itself we'll get into one day.
Absolutely.
But it's suffice to say, I think, that we don't have the cabling we need, all the cabling we need to get this new, freshly generated, renewable energy into the grid.
Yes.
In an effective way.
Yeah, and that's why I guess the narrative of whilst we need the oil and gas, which we evidently do, right? So 70% of the time we price with gas prices, right?
Yeah, even 98%, right?
Something between that. But the point is that we import 60% of our gas, we import about 50% of our oil, and that's to do a bit more with the fact that we can't refine very much, so we need to import high value products. But it's also quite clear from the evidence that we're not slowing down in oil consumption in the world and in here. And in the UK. So the argument that whilst this is going on, and whilst gas is so important in particular, but also oil, shouldn't underestimate that, then you might as well be making it locally. And that's what the oil and gas licenses, that's obviously where Claire's coming from. It's an easy win, right? You get the immediate tax receipts, or at least protect the tax receipts that we have right now. You get to potentially start to compete more with Norway, who are finding new oil all the time. Very recently found even a new huge pot of oil, if you like, in gas, and they're doing very well with it. So I think it's resonating with people more and more. So it's definitely the most polarized I've seen. Bring it back to your original question. It's the most polarized we've seen.
It's one we have to watch, because Ed Miliband, even though he articulates an argument against it, may well be signing off on more North Sea oil exploration.
That's
before long.
Yeah, and I think we need to say these are all political statements. Obviously, there's no one's hiding that. But we're trying to break down exactly what it means. And again, hope, aspiration is probably, in my opinion, the right way to word it, because it is hope, and that needs to be aspiration to achieve these goals. But another way of saying that is we need to invest. And the UK public needs to invest in that, and they have been investing in that. And there's real taxes that you pay to accommodate for these net zero investments, but there's also taxes in the form of the price. And again, it's something we should do. later on, which is break down the bill and exactly where the net zero components and renewable components are hitting your bill, because you're paying there as well.
Because you've got to try and win that argument as well, the pocketbook argument, isn't it, of how much cash we've got left.
Yeah.
We'll come back to some more detail in a second. Let's just talk Storm Amy for a minute. It wasn't that bad, but it had some record. I think the number of sites, according to the Met Office website, had the strongest winds for October in 30 years or more. Any consequences that you've seen from the Flux team?
Just generally, I'd say storms weather incredibly important to our energy prices and people's wallets. Right? At the end of the day, we have a globally integrated oil market and gas market. Obviously, renewables with wind are a lot more about localized events, but particularly in the US, when there's big storms and there's big hurricanes, of which we're pretty much just out of the peak hurricane season, it's always a bit of a nervy time, because we've seen a lot in history. Hurricanes hit the Gulf Coast of the US and destroy refineries there, and that, or at least take them out of operation for a while. And we rely a lot on imports from US. And so when they go down, even temporarily, there's big price spikes. That didn't happen this year. Okay. And that's obviously a good thing for people's wallets and for the global economy, but it's always a little bit nervy. So then when you get the weather systems, as they tend to do, pass from the US over to the UK, things like this storm, it doesn't have as much of an impact on the global prices, but then it starts to get a bit more local. And particularly, colder weather that's coming in, that can have impacts on the prices on gas and electricity. But I guess in the context of this, it's about the wind, right? Clearly, the storm is going to go a lot of wind. So you would think a lot of wind turbines, wind farms, it's exactly what it needs, right? It gets powered by wind. And actually a big theme, more first half of the year, but certainly last year as well, was the Dunkelflaut, if I'm saying that right? This German word they use for basically no wind.
Okay.
And it was unusual. It was incredibly, it doesn't often happen that you just have such sustained periods with no wind, but it means you can't produce electricity. And so then you have to go and get the electricity by turbines using natural gas. And the prices and all that. So this time round, it's probably better for you, Julian, to comment on this part, but as in, it did have a bearish impact on electricity prices.
Absolutely. I mean, from as you say, quite rightly say, Greg, this is about the impact for the business and households, right? So actually, during Saturday, it was actually a sunny day. So we had a lot of solar and we had a lot of wind, right? And yes, there are grid constraints and there's balancing costs. So that how you move that effectively through the grid is tricky at the moment, right? Back to that, we haven't upgraded the grid quickly enough for the last 20 years. But actually prices went negative, and they went negative to minus 42p a kilowatt hour on the wholesale.
What does that mean?
So what does that mean? The tariff, if you're buying power at your house at the moment...
It's probably easier to say electricity, isn't it?
Electricity, sorry. Yes, electricity, yes, I love to say power. Electricity costs are currently capped. The unit rate is capped at about 26 pence, positive 26 pence a kilowatt hour at the moment. So during that
negative.
Saturday...
They pay me some money, do they?
If you're consuming, you're putting your kettle on, effectively, you would be paid to put it on. But it's at the wholesale distribution level. It's not at the
It's
retail
not an
bill.
individual household.
So you've got to move that electricity from the grid, transmit it across the grid, distribute it to your house, and have the other levies that come across, the green levies and various other levies and taxes and so on. So ultimately, if you're on a variable price tariff like Octopus Agile, Octopus Go, Good Energy have got a variable tariff. There are a couple of variable tariffs out there. Unfortunately, in this country, most people tend to fix their prices, quite sensibly so. Yeah. Because if we had the seasonal chart of electricity prices on the screen here now, for the last 5 years, we'd see right now actually where prices are is a good time to think about controlling it relatively. So where we are on this chart at the moment is right on that right-hand side, bottom side of the chart. This is an annual chart. Yeah. And you can see this is actually wholesale, not retail prices, but wholesale, and it's in pounds per megawatt hour. Okay, so it's energy cost at the wholesale distribution level, and assuming I'm consuming the same amount throughout the day, from midday to midnight, right? All through the day, from midnight to midnight, I should say. And we can see here those big peaks represent 55 pence a kilowatt hour, just as the wholesale price. Then add on all the other different things at about 16p additional. What I wanted to just point out there is that Tilbridge plant plots below the lowest point in terms of cost on the wholesale grid as a CFD. So it's really very positive from that point of view. What's driving those prices is 98% of the time the gas price, because it's that last marginal piece that needs
I think
to
just staying on the negative prices, because the first thing I would think is, well, how do I get those cheap prices?
Yes, yeah. Can I sign up? Where do I sign up?
Good question.
I think that this is about the mechanism as we pass from wholesale prices to retail, and it's the same. It's the same with oil. It's just a very different setup. And you've got to therefore track the wholesale prices. Again, something we want to do and show and be very visible about where things are and where they're going, we think, and all that. But when it gets to the retail level, you're obviously getting into that distribution economics. There's duties to be paid. There's, as we said, these levies,
CFDs, balancing.
that kind of thing. And in short, essentially, like you said, Julian, if you're on a variable rate for electricity, in theory, you can benefit more.
Yes.
But there is a minimum, right? They will never, well, at the moment, it doesn't look like they will ever say, okay, we're going to pay you. I have heard of scenarios with Octopus where they will say,
Yes,
look, if you
Octopus
can
do
be
this.
from 10 to 11 on a Sunday, we'll pay you a small amount of money to do it.
Actually, that's a really good point, because actually Octopus have been very, Greg Jackson's really led that company forward. They have a system called Kraken. It's this massive AI system. It's doing 3,000 processes a second of data points right across the country of all the generation, and saying, tomorrow I'm going to predict that actually if you're in London between 11 and 12, given the weather, given the wind and all the generation mix we've got, you can consume power for free.
But let's be honest, they are still buying it wholesale very cheap and giving you maybe a slight, they're still making money out of that, right? And that's their infrastructure and that's their trading infrastructure.
It's a great phenomenon, though, isn't it? The idea of power for free. We'd love to get into that.
Wind back 20 years ago, British Gas contacted you saying tomorrow you can have free. Right, no.
I want to get onto the Ukraine story because it's happened this week. And look, we all know about the difficulties of reporting on the Ukraine-Russia conflict. And it's, I think, on a very physical level, we all know it's grinding on at the front. It's an interesting take, I think, and a lot of observers have spotted that in September, Ukrainians being very good at letting us know and publicising what they're achieving. But I think even if you take that on board, it does appear they're having more success in getting drones to go and blow up or damage both refineries and storage depots, which in and of itself is interesting from the war. But Greg, I wonder if Russia's oil supplies and therefore reserves of diesel are dwindling, will that have an effect on you and me here in the UK?
Absolutely. When it comes to oil, so again, if we talk about our renewable capacity being quite strong to produce electricity and all the rest of it, when it comes to oil and gas, it's absolutely not the case, right? Oil in particular is incredibly integrated. So in other words, let's say we produce a lot more North Sea oil. That doesn't mean UK prices get cheaper. That just goes into this big pool of oil. And your concern as a consumer, if you're concerned about price volatility or price increases, is about how much of that big pool of oil that's available in the world is available or going down. And ultimately, by striking Russia and having fights with Russia, if you like, and targeting on the energy side, you are running the risk that you are diminishing global supplies, which ultimately raises global prices, which will find its way obviously to your wallet.
So if we want to, let's say we want to support Ukraine and think, good on you, you're actually harming the aggressor, but actually there will be consequences of that actually our energy, for another reason, could start climbing again.
I think, and the big thing on that is about refineries. So we like to talk about oil and gas like they're just these binary things, right? Oil is ultimately, when we talk about oil, we really talk about crude. It's what you dig up from the ground. But what we use every day is thousands and thousands of different oil products, and they've got to be refined to process everything from plastics, fertilizers, diesel, of course, airline fuel, all that kind of stuff. The problem we have is we're not just short on oil locally, crude oil. We're short on the ability to process it. Our refiners have gone down from 17 or 18 50 years ago to now about 4 operational. So we have to import half of our oil, of which the majority of those imports are diesel and jet fuel. We can produce enough gasoline and we actually export that, and we export shipping fuel. We don't need that either. But the point is that refineries in Russia, there's about 7 million barrels, I want to make sure I'm right there, but 7 million barrels of refinery capacity, I believe, in Russia, which again, you can say it's Russia's problem, but no, but they're set up to refine the crude, to create the products for the world, to then send into the world, into the export markets, which obviously finds its way back to the UK and Europe. So when you destroy these refineries, you are hurting yourself ultimately. That might be a completely willing thing to do, but it's just something people need to be aware of. If we could produce our own diesel, we would, and we can't. it's not economical for us to do so. We have to import it. We pay the price. And when we sanction Russia and when we hurt their energy infrastructure, we have to buy it from someone. And it's all integrated. It's not to make a biased opinion one way or the other. It's just knowing that it is
These
integrated.
things are all joined up. That's the point, isn't it? And if Russia has got a fewer working refineries, and I think with all the reports, one has to assume that it's still a modest amount of damage. We're not talking, in the 10 or 20%. We don't actually know, do we?
We don't know.
You guys are plugged into what's happening in the world. What are you hearing from your sources?
Well, this is the thing. We're absolutely plugged in because as traders, as a trading company, ultimately at the group level, this is something that affects the gyrations of the market like all the day, all day, every day. And so you really do need to know. And of course, there's the opinion, like you said, about what the Ukrainians are saying, what the Russians are saying. We're trying to find the truth, if you like, or what at least is confirmed. And it's very variable. We've heard lots of different reports. Some say up to 35% of the refinery capacity has been taken offline.
Okay, that much.
And some are saying there's been no impact to gasoline supplies, at least in Moscow. No one's queuing up, that kind of thing. But then the other areas of the country, they're having to travel 50 miles to get gasoline. It's definitely not clear, but you are seeing videos and evidence of the refineries. They are being hit. How much capacity, we just don't know. The more strong confirmed signals is how the traders are operating. And this is the physical traders. So the physical guys that are moving the oil around about, they are not allowed to basically resell diesel and gasoline in the open market. So what's happening is only the producers, the people who actually produce it themselves, are allowed to export. That's quite a clear signal that Russia are concerned about what they've got and actually should they use it domestically first. Right. And there's actually bans on exporting some of their stuff. So that's as clear as a indication as you can get. Having said that, the global pool, as big as it is and what's going on right now, and on the backdrop of what we think is a global oversupply, it hasn't really had that material of an impact. And actually, a lot of traders lost a lot of money thinking that it would. Okay. So it's very,
yeah, we have to be patient and interpret the headline. So tell me, if they are short of refining capacity, though, who's still friends with Russia who might take some crude and turn it into all that myriad of products that we all know, like the diesel, like petrol, and all the other plastics and so on?
Yeah, I think that's the point really why it has had lesser impact. That crude has now, because those refineries are unable to, the Ukrainians have been very targeted on those refineries, focusing on the middle distillate area of the barrel, because they know if there's no diesel, gasoline available on that that western front, then it's much more difficult for Russia to fight a war, right? So this is why they've been so targeted. That market, as Greg was just saying, is about 30 million barrels a day globally. The impact in terms of exports, because let's remind ourselves, there are sanctions on buying Russian exports from most countries.
They're being busted,
right? So actually, it's only around about 160,000 barrels a day on the grand schemes of things, versus 30 million barrels a day of that stuff floating around. Hence why Greg was saying it's had little impact. But back to your point, where those, and I think those targeted issues, the refinery isn't completely obliterated. It's just a unit. But it's very difficult for Russia to now mend that quickly, and it's in so many different places. So the numbers ebb and flowing. No one really knows, as we just discussed. So the crude that was going there, that's surplus, if you shut in a crude field, it can take a long time to get it back online. It's not like a tap in your house. Okay. So if you shut it in, it can really start glooping up and sticking. So basically, the Russians want to produce that and get some revenue to feed the war machine, right? So that crude probably, I don't know, guess India and China, I don't know where that flow's going, but those would be my guess.
Well, we do know. I mean, it's a majority India for some time, and then China, others, and there's pipelines on the Eastern Siberian Pacific Ocean that they maximize. It's a very short journey to get it to China, and they maximize that outlet. But I guess the other final thing on this is that, again, about this global integrated side of things, that oil finds its way to China and India, majority, but other places as well. It's about the refining and sending that back. So it's actually China who we hear about 50 to 55% of their refinery capacity is in use right now. It's not very high, is it? So they've been stopped. They've got a bit spare, and their actually inventories are the highest they've ever had. So it's what's called a strategic petroleum reserve. They are building up huge, 1 billion plus barrels of capacity for any number of reasons. We don't know. We don't know at the government level what they're thinking, but of course, generally there's a security of supply thing going on there. It could be about it being very cheap versus gold prices. It could be a long-term geopolitical play. We don't know. But the point is they're not taking that excess oil, refining it, and then sending that into the world, which they have done in the past, or not as much. They're not doing it as much as they've done in the past. So if they were to, the net impact would be practically zero. And if you like, if that's what you were trying to achieve, lower prices but maximum impact on Russia, that would be the best way.
I think the key thing here that we're really trying to underline again, and I think Greg mentioned it, is in terms of UK diesel price, it's had very little impact. And gasoline prices, in fact, they've slightly weakened. You know, for looking on flux markets earlier, they've actually, well, they've been relatively stable. Actually, within that price, the thing that's really moved, that's off the radar, as prices have generally trended lower this year, is actually the bioelement that gets fed into to green the diesel network and green the gasoline network. So this is ethanol and gasoline and biofuels that get blended.
That's a whole other topic as well.
That's a whole other topic. That actually is increased in costs.
Yeah.
But it's off the radar because you don't see it at the pump.
So let's now consider what's been talked about on social media vis-a-vis the energy world. We call it What's the Buzz? And we're going to start, first of all, with this comment from Jimmy Jones, posted last month. Julian and Greg, have a look at this one. Octopus Energy getting another mention. Julian.
Yeah, and he's saying, is it worth sticking with a variable flexible tariff? And I think the answer to this, the first thing really is, you know, we talked about the energy prices in this country being dependent on the gas price, setting that the last bit here. So if you're worried about that right now, energy prices have a risk that they could spike up. Geopolitical issues globally impact our costs here in this country, household level, business level. So if you're worried about that, you want to budget, then fix or cap your costs. But in terms of a variable tariff, it's really lifestyle dependent. The first thing here is you should always shop around for the best tariff that suits your lifestyle. The next thing is once you're on that, if you are on a flexible tariff, you want to go for one where you've got a very cheap overnight tariff. So you can fill up your car, your EV, and set your washing machine on. Now, there's a bit of time resource there, but that's not a costly thing to do. So you set all your heavy load, like your washing machine, your tumble dryer, to work at night when you've got the cheapest prices, or whenever that is on the variable tariff that you've got. So that's the benefits of variable tariffs. You can pick and choose because you've got your smart meter, you know what your prices are, and you'll know what your tariff is. It's normally kind of crystallised. You've got cheap prices.
So if you want to be proactive, variable, and I think variable as well as leaving yourself exposed to the wholesale price we keep talking about, which means if that goes up and down, that's where your exposure is. I think, you know, anyone can talk about both sides. To give an opinion on this, I would honestly say that it looks like with the wind that we're getting, which has picked up a lot in the past, with storage being quite okay, if you like. In Europe, we're about 80% storage. From the gas side, I think it's not a disaster situation. We are in a lot different scenarios we were even last year and certainly the year before. We've got a hell of a lot of liquid natural gas supply, which is, you know, the form that you can ship rather than send through pipelines. And there was an enormous response to the Russian pipelines being cut off to Europe and then therefore the UK to some extent. So, you know, the US, Qatar, but certainly the US have not only sent a lot of liquid natural gas our way, they've also been producing a hell of a lot and producing a lot of export terminals. We're producing import terminals. There is so much security in liquid natural gas supply. So you shouldn't expect a big shock, in my opinion. Having said that, it is still expensive because it has to get here, and you know it's always better to buy the most local and more freely available. But you're talking about incremental gains. I think that would be my opinion, not to make too much of a market call, but
yeah, I think you're right.
Public sentiment also a bit of anger, really, when you compare yourself to our near neighbours. Now, France is one example, but let's show this particular tweet we've got here. Britain paying the highest electricity prices in the world for second year running. That's the essence of this particular, or the tweeter, a chap called James Melville, has taken that article and is saying we are being fleeced. We've covered a little bit of why that might be the case, but is the anger understandable, Greg?
for me, it's certainly understandable if you didn't know what was going on.
Yeah.
At the end of the day, the investments, and there's very simplistic, overly simplistic talk about it's to do with this, it's to do with Russia, Ukraine, or it's to do with renewables.
Well,
It's
we're
kind
here
of-
to try and explain
We're
that.
trying
So
to
help
trying to
us
break it down.
understand.
So there was an enormous wholesale impact in prices because of what's going on in the world, but that's since really calmed down. Like I said about the response and physical supply coming, that's all largely sorted itself out. We've got lower crude oil prices. The world is looking in a lot better shape from the perspective of supply, and that is ultimately a good thing, and ultimately that should mean prices are going down. So why aren't they? Well, there's taxes and duties, and we are paying quite a lot of money to subsidize wind farms. It's a big topic, and Julian can help me with it maybe another time. But just in brief, we do also have to pay for the intermittency, which is another thing that politicians are starting to emphasize a lot. We talked about wind creating electricity through wind farms, but also when they don't work, then you have to go and find the natural gas. And the problem is the volatility. It goes from super negative to super expensive, but when it's delivered at the retail level, it kind of results itself, ironically, in just a slightly higher price, because it's basically it's a lot harder to monetize the weakness than it is to pass on the expensive price.
And one of the other things, I think we touched on this, Julian, was that isn't it the case that even if the wind farms are working and they're generating gazillions...
Generation, yeah. Electricity.
Let me rephrase that.
I was going to say that.
Even if the generators are turning, they're producing a lot of electricity.
Yes.
Sometimes it's not needed. And the network has to turn them off. And then the generating company gets paid some money for doing nothing.
Yeah.
Or for squirting it all down the plug hole, or whatever you do with electricity you don't need.
Absolutely. And again, we could focus that's an issue because of renewables. But the way I view it is there are three things in answer to that tweet. First off, it's our dependency on the gas setting the price.
Yeah.
Not gas itself, but setting the price.
Yeah.
Right? And that creates huge spikes in prices we saw in 2022. The next thing is the policy. The guys that set the policy sometimes, and I'm not saying it would be easy and I could do a better job, but that really is very important. And that drives a lot of these issues that are hitting people in the wallet. So getting sensible people to set good policy is really critical here. And the fact that we haven't upgraded our grid for 20 years is what's really driven this issue. Whereas France, Spain, Germany, and most of Europe have invested billions every year. We haven't. And that's
in the grid.
Yeah, in the grid, in their grids.
In those bits of cable that actually get electricity from A to B.
Copper wires, that's it, right?
I think the frustration again is, do you know what's really going on? And again, you are being told very different things.
Yeah.
And it's not
that detail, isn't it? You need,
It is that detail, but I think also the problem we have with these such polarizing views to get people in power and these kind of things, you do get quite extreme policies at the same time. Mm-hmm. And obviously hindsight's a wonderful thing, but this talk about transitioning is kind of is the easy thing to slate the government for, because if we had been more in a transitionary mindset, we would have stopped some of this fluctuation potentially, right? At least there would have been an attempt to, but we've been very aggressive. And again, it's so easy to blame politicians for this, but it's also, remember, politicians are responding to the general public. There was a lot of hype, which I think peaked in 2021 in particular, about a very aggressive anti-oil and gas narrative, which that's what people decide. But the reaction to it is so extreme. Mm-hmm. You got to agree that has created a bit of an issue, intermittency issue, and higher prices.
It's certainly created that I worked at the time. I worked in the oil industry, in delivering oil, and there was a mindset change in 2019. It came shortly after Theresa May made that legislative change. Mm-hmm. The Climate Change Act was 2008, but it was updated to actually ratify its legislation. Come 2050, we would be net zero versus 1990 levels. Yes, that rush to now decarbonise is problematic because we've underinvested in our railways. We've underinvested in so many elements, and really, in this case, in terms of power to the home, our grid.
Okay. We've got some charts, Julian. I wonder if you could just help us with these, with the latest bits of data from the various markets. Of course, we're concerned about oil, we're concerned about diesel prices, petrol prices, and so on and so forth. So what are we seeing? The GB base forward curve. Explain what the hell that is to me.
Yeah, absolutely. So this is the next 6 months to a year out. This is the base load price. What does that mean? It means if I consume power evenly throughout every half hour of the day, this is the cost, wholesale cost of this price. And this is the current future cost of this as of this morning. So we can see during the winter, as you may expect, the lights come on more, demand goes up. So we're seeing an increase in prices here. And this is in pounds per megawatt hour. Okay, so we're seeing prices, I think, go up to around about 80 or 90 there come the winter and drop down. Now, as Greg just said just now, if there's a geopolitical event that impacts gas prices, this whole thing just moves up.
But to go back to the chart, it is showing that actually the way that the market is trading the future, and there is this forward market, right? And this is another thing we're keen to bring visibility on. There is a market that trades the future prices in calendar months, right? Going far as 3 years out sometimes, so you can have a lot of trading. And it's a gauge of where traders are seeing things, right, ultimately. And you can, in theory, fix these prices right now and protect yourself against those prices. That will take some time to filter into the retail audience and them being able to profit from that. And that's something we're really
But that's your meat and drink, right? That's what your team does every day.
Exactly. And that's what we're going to try and bring in an intuitive way to the audience. But sticking on that, I mean, it's suggesting that if you hold steadfast and, on variable or whatever, or just wait for things to happen, it should get better from a consumer price perspective.
Yes.
That is the way the market's trading right now. That's logical in my opinion, and we don't foresee any shocks to that story right now. But as is always, markets are incredibly volatile. Anything can happen. So if you can fix
no crystal ball.
No crystal ball, but it's looking more attractive than it has in years, which is ultimately a pretty good thing.
And what that chart doesn't really underline, because it is that even. Houses don't consume evenly. A data center does. It's always on.
Yes.
Yeah, it's very, it is always consuming very regularly throughout the day. So it's a big baseload consumer. So that's a data center's cost profile for the future, plus distribution and other taxes that I get added onto this.
So the UK household will be
for a UK household. Each of those days, they've got what we call a profile that peaks at breakfast and peaks again at higher at dinner time, effectively. But during midday, when the sun's out, prices drop massively. During the night, if the wind's out.
So sleep throughout the day. And
so this is why it's sort of flexible. That question that chap tweeted was really important, because actually what I just want to add on that is that most people, I don't know whether I said this earlier, most people fix. 10% are on variable tariffs. So most people do fix in this country. So with prices coming down during Storm Amy, they're not benefiting at all.
And that's that point about negative prices again.
Yeah. Right, let's have a look at the natural gas. You've got another graph here. Greg, what are we seeing?
Pretty much the same thing, a slight dip into the future. I actually think this is an example of maybe the trading not reflecting actually what we probably at Onyx, if you like, or at Flux, if you like, that we probably do think prices are going to go lower than this. Again, that's our opinion. That's not absolutely what's going to happen. And that would be an example of, if you were to fix right now, you're not going to benefit from potentially future weaker prices. But again, this is something you've got to decide yourself.
So this is the national balancing point, UK's sort of natural gas, very similar cost-based TTF. That's the European equivalent. Okay. And if we converted this into pence per kilowatt hour that people know at their homes, this is about 2.7 pence. You're probably all out there. The cap at the moment is about 6. Okay, maybe 7. I can't remember exactly. So this is substantially below that. The heating. Okay, what's really important about this graph, you can see the broad shape is very similar to the power graph, because this thing sets the other one, right, as we were discussing. And what's really important to think about that, if you were to do your calculations here, is actually you need to double the amount of gas. You need 2 units of energy from gas to produce 1 unit of power. And then you've got to add on your carbon dioxide emissions.
Gotcha. We should do the fuels, because we talked about them a lot in this show. Diesel. Let's just consider the diesel graph. And what are we seeing as we look ahead?
So diesel at a wholesale level is what we call a lot more backwardated. Now, again, too much detail to go into right now, but essentially another good example of prices are looking weaker going forward because of essentially the structure of how the market trades. It's about storage, it's about all these kind of things going on. So if you like, that's a bit of an artificial forward price. What the market would expect is those prices later on will catch up to the front, given what's going on right now. Again, if you take the view that that's not going to happen, that's fine. But I would say from a market perspective, those are actually on the low side in the future. And we're a little bit concerned that those prices might increase.
I think if I was a household and I was consuming diesel, typical households 1,500 litres of diesel or gasoline a year, or a small medium business, or even a large business, what I draw from Greg's comments there is near-term prices are expensive, so the pump price is expensive, but the forward price drops. So if you're thinking about budget controlling it, bear in mind most households fix their electricity and natural gas heating costs. They leave pump prices completely floating. So actually that's a benefit. That's a saving straight away.
That's what it is.
You can save
Okay.
5p.
And while we're down the supermarket, what about petrol? What's the graph showing in petrol?
It's pretty much the
Similar.
same thing, but I think that look, at least the house view, if you like, is a lot more less concerned about the state of the gasoline world, if you like, than the diesel. And just the main reason for that is the diesel is very much what Russia produce and what they focus on. And it's back to that story. That's the real variable concern. Whereas gasoline is more globally produced. We actually produce a lot ourselves in the UK, and it doesn't look very concerning, at least.
That's an optimistic note on which to end this first edition of the UK Energy Show. Thank you very much indeed for watching. We hope you found it useful. Do add the comments below where you're watching this. We'll look forward to reading them. See you next time.
thinking fast and slow, right? Like that's so powerful. Like I still use that on a daily basis, not just in trading, but certainly in trading, right? So the concept is really about you learn all this knowledge, and then you build a framework, and you follow the step one by one, and then you do that many times. In the end, you could that builds into your intuition, right? That's why people say, oh, like intuition is like a high dimensional thing. You know, your intuition is always right. It turned out to be right. You gotta trust your intuition. There is like scientific evidence about it. It's really about your slow thinking got built into your fast thinking process.
Hey, Legier, could you just quickly describe what you do at Onyx?
So right now I run the trading business in Singapore, and I also run a global macro trading book. So I trade a range of assets, including oil, like our main business, mainly on futures, but also including all the OTC swap products. And I expanded the trading range to crypto equity indexes and also the bond futures.
What is your favorite trading book?
Yeah, I want to say, I mean, it depends when you ask, right? Like in earlier career, you know, the big shorts, the flash boy, like the more kind of story type books are definitely fun to read. But after trading for 10 years, I would say, you know, The Alchemy of Finance of George Soros is definitely one of the best. And because it always have this like philosophical element to it. And the great thing about it is not what he wrote in the book, it's what it's like when you read it, like what it kind of inspire you yourself, and then you kind of like have your own imagination to it, right? So it's almost like 1,000 readers read this book and they will have different feelings completely. So I think that's why, you know, that's what is really good about the book.
Alchemist, this is.
Yeah, Alchemy of Finance. Yeah.
Yeah. Alchemy of Finance. Okay. And who would you say, trader or investor, you look up to most at the moment?
I think in terms of trader, it's definitely Stanley Druckenmiller. Yeah.
Yeah.
He's done like more than 40 years of trading, and then he didn't have one losing year. So that's quite phenomenal, because if you think about, if you just make 2 trades in a year, and then if the likelihood of you losing money is only 10%, which is still it's super good, it's nearly impossible to achieve. You end up being, you know, you still gotta be down 20% of the time. And then if you take into account, you know, 40 years trading experience, and then without a down year, it's gonna be, you know, less than 0.5% chance. So that's really hard to achieve, I think.
Unless he's Bernie Madoff. But no, I hear you. What would you prefer to study at university, philosophy or science?
I would still study like something practical, because like I don't think you can say you understand philosophy when you don't have the life experience, right? I remember when I went to Edinburgh, and there's this friend who studies linguistics, and I didn't know what it was. So I was like, oh, you study language, like which language do you study? And then he was like, no, I study linguistics. I don't study any language. I study the structure of language. And I was like, oh, you're screwed, because you can't find a job. You can't speak, you know, because traditionally you think if someone study anything about language, you better study like a niche language, and then you become like a interpreter in that area, you know, something like Hebrew or something, right? And then now I understand, okay, because I look into more linguistic stuff, and then it's super interesting. We talked about it last time when you were here. But even then, I don't think he could understand everything when he was studying linguistics, because he was like 18, 19, and he simply don't have like enough life experience about it. So if I to look back at all these philosophers, like the Greek philosophers in the past, they all started as some sort of, you know, scientist or like writer, and then eventually they kept asking why, right? So and then eventually it was philosophy.
Yeah, I mean, I chose those questions because,
Yeah,
again, I find that you know your subject obviously very well, and you treat it like definitely like a vocation, right? Your trading is, I'm not trying to speak for you, but it seems like you treat it like a way of life. It's like how you look at trading is how you look at life, and you're always on that kind of non-stop journey of trying to learn more about yourself, about people, about markets and philosophies and psychology. And that might sound obvious to people, but I think that you do genuinely, I think people say things like that, but I think you genuinely live that way, right? So would you, well, A, do you agree with that? And B, could you talk a bit more about like how you go about like your foundational, like if you start a new trading year, like how you're starting to build a picture, if you see what I mean?
yeah, for sure. I think yeah, what you spoke about was really interesting. You said, you know, you kind of touch on, you know, learn about the market, learn about people, and then learn about myself. So I think so there are three types of knowledge. So there is, so the first type is the knowledge between, to figure out the relationship between human and objects. So that's physics, you know, math, or any kind of engineering, practical style of subjects. And then there is the second type of knowledge, which is, you know, figuring relationship between people. So between people and people, right? So then we are talking about game theory, you know, sociology and all that. And then the third type is figuring out the relationship between you and yourself. So like between people and themselves. So then we are into the territory of psychology, you know. I think trading is one of the few, if not only, subject or, you know, profession that combines all these three types of knowledge. Like, you know, you have to apply all of them at once. So I found it extremely interesting. So I mean that's like really what you said about I view trading as my life. Like, you know, the attitude, my attitude towards trading is also my attitude towards life. So I think you gotta really align. I mean, for me at least, like I gotta really align myself with what I do. So I start being really patient and disciplined, which I wasn't. Like I don't used to be like that. But I think, you know, I want to be a patient trader, and I want to be a disciplined trader or investor. So I optimize for that and change my lifestyle around it, because I can't say I'm a patient trader or disciplined trader if I don't do that in my life as well. So
Yeah. So I think that's a good thing to build on, because you know you started out as a market maker, right? As in,
yeah,
at least in your official career, right? And that's very high frequency. That's very immediate. You know, you talk about the dopamine rush of it. You know, the immediate feedback loop, and that's your life. And then we were trying to always. I mean, we are always trying to gear up that way of trading, taking maybe more risk, more warehousing, and kind of develop that style. But very quickly, the more you learn about market making and trying to develop that, the more you learn that trying to proprietary trade, so directionally trade over a medium to long-term basis, and trying to market make, they're really at odds with each other. And I think to this day, I still feel we struggle with that and how we manage it. And we're trying to get better not trying to make it so binary on the one hand, like prop or market making, but at the same time trying to be careful about not falling into lulls, falling into a sense of for example, like putting prop risk on your market making book without actually realizing it, that kind of stuff. But I think with yourself, you've clearly made that distinction very clear. So did you make a conscious decision that in order to develop your trading, you needed to become a directional trader, and then then you were looking to people who actually make money directionally, not the people who say they do, the actual evidence there, and looking at those people like the drunken millers who they treat it like a life philosophy, and they are patient. There's things you're saying. So did you make that distinction and just say, do you know what, that suits me better, I'm just going to start working on that? Or was it more of a transition, or when did that happen and how did that happen?
Actually, I would use your quotes about 7 years ago. You said something in 2018. You said, prime market maker age is between 25 and 30. Do you remember? And I was like, okay. I mean, I didn't really agree or understand what I meant, right? And then when I was 30, actually, it was it was exactly like my kind of like peak or top for my market making state, which was I was market making fuel oil in 22, right? It was mad, and then I think it was a natural transition as well, because I was always prop trading on my own account, and I tried to, if I had chance, I tried to prop trade in the market making book as well. But we didn't have those like differences back then. It was, you just take it, put it in the book. It wasn't big. I didn't really have drawdown, but I think it was a very natural transition. Like I just couldn't, physically it wasn't possible to last that long as well, especially in fuel. So I think that's definitely one of the factors. You gotta think about what you do as something really sustainable. I can do it for the rest of my life. And market making was great. It taught me a lot of things, but it wasn't for me like for the rest of my life, right? So I think, and it happened to be when I was 30, and then kind of agreeing with you on like 30 is kind of the last year you do market making, but you can always do that like when you're 35, even older. I'm not saying it's impossible, but I think I just have to make that choice. And then obviously, I developed
just for
the
people
project.
listening, should we just
Yeah.
Yeah, should we just develop on that a little bit, just because it might sound ridiculous to people, right?
Yeah.
But I think the reason why we say it is because the particular market making we do is voice trading. It's actually quite physical. It's you've got to shout. Sometimes you've got to be, of course, concentrating all day. It's very taxing on your body, mind, and even like your hands, right? You're constantly like doing stuff. I remember Omar used to get like a claw hand at the end of the day. But the point is that that's okay. But the problem I think is that when you get to 30, if you're not very astute at keeping your body fit, that's when everyone starts to feel, a bit more of the effects of if you don't take care of yourself. So if you're not taking care of yourself, or you find it hard to take care of yourself physically because you're working such long hours, and then you keep doing what you were doing 5 years prior, that's why it becomes unsustainable. So like you're saying, as in like, it's not impossible, but you need to make a conscious choice to, a bit like an athlete, right? If you want to be a footballer like Ronaldo up until 40 years old, he has to spend a lot more time in the gym than a 25-year-old, just to keep fresh. It's kind of similar, but on the flip side, you're using the experience you've gained over the last 8 or so years to then develop into a more mature, macro style trader, which you can't do when you're younger because you don't have the data points in your head. That's the way I rationalize it. Do you kind of agree?
Yeah, exactly. So I think it happened like quite spontaneously. And then and market making is very important as well, because especially in trading, illiquid products. So they're saying, people who trade illiquid markets can then go trade liquid markets. But if you start with trading liquid markets, then it's quite hard to convert those skill sets into illiquid markets. So I think the experience is extremely valuable. And it helps so much with building the intuitions, you know. So when I first went onto the desk, you know, Lions, obviously Omar was my first mentor on, you know, trading Onyx, right? So what I learned really was thinking fast and slow, right? Like that's so powerful. Like I still use that on a daily basis, not just in trading, but certainly in trading, right? So the concept is really about you learn all this knowledge, and then you build a framework, and you follow the step one by one, and then you do that many times. In the end, you could that builds into your intuition, right? That's why people say, oh, like intuition is like a high dimensional thing. You know, your intuition is always right. It turned out to be right. You gotta trust your intuition. There is like scientific evidence about it. It's really about your slow thinking got built into your fast thinking process. Then you are just using your intuition to make decisions. So I think that's like the most important thing I learned from market making. So like I apply that in different areas. So now, right now, for instance, I could meet someone or I do something. So I say to myself, okay, trust your intuition. So I trust my intuition, and then I rationalize it later. So I think that's a very
But
yeah.
how do you stop that being like reckless though?
That's why you gotta rationalize it later, right? So like you, yeah,
No, but you act on it rationally, right? You don't just blindly. You trust your intuition, but you still obviously you still rationalize it by the risk reward and the
yeah. So yeah,
position
for sure. So
sizing and
in
things like
trading
that.
terms, so when they say okay, invest and investigate, right? So that's another quote by, you know, the Soros guns, you know, like Druckenmiller or Paul Tudor Jones, Scott Besson even. So that's the rationale. So they look at the stock or like the assets. They're like, oh, it makes sense. But then, you know, you don't have time to do the research. So you would put on like a sizable position, not too much. Let's say you put like a 10% of your portfolio or something. And then you do the research, you investigate
and then
it.
you can look, and you get the confidence and the rationality, and then you put in more. And I get it. I think another thing that I think is very interesting with yourself is, you know, just taking again this directional trading concept. You know, most of the time, I would say, kind of to people, don't waste my time if you think you're a directional trader. It doesn't make any sense, right? You can't just walk into a room and directional trade because you're just gifted. Like, I need to know what's behind it, what your style is. And, you know, I've interviewed so many, and you're very good at interviewing directional traders. And that's actually what you're doing out in Singapore, right? You're building kind of a team around you to do more of this trading. And it's that, what I think you've demonstrated is, you know, you need to have a life philosophy to this. It needs to be everything you do. You need to treat directional trading like an expertise. And I think that what I see in the industry in particular is this desire to be respected, right? This desire to be, you know, I'm a big size trader, I make lots of money, I'm this, I'm that. But there's not really much, and I think this is changing, but historically there hasn't been much of a will to explain why they're a good trader. It's, I am just a good trader. I am this, I'm that. It's very loose definitions, but I think what you've done is you've done the work to say, if someone's a good trader or someone has a particular style where they're starting to make money or they're making a name for themselves, you start to think about it, right? You're like, well, is that, what is their general belief? Are they kind of are they a contrarian type trader that just believes in markets should be generally rational? So you just basically trade it when it's rational and monetize when it's rational, or like little things like that, right? That's very much what you do when you're investigating people. But so I guess it's two-pronged kind of question to you is, one, for yourself, how would you define your approach to markets? But two, when you're looking at traders and looking to see essentially whether they're any good or not, or whether they can work with you, or whether you trust them with risk, do you find, or how do you get to the bottom of like what's really going on?
Yeah, so I think you gotta have like a, you know, like a structure, right? You know, or a framework. So I think the top level is really I mean, to answer your question, is knowing, basically being extremely realistic about it. So what I mean by that is, put into context, is let's say institutional trading. So there is this like impossible triangle. Okay, you can phrase it differently, but roughly it's like drawdown, basically lower drawdown and higher return, and also VAR deployment, right? So let's say this triangle is, at best you can get 2 out of 3. So let's say if you have a strategy that has very high return, and then you're constantly deployed, your drawdown must be quite high, right? If you want to have low drawdown and high return, then you can't be 100% deployed most of the time. You can only trade like once or twice a year. You gotta be really patient. And then if you don't have low drawdown and then you're constantly deployed, then the return is probably not that high. Do you know what I mean? Let's say if you put your money in like treasury bills or something, right? Of course. So my point is that, like, you just can't have it all, right? Like, just being able to say to yourself, okay, I'm never gonna buy the bottom, sell the top. That's like a underlying philosophy built into my mind as well. So that's why people say in finance or in life, like sub-optimization is the optimization. So basically, like suboptimal is optimal. So I think that's very good. So then I gotta make choice. So let's say, what am I gonna sacrifice in this impossible triangle to make him to make sense for me, right? So so for me, I think institutional trading, you wanna be patient, right? So if I want to sacrifice the VAR deployment, I don't want to be deployed most of the time, and then it suits our structure. We're not hedge funds. You don't have to deploy your money all the time. So I think it's possible to achieve a lower drawdown with higher return, like a high Sharpe ratio profile, and which aligns with our market making business as well, right? So in that context, like the whole architecture of the team of prop trading has to be around that, right? So the keyword is patience and discipline. So let's say if I build a quant team, like do all the research, I'm never gonna do those like a data heavy kind of approach to optimize on that dimension. As I said, there's no point. But when patience and discipline becomes a culture embedded in the team, then like all your output is kind of aligned with that as well. So I think that's like the top line concept of this framework. And then secondly, as you said, like prop trading is so hard because there is a lot of like human nature in it. So I think just now when you asked me like my favorite book about trading, so there's like loads of like books on behavioral finance is also very important, and I like reading them as well. So that explain to you why we are human, right? Like what kind of behaviors are there in the financial market that makes people not a good trader, because only a handful of traders will be good. So I kind of like got into evolution theory as well because of this. So now I think I can overcome most of the, like kind of the human nature mistakes, like the FOMOing, the fear, like greed, fear of missing out, fear of leaving money on the table, fear of being wrong. So I think I kind of let most of these kind of things go. That's super important. So to answer your second question, when you speak to a trader, you clearly know where their ego is, right? Like you can talk to them and then you can clearly see. I mean, ego is different from conviction. You can have very high conviction, but then you kind of let your ego go as well. So you can very much see they have that in them. So the worst type of traders you see will be, they come in and be like, oh, I think this is gonna be here. This doesn't make sense. That doesn't make sense. this looks cheap, that looks expensive, right? And then they pull the trigger. A better version would be you have a fundamental thesis to decide the direction of the trade, and better be very structural or slightly less, maybe cyclical, but it has to be something really, really sound. And then you wait very, very patiently for good entry. So that's also a must, right? Like we talk about positioning all the time, some of the technical indicators, and I kind of categorize quantitative analysis in that category as well. So I think if someone says, okay, I think this is too cheap, this is too expensive, but they don't wait for the signal, then that's kind of being quite arrogant, right? Because why can you say market is wrong and you are right? Like it's very hard to justify like he's smarter than the market. So he has to answer these questions, and then that's conviction. But if he hasn't answered these questions, that's arrogance. So I think you can see a lot through discussing this kind of concept with any trader.
So in a way, you're looking for a trader to acknowledge the realism, as you say, not being able to pick the bottom and pick the highs, certainly not all the time, and extrapolating that, not really ever explicitly knowing where fair value necessarily should be, but having an idea and a philosophy of how you come to a view that there is a mispricing.
Yeah.
And I completely agree with that. But it's funny because, like you said, there's a difference between high conviction and ego, but it is a fine line.
Yeah.
And I think that what I've seen, which is really interesting, is when someone's too successful, if you like.
Yeah.
And let's look at the last 3-4 years in the oil market, energy market, 21 to 24. Obviously it's been aggressively harder conditions last year and this year in particular. But you're still on the backdrop of, let's call it 5 years of fantastic market conditions, which traders and market makers and physical traders and bank traders, they are all doing very well in the sense that the returns are being attributed to them. And the evidence of that is hedge funds piling into this market. I guess investors want more exposure to commodities, frustrated at missing some of the returns in 22, etc. And they are paying for any trader, it feels like, and they're paying huge sums and huge sign-ons for managers, for traders, for teams. And look, largely speaking, I would say it's massively backfired, which I think on the logic of what you're saying, it's just so obvious in a way, right? You're chasing a high and obviously there's no realism there. And I guess what I'm saying is like staying rational when year after year, you're making more and more money and you're doing kind of what you think is right. And you feel like you're on top of it. You feel like it's your decision. And I think a lot of people struggle to see the underlying system of why they're making money. And I guess if you don't do that, you'll attribute, flow or physical risk or whatever, market making risk to your P&L. And then when you take a punt or whatever and you make money, you're like, see, I'm so great. And I think that's a very difficult thing to not allow into your ego. You put on trades and they work. You got a system, you leverage it, and then suddenly it doesn't work. It's a shock to the ego, and you can kind of sympathize, can't you? So I guess, what do you even say about that? I guess, are you looking for people who have great years to be realistic about it and humble about it and acknowledge the system impact or the beta impact from the market? Or, it's quite harsh. It's quite hard to say, don't let ego get into it, because it has to some degree. You see what I'm saying? So how do you manage that then?
Yeah, I got what you mean. So I think that's about, it's more like on the psychology side, you gotta read people. So I think distinguishing behavior and the intention is important. So, someone might lie, but lying is a behavior, but what's the intention behind it, right? So someone could, when we say, oh, you tell like a white lie, whatever, it's basically saying, oh, you're lying for good intention. So the behavior might be bad, but the intention is good. So I think that.
So, for example, mother, father, whatever, saying to their kid that Santa Claus exists.
Yeah, something
That's
like
a
that.
white lie, but it's
Yeah.
the intention is, love and fun and whatever.
Yeah.
But what would be a behaviorally? How does that form into behavior then?
So the behavior is lying itself, but the intention is okay. So my point is sometimes it's you can mix these two, and then so the definition of having the ego is you. So that's an intentional thing. It's about intention, not about the behavior. So let's say if I go out and say, oh, I made this much money, that looks like I have a lot of ego, but that's just the behavior side of things, right? But if I'm extremely honest to myself, I can face myself to the darkest end, then that's fine. That's not really ego. So I think you can see some traders that will say things clearly. That's their intention, and then their intention of like gaining power over other people by you can call it bullying. They show off P&L, or just simply trying to
Or status.
status, like play the status game, trying to present themselves as something, as someone really big. That's like a typical behavior of someone who has gained power in their life for the first time, and then it's very hard to overcome. Like everyone will encounter that, but I think eventually, if you really figure out the relationship between you and your inner self, and then you can come out like much stronger and with a great amount of humility as well. So yeah, in traders, it happens all the time. You talk to them, they will come in, oh, I made this much money, the market is great, and then they start thinking, okay, so I think what is missing is the self-reflection bit. So if you could ask them, so what was your edge in those trades that you made money? Like that's a constant question I ask myself before I pull the trigger and after I pull the trigger as well.
And after.
Yeah. So, and I kept telling this to the guys on the desk as well, right? So, most of the people can't really say that, like can't really tell a good answer. So if you go back to that movie Margin Call, they say, okay, you're either smarter. Sorry, you're fast, or you're smarter, or you cheat. So that illustrates the three most important edges in trading. So you have speed edge, you have information edge, and you have a model edge.
Or insider information.
Yeah. So to be honest, like I guess structurally, a lot of people cheat. I mean, it's not like illegal or anything, but like people cheat, right?
Yeah, it's hard to define where the line is there. So like, the information you have, you utilize it. The insider trading.
Yeah, so you could see, let's say Trump got
agree.
elected, and then all his friends or his like connected people, they all got rich, and then people call it crime season, right? But I'm sure they look into the law. He launched a coin himself, so it was all compliant. But if you ask these people, so their real edge is information, right? But who is gonna admit, okay, I made this money because I have insider information? No one's gonna do that. And then a lot of people will just think they are much smarter than everyone else. So that's kind of a red flag, because you can't be that smarter, right? So for market making, it's just easy.
So how do you use your ego? But how do you use your ego to work for yourself? Like, I think what I could get from that was to say, like, if you want to make it about yourself and you want to be the best, right? You want to be considered the best. That's a status thing. That might be something for your self-esteem. I think what you're saying is, the things you can't control, you need to actually say you can't control them. So rather than say I'm the best at making money and predicting the markets, you could be the best at managing the volatility over time and structuring trades and the best at building and managing trading systems. And that's the kind of thing, I guess that explains kind of the very beginning of this conversation, which is that's what you've tried to evolve. You've essentially tried to create a system around your directional trading, whereas I think a lot of people are guilty at wanting to believe in their own story of themselves. And that's a very human trait, isn't it? Like, I am special. Why am I special? I don't really know if it matters that why. I just want to project that I'm special, and I want the validation from the markets, from people. And I think it's very, very astute in putting it as intention, because I don't look at that intention and think, what a bad person. I understand their desire. That's why I say they've got to direct it in a way that's kind of healthy, basically. So I don't like to say ego is like the worst thing in the world. Like, ego is the enemy. I like the book, and it's an interesting way of putting it. I don't think you can get rid of your ego. You can only channel it. But what is destructive, and I think you were alluding to it, is this unrealistic intention of I am always the best and I am always right. And we've seen it quite recently in Onyx as well, right? A big loss, and having made money for so many years, it's not my fault, it's your fault, because I can't bear the idea that after all these years, I've actually reached the point where I've lost money. No, I'm always right. I am the best trader in the world in my market. And there's all that intention is, the intention is to be on a pedestal. The intention is to make it all about them. And that's just very dangerous.
Yeah.
I guess because of the delusion, and then I'm just trying to use your logic, and because you're trying to hold on to the idea that you can control the uncontrollable, and that's why it can become destructive.
Yeah, exactly.
Is that a good way of concluding it?
Yeah, I mean, if I rephrase, maybe it's not the ego itself, it's the intention of protecting the ego instead of doing the right thing, or let's say being unintentional of self-reflecting. So that's the biggest enemy. Yeah, so let's say, carry on.
No, I was just going to say, so taking it to the next step, and that's, again, I like this kind of 30 to 35 I think in any career really, but particularly in trading, as it's kind of tends to be a younger person's game in some respects. But I find where you get to your level, your stage in life and mine, it is about, you found a good, reliable way to identify yourself, what you're good at and what you could develop on, and you're kind of taking yourself down a particular path. Whereas when you're younger, you've just got every option available to you, right? You could be kind of anything you want, but you'll kind of get to that stage where you feel like you're good at self-identifying, you've done enough self-reflection, you've looked at your own track record, and you can kind of see where you're going. But I think, if you don't mind me talking a bit personally about you've had struggles sometimes to be like, maybe identity. What do I actually want with my life? Does that align with Onyx? Does that align with what I'm doing? For someone to say, I am a trader, and love that, there are people that are like that. There are people, I am a soldier, I am a football player, I am in this. And that's the kind of, it's not a Japanese thing, but the Japanese are all about being a master at what they do, right? I love that. But that's not necessarily how we do things in England or whatever, different cultures. So I guess that's my question to you is, have you embraced that identity, if you see what I mean? Or is there more to your trading now and your lifestyle now than just making money? And is there an element of that's because you've exhausted that, you've got to a point of comfortability, if you like, and now you're looking for the rest of your career and you're trying to make it make sense? Do you see what I mean? Because you could say, smash it 22 to 35, try and find the best place to make money in trading, collect the energy boom like the trade houses have in 2022 and such. And they're all trying to retire, take their money and run. But then I'm like, but what are you going to do now? And do you see where I'm getting at? Have you been through those struggles? Do you resonate with what I'm saying?
Yeah.
To simplify what I'm asking, is it really about the money anymore for you? Yeah, is it really about the money for you now? Is it vocation?
Yeah, so I think to answer your question, so it's about basically there's a big, investing and entrepreneurship, right? Let's say investing and building a project or let's say building a company or building a business, sometimes they can be a little bit contradictory, right? So so there's like the first type error and second type error in statistics. So the first type error, I mean, applies in so many different areas. But in investing, it's like the first type error is you invest in something wrong. Whereas the second type of error is you didn't invest something and then you missed out, right? So there's a heavy skew towards avoid type 1 error in investing. So that's why you get all this saying, let's say by Warren Buffett, you know, he says something like, okay, investing is like you can only choose 20 equities or companies to invest in all your life. You got to be really careful. So then your requirement is really, really high to invest in something. And then, which means most of the time, you are waiting, right? Like you're waiting for opportunity to put your money in. And then investing is about compounding, and then you gotta like live quite long, you know. So then it's kind of like it's very logical. Okay, you live a long life. Like, how do you live a long life? And then you don't try and, you know, like push yourself too much, but not intellectually, right? You just have a good sleep, you know. You try and be healthy. Okay, then you're compounding. So that makes sense to be the greatest investor ever. So that makes sense. And then you should avoid like type 1 error. You should like say no to most of our opportunities because none of them will be good anyway. So that's kind of like one track. And then doing, you know, like founding a business or like starting a company, then you gotta avoid like type 2 error because the entrepreneurs are more like the 24/7 iteration mindset, right? If you go to Silicon Valley, they're like, I mean, even when you guys were starting Onyx, you know, I was one of, you know, the part of it. And then we were doing that.
First employee.
Yeah. Like we were iterating, right? We could do Tocom. Okay, no, we don't want to do that. And then we're trying, you know, we have option, and then now we have version 2 of everything, right? So in starting a business, the founders are working 24/7 and not literally 24/7, but you know what I mean. And then super busy, and you can't afford missing out something that could be the next growth driver. So then it's contradictory, right? With investing, which you should avoid type 1 error.
Yeah, understood.
In starting a business, like you wanna avoid type 2 error. So I think the answer is really, you gotta kind of like make a decision on which route you're gonna go, right? But it doesn't mean you do nothing. You still do a lot of things as an investor. So then that.
No, I know,
yeah.
but I think it's very hard to accept that, right? Because you've been for so long been told and seen that you can do anything. You can start and stop again a million times, but you reach a certain point in life.
Yeah.
You got to make a decision, right? And it's the same with careers and trading, right? Obviously, it's like, what are you going to try and be the jack of all the whole time? It's not. Is that a type 1 error then?
Yeah, exactly.
Trying to do too much.
Yeah. So.
Yeah.
Yeah, it's a balance. It's a trade-off, right? It's a trade-off. And then at some stage, then there's like the risk rewards question. You know, the risk reward thing coming, because then, you know, okay, what about family? What about kids? You know, and then you are no longer the one that has nothing to lose. Do you know what I mean? And but
I 100% know you. I think it's even deeper than that. The trader that always wants to make money and wants to be known for it, they want to be known as the best trader in the world.
Yeah.
And then they want to be known as, and it's, the human appetite is insatiable, right? Then you want to be the richest person in the world, and you want to be this, you want to be that. And life will obviously humble you a million times. But it's so funny you say that. It's kind of stressful to be like, no, you have to make a decision here. And that's, I think, to an ambitious person in particular, but I think most people, it's quite stressful to say, I've got to give up this for the rest of my life to do that and make a decision. And it could be the wrong decision. So the only thing I would say back to that and myself is like, but you've got to make a decision. And it's nothing worse. The same with trading, the same in anything in life. By not making a decision, that's a decision. And you can really just learn to regret that. So it's all, I know you say they're at odds with each other. I don't know. You could argue the opposite as well.
Yeah, exactly.
they are kind of
It's like,
aligned as well.
you know, like there isn't a rush, right? It's like you don't have to do it right now. It's like what you can do is you identify those. Okay, then I'm talking about like quite theoretical stuff again. So you can see, as a person, I'm leaning towards, the thinker type, because that's what really inspires me. Like I love those like abstract concepts, and then I love figuring out the relationship between them. So I think back to that question is, you can define like a few compounding factors in your life. So let's say what you do, let's say you take out your schedule on a daily basis, weekly basis, monthly basis, quarterly basis, and then you can clearly see some of the stuff you do have a great like compounding effect. Basically, you can reuse the work you've done in 10, 20 years now, right? And then some of the work, the compounding factor is quite low. So then you can be like, okay, I'm not making a choice between, do I keep funding a new business versus do I just take a step back and then be an investor, or just like, do a bit of like slowish trading. That's not a decision to make, but rather think about the first principle of it. So why do you want to be an investor in the first place? Because you want a compounding life. You want to have non-linear growth. You want to have exponential growth. So then when I look at those factors, okay, so these factors are going to offer me those exponential growth potential. So be it, like really create like good trading system to trade, or, going to the gym, that's avoiding you. That's also.
Yeah, but I think you were just on the way to defining, it is going back to your personality type.
Yeah.
And if you want this non-linear growth in something, but that something, the lazy way to define it is just money and generic success. But actually, if you get a real kick out of abstract concepts and spending time thinking about that, communicating it, feeling like you're solving the life's riddles kind of thing, that might be your thing. Or it might be the action and, the warrior type, or I know, more on this than me, but I guess it's like being in tune with that, right, is kind of what you're saying.
Yeah.
But what I'll throw back at you is, no, not to you, but maybe to the audience a bit more. It's something that frustrates me, having been in the trading world for 13 years now, and having to see a lot of people train and go through life and whatever, even though, still young, but it's a decent amount of time and iterations. The number one thing people think of traders is this cool, calm, collected person. And I have literally seen the opposite. It's the best traders are so emotionally invested in what they do and their trading and their craft. It's very upsetting when things go wrong or they can't figure things out, because it means so much to them. And then on the flip side, there is an element of, it's very aligned to people who kind of struggle with bullshit, maybe you could say. So, for example, like I think me and you are similar in the sense that we can think practically, can think very logically, but we also enjoy the social side. We enjoy the abstract. We enjoy the connection of people and journeys and ventures. But what I do think I love about trading and the trading world is, if I was to compare it to, say, politics, or compare it to, I don't know, just social dynamics, there is ultimately no lying. And it always comes back to numbers and hard evidence, which is very nice because, if I'm just trying not to ramble here, but to extrapolate my point, it's like when people have a dispute and someone, let's say at the biggest stage, if Trump says something or the other side of the Democrat Party say something, and they're all fighting each other to say, no, this is what happened, he's lying. And they said, no, he's lying or she's lying. And they attack each other's personalities. There is never a defined who is actually right, though.
Yeah.
No matter what happens, you can spin narratives. You'll never actually know the truth in a lot of scenarios of what really went on. There's conspiracies, there's intelligence agencies that do all these kind of things. And obviously I'm just talking about US politics here. But in general in life, I think I'm talking for you here, but I think for personalities like me and you, that denial and just people who just don't ever really need to tell you, don't ever really need to be put in check for what they've said, is quite stressful.
Yeah,
So
exactly.
what's great about trading is bring that into the trading world. It's not going to happen. You can't bullshit your way into making money. You can't bullshit your way into a good, sound process. And unfortunately, outside trading, there are less of those tangible things. So when someone says to me, no, this is what's important in my job, or this is what I want from Onyx, or this is what I want in my life, and you just can't know if they're telling the truth, because there is no ultimate accountability to what they're saying. And like you said about going back to intentions, is their intention just to get paid the most, to do the least, or to get the most credit or whatever?
Yeah.
It's very hard, and trading gives you that truth. Do you see what I mean?
Yeah.
Do you agree with all that?
Yeah, completely agree. Yeah, that's definitely, yeah, one of the special
But that's
traits
why
of
it
trading.
suits you. That's why you feel, no, I'm saying for you personally, that's why you feel at home in the markets, because of that.
Yeah, for sure. Yeah, that's probably one of the reasons, one of the most important reasons that I chose trading in the first place. Yeah. So
Is the truth, is the kind of binary aspect of the outcome.
yeah, it's just very clear, right? Yeah, you
broader.
summarized it very well just now. Yeah.
So what would be your advice then to traders now? And I think it's important to say now, because we are in a highly democratized trading world, and I think it will get much more democratized. And the things you can trade now, even with Polymarket, you can trade how many times,
Yeah.
US Senate leaders say the word uncertainty or whatever, you can do pretty much anything these days. It's going to be more and more like that. And with AI and all that, what's your advice to aspiring traders now?
It's kind of the advice I would give to my younger self when I started entering the trading industry, right? So I would say focus a lot on the scalability of the strategy you trade, and also the market that you trade, or the products that you trade. I think that was like a huge missing part for me back then. I mean, it's probably better off this way anyway, but that's something I would say. It's not a hindsight thing. It's not like, I could have gone to crypto, like that's just hindsight. That's not what I'm saying. But my point is there should be quite a bit of a heavy element quite a heavy element of thinking on scalability when you start out, because that ceiling really dictates.
As in, is the area I'm in, do you mean is the market I'm in scalable?
Yeah, or the
Will I be
way
able
I
to
trade, if
scale
it's
my
scalable,
strategy?
because then that really decides your
Okay.
ceiling in the future. So let's say, you see that,
Yeah.
someone like Jeff Bezos or like Elon Musk, when they started this business, it was like huge. The imagination was huge, right? So Elon Musk is doing, let's say, SpaceX. He's going to Mars. Clearly the ceiling is unlimited, right? So along the journey, like he didn't have chance to, let's say, be in a point where just now we discussed, now you make some money, you are rich, and then you're kind of like comfortable, you got kids, you got family, so now make a decision. Do you want to keep going, or like you just like take it easy, take a step back? So for those guys, I feel before they even realize how big it was, like, as in they didn't have time, or like they didn't have to make that decision, because it was like the ceiling was so high. And then if you are just top 10%, let's say, across different asset classes or like different industries, so the most scalable one will be the most rewarding in an exponential way, right? So I think the reason why George Soros or Stanley Druckenmiller, we talk about them right now as the greatest investors or traders, really, is they chose a very scalable market. So back then, when they started doing macro trading, the bonds of the world, the fixed income of the world, it was relatively small compared to now. And then the hedge fund industry was tiny. So they grew with the market, right? And then they didn't have to change like drastically how they were going to trade. You know, let's say it's not like, oh, you have to trade equity and then tomorrow you have to trade
I
bonds
understand
now.
exactly what you're
Yeah.
saying. Yeah.
So
Yeah. And I think that's a great advice for businesses as well. I think more so maybe for business, because there's a trajectory of financial volumes in general growing in the world.
Yeah.
But the trajectory of, you know, you get these especially young people who say, you know, I'm going to set up this, you know, fashion brand. I'm going to set up this coffee shop, and like they're actually quite cool niche ideas, and they might make a bit of money, but it's not scalable.
yeah, it's not
And they
scalable.
might
Yeah.
lock themselves into 5 to 10 years, and then suddenly they're like, oh God, that was a hell of a lot of work. To now, you know, my appetite then, you know, I couldn't see what I would feel like once I had some version of success. I thought it would just be endless. But as you say, there's macro themes that are going on there. So it's great advice, but I actually think that energy is the perfect place then, because everyone says the energy markets are niche and whatever, but they are the most important markets in the world, and they're yet to be opened up. So maybe you disagree with the scale on the opportunity with us, but I personally think
I think it's
you've got
a
that going
very
for us in the energy.
Yeah, I
market.
think our market is is a very good place to be. It's, you know, I would definitely say it's top. If you have to, if I have to put a number, it's definitely, you know, like let's say top 20% in terms of scalability, right? So I don't disagree at all.
Well, energy is always going to be needed, and
Yeah, exactly. Yeah.
Absolutely. Leger, that was great. I really appreciate it, and I think this hopefully is only the first of others we do, because you've got, you know, abundance of knowledge and wisdom to, you know, impart, and I'd like to do more, but we'll leave it there for this time. And out there in Singapore, you're our first video of the Singapore studio. You got a great background, and the oil ships in the background is perfect.
Nice.
So thank you for doing that.
Yeah, thanks.
And we'll
Thanks, man.
speak
Yeah.
again soon.
Yeah, cheers.
Cheers. Hi everyone, I'm joined with Vincent from Flux Insights. We're going to discuss the major themes in crude this year, 2025, and some of the things maybe going forward. This is about the narratives, the themes, the positioning, some of the more nuances in Brent Dubai, dated Brent, and all the rest of it, and just give a general overview, right? So Vincent, take it away.
For sure, let's get started. So talking about the key crude themes this year, you can't go without talking about the overarching narrative, which is OPEC unwinding their voluntary cuts.
Absolutely.
Which that has, the first tranche has been completed in September, and they're beginning their next tranche, the 9-member voluntary cut and the collective group cut that's supposedly ending by the end of 2026. Of course, that is quite, the market has a bearish interpretation, whether that's actually bearish for the physical, that's very much up.
That's what's been up in the air. So I think, coming into this year, they were actively unwinding on paper. They were calling for it. We're working through this kind of volume triangle, whatever you want to call it. We're about here, right? We're starting to get towards the end of this in theory, right? And we're starting to get to the last 2 million. But really, like as Jorge has been going on about, the officials have been going on about, the data is so spurious. The ideas, the talk of the super glut has been, just banded everywhere. Every trade house, every consultancy is looking at their supply and demand balances and saying, on this, in theory, data, this is what the result is, but we just haven't seen any evidence of that in the physical market. In the benchmark pricing. But then we're into that dichotomy of like how are benchmark contracts priced? They're priced by freely available oil and or traded oil, and of course sanctioned oil can build and be oversupplied, but not filter its way into the price. So that would be like, just to like lay it like straight away. This will drive hedge fund narratives. This will drive kind of tourist narratives. The market should come off because OPEC is supplying more. But really, I mean, just immediately from a crude trader myself, it's like, okay, I'm only ever going to position, if I really believe in this, and I really believe there's a lot more supply to come back, I'm only ever going to look at Brent Dubai as a proxy for, is it really happening? Brent Dubai has been negative for majority of the year, certainly weak for the majority of the year, and actually went shockingly low, like -3, -4 levels in the prompt, after they announced the latest cuts. So it really doesn't really add up. But yeah, anything to add on that generically or about the narrative?
No, in terms of the physical market, we haven't really seen that weakness, as you mentioned.
Well, the physical market, oil and water, like we could get into that, but it's more the physical pricing of the benchmarks. We haven't really seen it.
And for the Saudis, they have a bit of spare capacity, but other producers, they were overproducing initially, so maybe they are maxed out in terms of their production, as well as Saudi, they're sacrificing their revenues for market share. So that's another big theme as well.
Do you think there's enough information out there, Financial Times, Bloomberg, etc., more generic, bigger media, have they reported enough on the fact that this data seems spurious that could filter into more of the touristy hedge fund narrative?
To be fair, Reuters did come out with a headline mentioning that only 75% of the supply hikes have been actually completed out of the stated amount. So a lot of the hikes is just notional, just the numbers only. Hasn't really. Not many countries can actually have the capacity to raise that output. So it's actually more bullish than stated.
Sure. But as you said, that's been the leading theme. Hedge funds have been shorting all year. CTAs have obviously been going with it. We've got max short there. I'm sure you'll go into all this. And it has worked, largely speaking, right? We got down to almost, I think it was 60.07 on the very low of Brent. You've got the price, nice.
So this was in early April, and another big catalyst was the Trump's Liberation Day announcements, which also catalyzed a big sell-off too. So confirming prices down into the $60 range.
So going into, sorry, this is April. God, it's crazy to think back now it was at that level. But this is the Liberation Day tariffs and the carnage on that day. I know the market was positioned generally bearish as a kind of sentiment, as a kind of a discretionary trade, CTAs, and people holding puts. I think there was quite a lot of interest in holding some of the options, trying to see this like move down throughout the rest of the year. You got really paid aggressively on this move if you were owning puts in particular, because volatility absolutely split out. It's such a big move. Volatility roofed, and the price obviously moved down quite aggressively. So these kind of 60 puts did very well for a time. But what was immediately obvious there when the sell-off happened was when you compare it to other years, other years you're getting negative refinery margins, negative crude differentials, negative time spreads, and it's kind of flat price has to go because it's just a house of cards. It was kind of the complete reverse. Flat price did move, generated by a big macro sell-off. The weight of the risk-off money in the hedge fund world and all that really kind of drove this down, it seems. But once we got towards the low 60s, the front Brent spreads just wouldn't move. And it was about 30, 35 cents from memory. And it was there. And it made you think, God, flat price moving like almost $10 and it doesn't want to budge. That is like the North Sea traders are really looking to own that time spread, which means they're really confident in the physical and holding the physical. So actually that became a buy. And then when we leveled out, that time spread went all the way back up to $1 positive. And if you're $1 positive on a time spread, that's just, you can't say anything other than that's a strong market. But that's my anecdotal thing there. Anything to add on the general theme being, bearish throughout the year because of OPEC? But is that really why it went down? I mean, who cares for a trader? But as in all the signals whilst it went down kind of didn't really signal that we're actually oversupplied.
No, it felt like actually previously it was when Brent was trading between 70 and 80, it was always quite tentative, always felt like something was wanting to pressure prices down. And now then OPEC coming out, Trump's liberation, the cat was out of the bag, gave the macro market really a reason to accept the lower prices when other players most of the market wants to be bullish. They finally accepted this lower narrative. But of course in the physical market wasn't so, didn't really indicate an oversupplied market. So it's more of a reset. Basically.
Yeah, okay. So you'd be forgiven for retail traders, investors, people who aren't, oil professionals, would just look at that and say, OPEC are producing more, oil prices down, is completely logical. But I think our initial review of this is it's very much a positioning thing. I'm not really sure it was about anything other than that because nothing followed through on the physical signals. But why don't we go to the next thing?
The next part, another key thing driving the markets, that was in June, the 12-day war between Israel and Iran.
Yeah, of course.
Which those attacks saw Brent spike into the 70s, even up to the high 70s for a few days until Trump came out, until a ceasefire was announced between the two countries, which this is a moment where volatility had really spiked. There were a lot of call options being put on, but as has been a theme over the past couple of years, the market really usually intends to sell into these rallies and geopolitical risk when, as soon as it comes out that, as they realize that the disruptions to exports or supply or infrastructure wouldn't be affected, that there wouldn't be a regional spillover in the war. So that's the main key theme. So market really sells into these rallies.
Yeah, there's a time decay to these things. There's high tensions and all the threat, but the tension can remain high geopolitically, but every day that real oil isn't being disrupted is a day further the market is starting to calling bullshit, basically. And so you have a kind of natural time decay in moves like this. And then you also have a natural time decay in the options that you're owning. That is real value deterioration. But we were very vocal about this. Like you just said, we had the move down to low 60s. The market was comfortable with that because it aligned up with the OPEC narrative. It was seen as the tightness in the front, I guess, was going to be fleeting. You had consultants and banks, etc., talking about their supply and demand models indicating oversupply, just not yet filtering into the benchmark pricing. So that's when this started to filter. Sorry, this is when we started to get that narrative slightly shifting. The kind of feeling of, okay, I know you haven't seen it yet, but you will. And then it was like in Q4 is when you'll see the builds. That's when this narrative started to happen. So you still had quite a bit of short positioning here. So in this rally from 65-ish up to the peak, whatever, just below 80, because the market wanted to be short, let's say, from a discretionary basis, we said it was massively an options rally, wasn't it? It was a very local to call options is where the majority of the market put that trade on, which if you think about it, made a hell of a lot of sense because options are all about insurance, right? So you're insuring against a huge price spike, but you're positioning for it to go down. So you don't think this is going to last, but you don't know. And when people start talking about closing the Straits of Hormuz, well, that's actually a new thing, as in we've talked about it a million times, but the Iran are actually threatening to do it. You've got Polymarket saying, will they close the straits? And people are betting on it. And there's people in the straits themselves from ships talking about it. It was genuinely a threat. So if you don't believe that oil prices should be high, but of course you recognize some huge event could be likely and cause price spikes, you're going to buy insurance. So it was a massive scramble to buy call options. It was a massive volatility rally. But when it got to its peak, which was kind of like the Sunday night really, and you had weekend trading on IG and you had people like really thinking it was going to go on from here, as you said, that's when the market says, do you know what? They didn't close the straits. They talked about it in government and they said they wanted to close it, but nothing really happened. I think this has reached its peak. I think it's fever pitch. And this is when we got this really aggressive sell-off, which was really a sell-off in volatility if you were looking at the volatility on the options. And then of course the direct price, and that was kind of the end of that, right?
Sure. So it just ended very, very abruptly as well. That was when Iran struck one of the US airbase, US military bases in Qatar, and the market treated that as the ending of the war, because as in they allowed Iran to do that to escalate to de-escalate, and then afterwards Trump came out saying that both countries had reached a ceasefire, or he forced a ceasefire on them after the next day actually swearing on TV as well, which made both sides get the point. So then abruptly Brent returned to really normal, and then the market just returned to its old narratives.
You're a fan of Trump and his narratives. You always have been. You always comment on it, make jokes, all that kind of stuff. The point is that the new age thinking, particularly for a younger guy like yourself, is to be very in tune with the temperature of the dialogue. But if you go back, say, 10, 20 years, you're getting official narratives from governments, and you are really, genuinely believing in what the policy statements are and the conditioned narratives. And it's very, I don't know, in retrospect, very organized. These days, people are tweeting like Trump. There's all these threats from Iran. They're sending videos at night with like pictures of bombs, being like, this is it now. My question to you would be, on retrospect, where is the predictability in the chaos? Because like you said, it kind of was, right? Like you're saying, swear on TV, you get these kind of indications and you go, see that, I think that's de-escalation. You're getting a lot of transparency and live visibility into the thinking of these people. Do you see what I'm asking?
Yeah, exactly. Similar to the attack on the airbase as well. It's very similar to last year. There was the Israel and Iran also traded attacks to when Iran retaliated against Israel. That was very, very telegraphed. Talked about with intelligence and military, like the US military in advance. So that was when the market interprets this as kind of like a performance. Then it means that both sides have been given an off ramp, and this was the case in the Israel and Iran 12-day war as well. So
is the answer, because when I say where is the predictability in what's seeming chaos?
Yes.
Is it to recognize that it's a drama?
To recognize this, yes. Well, the official narrative would be to recognize that there wouldn't be any disruption to...
recognize that they're all playing games. And if you're comfortable with that, you can start to look for the signals. Whereas someone more, let's say, old school or kind of not, or a bit blind to the game and the agendas, they find it harder, right? They're like, hang on, this is chaos. Like,
yeah, so kind of reading between the lines in that sense.
Yeah. But it's funny because I think particularly the newer generations are finding it very comfortable, in fact, very relatable to see people like Trump, people like even the Iranian generals and these people, the propaganda, they're actually very comfortable with it because it's immediate feedback, and you can kind of weigh up the feedback and people's comments, and the interconnectivity we have around the world it's actually incredible. In an event like that, you've got people on the ground saying, yeah, look, we're trying to get out of Iran right now. I'm blocked up. I'm trying to get I've got staff saying, I've got to leave because I've got to try and get my mum to the border and things like that. And you've got information that way, like live. You've then got obviously Twitter, people tweeting like all the time, threatening, we're going to bomb tonight. And then like all this kind of stuff. It's incredible how transparent everything is and playing out in front of you, that someone like me or you, just literally sitting in London, like watching from a phone, can get a very like good sense of what's actually going on, and then we can judge it. You see me? I think your generation is very comfortable with that.
Oh, for sure. They also call OSINT open source intelligence. So, and especially, for example, the Russia-Ukraine war, just to go on a tangent, there's a lot of military footage, and then often these military analysts online, they can interpret these videos from these various Telegram channels and judge based on like how much progress each side is making. So with this is you just really using the power of the internet and like geolocating things and using that to your advantage. And
so again, if we go back retrospectively to this event, I would say with AI, it's not like it wasn't here this year. So you can't say in the future it might be difficult in these scenarios. It's happening right now. Just to add on to your thing, someone might say, okay, well, if you've got all that open source intelligence, that makes you very vulnerable to a very well done AI video to cause a price spike and all that. We actually haven't seen that, have we? We've seen people take every video and go, I don't know about that. And it's actually quite hard to convince people that something's real until they see the hard evidence. That's quite interesting, isn't it? Like, for example, the Qatar thing you just said. We were getting live streamed. We were saying, look, those are the Qatar bums. People were sitting in their balconies in Dubai and going, yeah, we're watching. And it's like, people need to see that, don't they? Because of AI, because of recognizing that you can manipulate videos. Is that a fair point?
Yeah, for sure. It's especially with the advent of AI, so many deep fakes can be created, not just of events happening, but also of famous people speaking as well. You really need to verify that. For example, when Trump said at the F-bomb, they were coming out saying that was not AI. He actually said that. So it's very interesting about like verifying information that people react to supposedly fake news, then that really has an outsized impact on really people's positions, P&Ls.
But I think you said it quite well. The industry or the professionals are looking for this. They love this false peak. They really, I mean, we know one particular trade house, but I'm sure a few trade houses were actually short volatility, did very badly on the way up, doubled down here and then made it all back, which is kind of as you'd expect these guys to do. They get caught out fine, but they recognize what's going on. They stay calm and they're ready to sell off when it happens. So this is where you're getting the dangerous area. If you've obviously maybe just a natural long position and you catch a spike or you kind of buying into this, fine. But when you're coming into, a few days of the crisis and you got people like Andrew Tate saying, I'm buying 1 million barrels of oil because of the crisis. That was more last year actually. But like, that's when you're like, ooh, we're looking peaky here. If Tate's getting long, if people like that getting long, you're like, it's too in the narrative and not enough has happened for us to believe it can go any further. You're right. That's when the industry's starting to think, okay, what's overpriced here? Because that will be a good risk reward trade. It's scary, but nonetheless. Okay. Let's move on from that then.
So onto a bit of positioning as we've touched on a bit earlier. So onto our Flux Insight CTA model. This is for Brent futures. We've been seeing that recently, particularly recently, CTAs have been close to their max short level. So we can see the rises and falls sort of in line with the price action. So during the 12-day war, there was a brief increase and then position slowly coming off. But what I wanted to touch on is that recently, as there's been more and more talks of the oil glut narrative, Brent potentially collapsing below 60. There's also a bit of technical analysis on that, but we've been seeing the CTAs were close to being max short. So what this means is there's not that much capacity for them to add new short positions.
It also creates a vulnerable market for spikes every time.
Which is what we saw recently in the last couple of days. So.
Exactly. So absolutely bang on. I mean, that's what I would emphasize too. But I think I would just say the theme of 2025 has been a saturation of this information. 2024, this was hot information. This was, everyone wants their data. Everyone kind of wants, from Bridgerton or Flux or whatever to be like, where are people actually going to sell this stuff? Sorry, where are the CTAs going to get their sell signals or buy signals? Because it's all relatively transparent. That's why we have these models. There's pre-programmed, momentum signals and data that they trade off. That's the whole point. It's transparent and methodical, so you know what you're kind of trading into, and it's just strict rules. But the point is that whilst that might have been interesting and people trade around it last year, this year everyone seems to have it, right? And everyone is thinking the same way. And this is where it can get a bit dangerous. When there's positioning information out there or when things are too transparent, you're going, oh, well, that's at a maximum low or that's at maximum high. Okay, take the other side or I'm going to avoid hedging because of this, because of that. And it's like, it really can impact market dynamics. Because if I want to go and you want to go and we both stand off, the market can't really function as it's meant to function. A massive like tangent to that, but the same theme, is shale oil hedging in 2022 and end of 2021. There was a great article from the FT, and one of the shale oil producers was saying, I'm not going to hedge. Every single bank is out there saying oil's going to go to 150. Why the hell would I sell side hedge? And you're thinking, yeah, we're bullish too, or whatever. But no, that's terrible news, because if he doesn't sell, there's no liquidity for the market to orderly go up. So what's happening? That natural huge sell side volume we were getting before is now no longer there. So now everyone's just waiting for a price spike. And then when the price spike happens, people are scrambling to take advantage, or when it comes back off, people are scrambling to get the things off. So I would say that's starting to happen. And it kind of happens with any new information, like Genscape, when it first came out way before your time. Genscape preempts the EIAs, right? So the stocks. And so everyone's trading off it, making a load of money. But then everyone wants that information. Everyone gets that information. It's leaked out there. Then everyone's trading off that. And you've just changed the trading paradigm. It basically gets absorbed in. I would say 2025 is the year where this has not become obsolete, but everyone knows it. So don't think it's not priced in or not in people's thinking or whatever else. That would be my take.
Yeah, for sure. The democratization of information, right? When everyone is aware of this, then you kind of need to see new strategies, or to kind of think to when this previously had people thinking 2 steps ahead. Now you need to think 3 steps ahead of
always
what's happening.
That's efficiency. Okay, so let's move to the next one.
Right, just a brief rundown on the technical analysis side of things. So as we can see, this is the chart for Brent futures over the past year, and there's been a lot of support at the $60 level, as we talked about extensively. Very psychological.
Very strong floor, right?
Very strong floor.
Yeah.
Previously, that was the $70 floor last year, but now that's acted as resistance. But last few days, there's been a lot of narratives about the oil glut, potentially prices falling under 60 when a shale gonna be.
And again, the new theme, new narrative. But again, technically, you had that very, very strong support psychologically and technically, I guess. And the blue line is the 200-day moving average?
50. That's a 50-day moving average. And incidentally, that's where we've seen prices sort of see resistance over the past day. So what this means is that a lot of people, and at a time when narratives are driving the market, when there's a lot of algos, when there's a lot of volatility, people tend to look into the fundamentals the technicals for their day-to-day trading, and these in the market as liquid as Brent futures, these moving averages, the psychological levels really play a huge role in where people buy and sell. And so looking at the moving averages, it potentially gives a signal onto where prices might see resistance in this case, or in other cases, prices go down where they might find support. So this is just a snapshot of the latest take on where prices are going right now. But of course, overall,
we're very much at that moving average support line. I think that's incredibly important. And again, if it goes too far, we're going, what market regime are we in here? We've just flipped from a really weakening market, an acceptance that the glut is here because of the oil and water being the highest ever or close to the highest ever. The benchmarks are actually starting to feed that in. It's getting weaker and weaker in dated Brent. We've gone negative in the differentials to literally overnight, bosh. Okay. Now we had a bit of a short covering rally in dated Brent. We had, that actually seems like that was nothing to do with the sanctions. And then the sanctions came in. We've just flipped to a 2022, beginnings of a 2022 narrative, which is insane to think about, how you can go from almost max bearish to max bullish. And it's real, and I guess we're in that scenario where, that's why I brought up earlier, the market, I think, is aware, the wider market is aware that there is this dichotomy of freely available traded oil, and that being a market, and physical oil that's sanctioned, that's on water. The market's had to contend with that forever. I mean, the Iranian sanctions have been around for a long, long, long time. And that was always the case. You have these oil and water tankers that are just there. They're just constantly there. And it doesn't mean it weakens oil prices, because they can't affect benchmark prices. So this is like Iran on steroids, right? So I think people are aware of it and they genuinely believe in this. It's psychologically very, very hard to make money here, because if you're directionally trading and you've got into this narrative, people love to say traders shouldn't be emotional and they should be clear thinkers. It's complete and utter shit, right? The humans aren't like that. And also, it's just not true. When they form stories, they form narratives, that they are obviously going to get invested. So if you're so invested and then suddenly news comes out, you've got a hell of a lot of processing to go through to accept that you're in a genuine bullish market and then go, oh, first of all, stop out, which is a hard thing to do for a lot of people, and I'm going to get long. You can flip long short if it's short term, but when you've been investing for a whole year in a short position and you've almost got to the break and you've maybe started this huge bear run, 30, 40 cents of Brent spread to suddenly be highly backwardated, I don't think a lot of people made money there. I think the people who were already long in the North Sea, okay, they've done fantastically well, but that's more luck than anything else or insider information. But for the general market, I think this hasn't been a good thing. Now that we've got this like nice support line here, maybe it's a sign that we could steady for a bit. The market could kind of take a breath. And if this is real, or people are starting to believe this is long-term real, then maybe they can start investing here and there could be some decent money. But we know, obviously, Trump could go, yeah, sanctions over. So anything else on generic technical basis? I mean, has the RSI been useful this year? I mean, what's been useful technically?
I think the most useful thing is the psychological levels and the moving averages, especially if prices diverge too far away from these average lines, then there's bigger potential for a mean reversion. But in the sense that in the very short term, it's a good guideline for price action or for day-to-day trading in terms of informing when to enter or like position sizing, as well as when to stop out. Because if you want to, a lot of people probably may have placed stops just below 60, but we saw there was clear support at this level, and towards the moving average, we might expect prices to stabilize a bit more. So in a time when the markets are so volatile, chaotic, Trump can come in saying anything, reversing sentiment. Technicals are sort of a haven of sorts. Not that it's predictive of price action, but really helps with informing or providing a framework for risk management.
I agree. It's been quite effective because even if you look at this market, CTAs have been short all year. Well, they must have done okay. I'm sure it was very hard here because they were max short around here and then they had to cover. But, they're relatively slow to cover and then they were getting short again. And you have generally performed. It'd be amazing if CTAs haven't net done okay in oil this year. And from technical traders, they've probably done okay because if you're absolutely agnostic to the physical, you're not getting blindsided by the physical narrative, the gluts. You go, look, it's trending down. There's some quite nice patterns going on here. And I think it's generally been quite useful. It's traded quite faithfully to some of the core principles here. So yeah, all right. Let's do the next one.
Next one, we move on to Brent to buy. So touched on this a bit earlier. This is on an M1 basis, just quite volatile, but it's reached all-time lows.
Incredibly volatile. This is just for your sake. I've been trading Brent Dubai for a long time, right? 13 years, and the range is typically 50 cents being very much the low, really, to plus $4 being the generic kind of high. That's been a very solid range, and it's never really going through that range. It's either in a regime of low Brent Dubai or high Brent Dubai, and then you kind of have a regime shift, which takes a while to reprice, and then you stay there for a while. This has been, these ranges, you're talking about going from $2.50 to $1. So imagine that was 1 to 4. That's a considerable regime shift. But you're doing that from a negative to a small positive. This is like unheard of, right? So it was undeniably volatile, very difficult for the market. And I think the tourist trade, unfortunately for me, because I was always talking in the bull game on this differential, OPEC supply hikes, it was very low. Actually, we can go back here. And then you should expect a long-term rally as the market reprices because OPEC are back. It's pretty generic narrative, but it obviously should hold. What happened? It tubed and it tubed again. And you say, this is the announcement, right? OPEC announced, and then it tubed again. What's happening here? Well, you can say fundamental narratives, you can say physical narratives, and people love to do that. At the end of the day, this unfortunately is what makes trading the prompt very, very difficult, because if you'd held the back end this entire time, it's kind of been exactly what I'm saying, low positive and just kind of stayed there. I think we're max high 1 on the Cal 26 down to minus 20 now roughly. But that's not too bad. That's kind of what you'd expect. In the prompt, you have to stay away a lot of the time unless you're going to be very, very careful on your position sizing, because literally anything can happen. And the narrative was Chinese SPR buying. We've got all the Chinese buying SPRs. It turns out that was bullshit, right? Of course they're buying the SPR, but they always buy for their SPR. It was a pocket of concentrated buying that trade houses were able to use as an excuse to run all the tourists out of the market. All these massive longs that I think people were building up on this generic OPEC narrative. Bang, like let's just clear them all out, get them to all stop out, and then into the pricing month, just take everyone unawares. To get to -$2, it makes no sense, right? There's no justification. This is all about pricing dynamics and the trade house games. And look, what can you say? That's what they can do. That's how the Platts have set up that benchmark. You have to stay out of it. Easier said than done, and I didn't in some scenarios. But I think that at the end of the day, that's the only real message here. If you expect rationality, it's not going to happen. But just to finish off my ramble, I still think this proxy, this Brent to buy differential, you can get it on Flux. Even if you're listening to this and you're a retail trader, you can still get Flux for free if you have an account and you're trading with us. Even if you aren't going to trade this differential, you should watch it like a hawk. Because if your leading narrative was OPEC this year, then I'm telling you, you can't short flat price or you can't get mega bearish until Brent to buy really rallies. Why? Because if OPEC is overproducing, Brent to buy has to rally because the Dubai has to reflect the weakness. Well, it has to be stronger than fucking negative, because that is suggesting quite clearly a very tight Dubai market. So if OPEC are going to bring back all this oil, you have to see that Brent Dubai correct for there to be even the suggestion that there could be oversupply in the physical market, and sustainably so, into the pricing. If not, and actually that kind of proved right. I was very surprised we were selling off as much as we were when the Brent Dubai wouldn't rally. So it's all been a bit random, and that's kind of like, I'm glad you brought up this chart because it's kind of signifies best the year of trading crude. Why is Brent sold off when you haven't really got any logical moves off the back of it on something like Brent Dubai? The CTAs have all been max short, and the physical traders are probably thinking this doesn't make any sense because the market's really tight. I should buy. It's been chaotic. It's not been aligned. It's not been clear. Like in 2014, we had a Brent Dubai rally. We had the physical diff sell off. We had the time spreads go negative. We had all this happen and Brent selling off. It was a very orderly rally on retrospect. It's been nothing like that this year. It's been inverted.
Yeah, very, very much so. It just goes against the logic that you would usually expect.
Basically, yeah. That's what I'm saying.
And to refer to what you were saying earlier about the Brent to buy previously trading very high, this seasonal chart from Flux really illustrates that. So the white is from 2025, and since last year, really, prices have been...
This is only for the last 4 or 5 years, but even so, it's still the case, right? Like 2022, which is the real, obviously, ridiculous moves we had. Look, it's so high, and that's with Russia being taken out of the game, right? How are we this negative? How do you create a fundamental justification for Brent Dubai being this negative? The answer is it's just positioning, just not to repeat myself, but yeah, that's it.
I mean, yeah, people do find fundamental reasons, but overall it is just the buy market has been super tight. Although the last couple of days we did the increased sanctions on Russia, where you would
this is actually a bit more of a logical sell-off. I agree. Is that what you were going to say?
Yes.
Yeah. So this one we kind of gapped down, didn't we, in the prompt? It made sense because again, back to this freely available oil versus sanctioned oil. So the freely available oil, if you want to trade the Eastern, you buy, Al Shaheen, you buy Murban, you buy the local grades in the Middle East or the Saudi crude. Now, the Indians in particular were buying all this Russian oil. Now the secondary sanctions have come in that they can't even buy, or they don't want to buy that oil anymore. They have to go and buy Al Shaheen or something like that. And Al Shaheen directly prices Dubai benchmark. So that had to create a bullish impact, and Brent Dubai had to sell off, fundamentally made sense to, and I don't think people were going to stay in the way of it this time. So I think there were stop outs here, and I think there was also a lot of belief that you can't stand in the way of that. So I agree with you, and maybe now it can become a bit more logical now, who knows.
Yeah, sure. So yeah, that's just whole the Brent to buy in a nutshell. So against a bit of logic, but recently, as I said, Russia sanctions, more tightness here.
Yeah.
So that's Brent to buy. Lastly, we'll have a look at the North Sea crude market. So this is just a snapshot of the Dated Brent physical differential, as it goes ups and downs depending on the supply and demand dynamics, the trading, the positioning of the physical guys. Recently, we've seen a big, a
It's
big
like a
collapse.
CTA graph.
Almost, yeah, almost. It's just a bit of a seesaw effect going on. Recently, people.
Let's just quickly explain this for people who don't know, right? This is, again, it's not easy information to get. You can get it from us. But this is the physical differential from a Platts perspective, right? From the PRA perspective. This is what they're using to set the price for dated Brent, which in turn will set the price for all the differentials and then ultimately Brent time spreads. So generically speaking, even if you've got no interest in trading some of the dated Brent contracts we have on Flux, etc., you should still look at it to get an indication of what the physical differential is. And that will link very tightly to the Brent time spreads. And the Brent time spreads in turn will give you a good indication if the market is strong or not. So that's why that's so important. Basically look at this like a time spread. Yeah, so we've been going from negative 3 times in the year to incredible spikes. Again, this is what's just nuts. It's like Brent Dubai. It's like you would expect in a typical regime, you're either strong and you're kind of 40 cents to $1.20, let's just say. That's a very healthy, strong physical market in my experience in 13 years.
Yeah.
Then what will happen is it will reprice and the range will be $1 to 40 cents. And that's how it goes. Just like I was saying with Brent Dubai. And you see all the correlations in the wider market. Might be a bit choppy, but ultimately the market's either strong or weak, basically. This year, we've gone from pretty damn weak. 50 cents. It got down to 50 cents again a couple times more recently. Okay, genuinely a regime of bearishness.
Yeah.
To a flip to unbelievably bullish. It honestly does blow my mind a bit because it just shows you flipping from so bullish to so bearish and flat price kind of nicely trending down didn't really make sense. It just shows the chaos again. We're kind of repeating ourselves, but that's what I get from this graph. What else would you say?
Yeah, it's just lots of ebbing and flowing. It's just more recently in the last 2 months as talks of the oil glut, the increased supply narrative comes back online. As our viewers might recall, for October, November, Brent futures expired. Vitol took on a lot of barrels, and then also, so in recent weeks, the physical was quite supported up to $1, and you had headlines coming out from Bloomberg saying, it kind of almost goes against the narrative of a supply glut, but then the physical differentials came off into the last 2 weeks as as the market became a bit more oversupplied, cargoes were struggling to clear. And but then all of a sudden recently, we still need to update this, but the physical has been rallying again. It might be a bit of a short covering.
It's on its way up, and you can get an indication from the CFDs, data Brent CFDs, not to be mistaken with retail CFDs. This is the CFDs and data Brent, and they're interesting to track because you can get a forward indication of what the physical differential is going to be, or at least the market's interpretation of what the physical differential is going to be. And that is looking strong. That's looking like it's going to bounce back up, which does make logical sense. But I massively agree with you. The supply gut story has always been here. It was concentrating in the last few weeks. And one of the major reasons was this sell-off here. This sell-off in physical differentials, one down to negative, was the more classic repricing you would expect. And I was really genuinely expecting, right, here we go. This goes down negative. Every time spread in Brent is not deeply backwardated, deeply contango, but meaningfully contango, minus 10, 15 cents, 20 cents a spread. And there was only one spread, or maybe Jan Feb as well, slightly. Two spreads to go. And it's over. It's a contango market. We're in a regime. That is what you'd expect. And it did look like Brent Dubai was it kind of started to make sense. Brent selling off, Brent Dubai picking up, physical differential selling off, and then bang.
Yeah.
For fuck's sake. That's why I say I struggle to believe that people made a lot of money on this, because you are looking to trade this repricing and it's all making logical sense. Then you get a black swan event. So you pick up again. The question's going to be, in everyone's mind, do you get long? So to your point, Vitol buying a hell of a lot of cargoes expiry, other trade houses owning oil here, they've gotten super lucky, right? They're gonna do very well. Fine, that's the way the game goes. But having said that, once it prices and you've made your money, are you gonna get long again? Are you gonna genuinely take on the physical again and expect this market when you know how vulnerable it is to a sell-off? And all you need is to Trump to tweet at 12 p.m. or 12 a.m., whatever, and say, I've agreed to remove sanctions. All that oil and water, like I said, Iran on steroids. Whenever it would be announced back in the day that Iran sanctions were going to be relieved, you knew all that oil was going to go find homes. It was unequivocally a bearish event. It's that so much more. We've got so much oil and water. If you remove the sanctions or a peace deal is made, I mean, it's like 1 billion barrels. I don't see how oil doesn't go negative again, or at least threaten to, in a short period of time, whilst the market reprices and clears this oil. You might not see oil negative in the benchmark prices, but you will for sure see a lot of people struggling to get rid of the oil and paying people ultimately to get it cleared so we can start again. So honestly, I wouldn't put it past the market to price incredibly strongly in the next few weeks, rest of the year, but then also be vulnerable to an incredible price dump. So I mean, buy volatility, I guess, is the only thing left to really say on that side of things.
Yeah, for sure. Buying volatility and the post-sanctions trade, there's going to be a lot of adjustments being made. That's for sure.
Yeah, and do you know what? Even as we're saying this, it's a Friday. What's the date? Whatever we are. We're launching next week. This will be online and part of flux-news. Man, think how much could have changed in the next 3 days. So look, just so the audience knows, we were on a Friday, just only a day after the sanctions were announced, or a couple of days after. So we don't know, but it could literally be the weakest market ever or the strongest market ever next week, which is nuts. But yeah,
for sure. Another really important, some interesting, a bit more niche chart I want to bring your attention to is looking at the actual physical differential versus how the data Brent held the forward curve was priced a week prior to expiry. So that's for the weeks.
This is data Brent implied. You're looking at the CFD curve, right?
Yeah.
CFD curve, the market anticipation of data Brent versus actual. This is a great graph. Yeah, thanks. Sorry, just wanted to make that clear. Go on.
Yeah, so on the left side, that's what was implied on the CFDs, and that's blue bars, and the orange bars was the actual physical differential, how the actual market was priced. And over the period of summer, there was a period where refinery margins were super strong off the back of stronger distillate cracks, gas oil cracks. And so the narrative was that triggered a lot of refinery buying, especially in July and August. So hedging the cargoes on paper. So the paper implied was really high, but when it came to the actual physical pricing,
but when is the snapshot? So is it like 3 weeks forward?
1 week forwards.
1 week forward, but you could even go 3 weeks forward. That would be very interesting as well, because 3 weeks forward, and if you go to like 13, 17 week in October, people were pricing that at plus $1. It priced minus 50. So that's when, again, that's another signal to be like, bosh, the market's cracked.
Oh yeah.
So yeah, sure. But your point is what? That it just struggled to actually reach the heights.
Yeah, for sure. So during a full period between July until September, it's if I have the numbers right, the actual physical was weaker than implied for 14 weeks in a row. So in theory, if you were to short the 1 week roll into pricing, every single week would have made money for.
But again, straight. That's a very nice physical signal. Sorry, a bearish signal. I'd be looking at this, really struggling to keep up here, and it just re-emphasizes the same thing we're saying. But this great analysis. Like, I think it's a shame you don't have that week, because I could show that. But other than that, like, you need to get this out more in the reports. Like, people should be clambering over you for this information. It's not easy to obtain, but you'll supply it, won't you, Vincent?
Oh, for sure.
For a cost.
For sure. So lastly, refinery margins looking forward. Of course, it's closely linked to how the demand dynamics in the data Brent market, and margins have been creeping higher since the start of the year. This is the M1, and gasoline cracks, diesel cracks have all been really supported. So, and in line with this, we've seen physical strengthening off the back of the sanctions news, and margins are pretty strong as well. So this makes, at least from my perspective, a bit more bullish going into the winter time, especially refiners coming back out of maintenance. There's going to be a bit of demand coming online, as well as the fact that if margins are in a high environment, then some refiners may be looking to defer their maintenance schedules come spring. So there's very much a bullish thesis for data going afford if you come.
Well, and as you saw on your previous slide, like you said, the refiners are buying those CFDs to hedge this kind of thing, and you get the indications. It's got real paper impact on the dated, which then impacts the Brent spread. So don't think that that's irrelevant. Like that's super important. I agree with you. I just wanted to add, going into the year, reasonable margins. This spike, the market's been pricing on a refinery margin basis as if the market has, or the world has, a lack of refinery capacity. And to some extent, that's probably true because of Russia being bombed, maybe that kind of thing. And China probably not running their refiners anywhere near what they're capable of doing, like more like 50%. So it kind of makes sense, but it's also pretty crazy. And I agree with you. It's hard. It's a very bullish signal to have such strong margins. And for them to be up this is European, remember, not Asia with the sophistication. This is European crappy refiners making a hell of a lot of money. They've all been wanting to sell their refiners for like the last 10 years, but you've held on to them. You would have made money, quite a bit of money. And I think when it's as high as $9, it's so hard to look at that and say, are we actually in a bearish market? And then, but to challenge that a little bit, we were selling off. This sell-off, the latest sell-off from 950 down to close to 7 was happening with the physical diffs coming off. Just to repeat myself, everything was coming in as you'd expect. And the problem with margins is if the demand is relatively healthy, but you've got an oversupply story, then you can justify having low crude prices and high margins because the products just are a bit more sticky, but the crude is getting, so it kind of makes sense. So you justify to yourself, it's okay. It makes sense that margins are high because crude's weak. But the problem is, can you really get a proper sell-off if their demand is still kind of sticky? And we've seen a considerable amount of consumer hedging at every point at every major sell-off. The tariffs, that sell-off we talked about earlier. Do you remember we were talking about this podcast earlier on in the year? Like insane amount of consumer buying from fuel oil. Then we got to recently with the sell-off when we got close to the 60 figure, the most ever jet fuel consumer buying, people are saying, from a hedging basis, like really, really concentrated buying, like quite unusually so. And that does have a bullish impact on the margins and the overall flat price. So what I'm saying is a real sell-off, if you like, will be completely undeniable on a margin basis and on a flat price basis if there is a demand shock. So that's maybe been the problem, if you like, for the market to not really follow through on this bearish move. I think we've got to see the recession that people are talking about. Yeah, UBS was saying it's like a 93% chance of recession now in the US. Okay, well, if that's the case, then you will get demand destruction and you will see these margins weaken. And once these margins are down into negative territory, it's going to be the complete flip. There's going to be a lot of reasons to sell off and to not hold up, but we're nowhere near that right now.
Yeah, for sure. So very much an oversupply story. That's the narrative of the past year. So demand has been keeping up, but there's just been more supply coming online.
Yeah, but like you say, like when you have shocks and you have maintenance being over and you've got refiners for reasons to buy the paper, it's hard for there not to be a big bullish impact. And then when you have CTAs max short and the market's so short, it creates vulnerability to these market roofers that we've periodically seen. And that's, I mean, I think we've done hopefully a relatively good job there over the course of this podcast to really emphasize when people say it's been a difficult market, this is why. Because you get it a lot. You know, it's been volatile. Surely it's been easy to make money trading. And the CEOs of Gunvor and Vitol and stuff were asked this as well. Like, how's the market been? They say it's just been very difficult. And people generically don't understand what that means. This is why you get this bullish signal versus this bearish signal. You've got oil and water versus very tight free markets. You've got all these things going on. You need kind of, yes, volatility, but volatility around kind of correlated indicators that over time can create a regime shift or a repricing. That's what the market was looking for. It didn't get it. So you're getting winged and wanged everywhere, and it's very difficult.
Yeah, I suppose like the difficult kind of volatility, especially with the US administration comments and stuff as well.
Yeah, usual 100%.
Yeah, all these changes.
Yeah. Cool. So should we finish maybe just quickly? You know, as I said, we are doing this podcast only very recently after the sanctions have been announced, the latest sanctions, and a lot could change. But going into next week, should we put some predictions in place? What do we think is going to happen? How do we think things are going to pan out?
Yeah.
Go on then. So we've got the CTAs probably still need a lot to buy back. There's a lot of capacity for them to buy back. We've got refining margins, very strong. We've got the Russian refiners still getting bombed. We've got a lot of bullish reasons, and we've got a big paper unwind from the market being so bearish for so long. the longer these sanctions maintain, the longer the market believes in them, the more time the market has to flip their positioning materially long. So I think it's obviously contingent on that, but I think we can easily go back up to the 70s here, and it could be a very decent bull run. Brent spreads, basically a full bull narrative. That would be my prediction if things are going to stay as they are.
I think so, yeah. But to speak of what might happen on the opposite end, if Putin comes to the table quickly, and US have mentioned publicly that potentially sanctions relief for freezing the front line, all of that as negotiating tools. So if that comes out, these headlines come out, then we could also see a rapid unwind as well. So as to we need to look at, like, the traders need to set stop out levels very cautiously.
I think so, and I think momentum trading could work. But remember, when you get bullish and you get volatile, it's tough.
Yeah,
you get chopped in and out of trades. My take would be trading from the long side, but the higher we go, start to pick up cheap put options. Because there's no, it's like a COVID event, right? If imagine being told COVID could happen. You're like, okay, I'm going to buy some fucking $20 puts, because if it does happen, it's going to really aggressively get there. I think the market is signaling that to us. It's saying, right, trading for the long side. But if Putin makes a deal with Trump and like it's happened overnight, then you really can, with all that oil and water, go from 75, 80, I don't know how high we're going to get, 85. You can genuinely go down to $30 with how much we've got, and how much positioning and how much carnage can happen all at once. So the only trade there is long volatility. So you have to own an option, you have to own an out the money put, and you have to, obviously, when that happens, price in the volatility roofer, maybe at that point, take it off and have a short position, whatever. The point is that could very easily happen. That might become a crowded trade, but basically long outright, the higher we get, the more you're buying out the money puts, will be my thing. And you could do the same with time spreads. You can buy CSOs on Brent spread puts. You can say, you know, as we get to $1, $2 backwardated on Brent, if that's going to happen, you can start to look at the deferred curve that's been dragged up and start to buy, you know, minus 60 or minus 40 put options on the spreads. That would be my take. I wouldn't do it in gas oil, because gas oil's still got that Russia situation. It's still got all that consumer buying. Clearly there's still demand. But at the same time, if there's a macro sell-off and there is a recession that comes in and all this gold unwind and everything, that kind of stuff, then yeah, you could get washouts everywhere. But that would be my take. Anything else to add?
Yeah, I think with these hypothetical trades, one would be covered on both sides for sure. So you can, like, on the rally, flat price, right? And then if things go the opposite side, then the puts will have you covered.
Yeah, I'm not trying to say buy when the market goes up and sell when it goes down. I think the market will go up as it is right now.
Yeah.
But because of the shock decision, the best way to trade a shock decision is to have a put option. And actually, if you had them in the tariffs, like I was saying, you got paid very quickly in 2 days, and then you're out of it and you start again. That if you're not in it, you'll lose it. You know what I mean? There won't be time to sell on the way down. It will be too aggressive. So you're going to need that insurance. Great. Vincent, thanks very much. That was very thorough. And thanks again, viewers out there. See you again soon. But again, it's, the guys I think we have, they want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. And it's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business. So I thought we would refresh our conversation that we had, it's actually 2 years ago, that we actually properly talked about the firm, what we're trying to do, and I guess, the developments of this year in particular. So I guess the leading thing to start with is like, what are the latest things that we've done? So the big developments, I guess.
I think the setting up of Axis.
Setting up a new market making division under the Capital Group. Consolidating like our services under one brand, Flux. So now we've got that like super clear. Onyx Capital Group is a trading business with market making businesses, 2 businesses across 4 different locations, Dubai, London, Singapore, Zug, and then soon to be New York. And then we've got obviously the service business in Flux that's got the retail offering and this kind of stuff. But I guess starting from the top then, like.
And we've also grown into the power and gas market quite a bit, which is quite a new
exactly. But I guess
for us.
To refresh, people wanting to know what's going on from our point of view and what we're doing. Again, it always starts with liquidity, right? Liquidity providing, that's what we do. That's what we've done for almost 13 years now. So this has been an extension of trying to basically be as big as we can in that space. So I guess this year, like, we don't mind being transparent about it. Axis was about taking traders from competitors, building it so that rather than compete with us in the external market, they're competing within our own brand. And on the back of that, we have a more market share, and we're kind of moving more towards that kind of dominant position, which is obviously great for a business. You see it the same way, right?
But I think, so we've grown our market share significantly by bolting on Axis. And it's nice to have, 2 different setups where they kind of have their own trading views, they're very diverse. We've seen times where, even recently, where, our gasoline book could lose money, but the other gasoline book is making money. So it's not like we are trading the same positions. And again, it's good when the market's going in the right way, when both parties catch that move as well. So it diversifies our risk and exposure big time.
To emphasize that, like last year in 24, that the opposite happened, right? We had a lot more traders coming in, different backgrounds, and we brought them into the same team. So we're having in this room, trader conversations, and they're actually, what happened was groupthink, right? And we were getting stuck in positions that were too correlated.
And every desk had kind of the same position. When gasoline was coming off, the whole, fuel oil, relative value, every book was long. Whereas when it was rallying, every book was short. So
that's the important distinction with Axis, right? We keep it separate.
Proper Chinese
walls. They do their own thinking, their own management, and everything's different. So in effect, it really is a competitor.
It is a competitor.
And then you get the benefit from that. So for anyone wondering, that's why, right? Because trading can be quite damaging in the sense of, Alf used to call it portfolio heat, right? When too many people have the same reflections, but put in slightly different ways, that can be very damaging.
And I also think, in terms of increasing your market share as a sole desk, when you go to the 30 to 35% level, it kind of saturates. If you go anything above that, you're almost taking the opposite side of the market, which which I've done sometimes, which previous employees have done, and then you end up with a position where you can't really get out of because you're giving the whole market the position, and you're the only one with the opposite position. So there's no outs. So the only way to get out is, you stop out when they're taking profit, if at all, right?
It's a really good point. Becoming that shift from a decent player with decent size to a dominant position from a volume perspective, doing so much of the liquidity providing, as we call it. We've had these new challenges we wouldn't have expected. So I guess what counters that then, if the overall market continues to grow with it, right? Then the capacity overall grows.
I think the overall capacity grows. But again, I think the market has also changed significantly to the point where it's kind of over market made now. So, when we were trading propane back in the day, we were one of the pioneers, and you'd always trade with real interest. Whereas now, in almost every market, there's 3 to 6 or maybe 3 to 7 people trying to market make. And it's okay in certain markets like fuel oil where it's very big and the volumes are humongous. But in certain markets that are illiquid, you end up just, you're just making two ways. You're trading with each other, and then real participants don't take part. And when real participants want to do something, they can't get it done as well. So sometimes, liquidity is, when there's too many market makers, that's not in the best interest of the market as well.
Yeah,
so you need a dominant
outside of what we do, like the options market making space, right? So generally speaking, options market makers need to be short volatility, right? They need to sell all the options to the world to get on their bets, their insurance and all this kind of stuff. So like the Iran situation this year taught us, right? There was a massive spike and when the tensions were peaking. And we heard, all the options traders lost a hell of a lot of money because they can't not be short. That's how they provide the liquidity. But as you say, when it's like too many people doing that, then what do they do when the volatility spikes?
It's a crowded trade and it's oversaturated. And again, to add on options as well, that's something new we've done this year, hiring Humayun, who's been a great addition to the team as well.
Yeah, it's trying to, I guess, so increasing the volume of the trades that we do, I guess, is what we would consider market share and going up to about, 30% of all markets.
Yeah, I think 30% is kind of the ideal point because when you try and force it above that, you kind of end up in an awkward situation. So sometimes you want to sit back. I think that's what I've learned as well is, there's days where you can be 40, 50% of the market. Sometimes everything lines up and everything's perfect and you can just trade everything. But when it's kind of one way, you don't want to be that one person giving all the liquidity because you're just going to get run over, right? Yeah. So I think 30% is kind of the sweet spot as an individual desk. But with the addition of Axis, we've kind of built that quite nicely to that level.
Well, it's getting to like 80+% on some niche contracts, data Brent CFDs, things like that. Yeah. But the next piece was, okay, it's all well and good having a lot of volume. How is it working as a unit? And that's something I think has been some evolutions this year, really excited about. So if we talk about New York, right, we've got Billy coming, who is a big distillate and crude trader, but much more on the futures, the block futures. And it's such a core component that, we do, but we're not as dominant in. So him bringing that in creates a kind of a slot in. And so that 1 + 1, Billy plus us doesn't equal 2, equals 3, right? And I'm really excited about that because it's basically, it's the information, it's the centralization, it's the internalization concept you can get, which I think is the next thing. And we can talk a bit about that, but then I guess the thing after that is to remember like what you're talking about, having liquidity constraints with your own trading, getting to a certain size. We've got to remember that that's because we are operating at the very, very forefront of the market. Like we don't get we haven't until now been getting the kind of flow that the banks get, that the basically all these models that provide access get. So by us bringing in this flux model of, flux markets, giving credit, giving clearing, giving access to retail traders to our market, that is flow that's additional, that wasn't there before. It really helps our game. So that's what I'm trying to say is build really strong liquidity, start to figure out how it works together as a unit and bolt on additional flow. And that's what we're going
for. You need additional flow. You want different flow, right? You don't want the existing flow in the market. As in the flow in the market is good, but all these avenues open up people who haven't even thought of hedging or people who haven't even, had access to these markets. And, retail clients, we have quite a handful and they're actually starting to make a decent impact now in terms of what we do. So I think that's a great addition to the team and I think it's going to grow and grow and grow. And there's so many untapped markets like, Jakarta, Thailand, there's, Far East Asia. There's so many people who don't have access to these markets. And again, as you said, everything that comes from these sources will eventually go back to the market, right? Yeah. It'll go back to the exchanges, to brokers, to traders, and it just makes the liquidity healthier for the entire market as well.
I think another thing we probably should acknowledge is we have kept the model very tight in previous years, but you get to a certain size position in the market that it's very difficult to operate without being able to handle directional trading. Yeah. And I think it's something we've developed over time and let's be honest, had some pretty shocking periods as well as we've kind of calibrated and navigated these markets. In particular, this has been a very tough year, but last year, second half was very tough as well. But we've learned a lot on that side as well, right? Like we've got Ligier in Singapore, who's pretty much running like a mini fund now, right? He's got like 4 or 5
his global
guys.
macro book, which trades cryptos and a whole bunch of different things.
But it speaks to, again, trying to not just build something that maybe makes money, it's build something that has benefit to the overall business. So I think Ligier has always been very passionate about directional trading. We did an Inside the Minds episode with him, getting into the grips with like how he's evolved over the last 10 years. And it's very complementary how he looks at markets to what we're doing. He can give you that macro aspect. That you don't feel like you're missing things, right? A big stock market move, a big macro shift. The trick though is really becoming proper like portfolio managers. I think that's been a challenge for me and you, right?
Yeah.
Because we're still quite active trying to figure things out on the ground, but then you have 2 huge portfolios in Onyx Commodities and Axis, and then within them you've got very different trading styles. We used to just be like just curve strip, market make, whatever, like, and kind of boost that a little bit, but now it's gotten so complex that it's just the challenges I'm trying to get at. Like
I think it's been a great experience. I think since our propane blowout in
24.
He's
come up with some names for these. The propane blowout.
It was a Feb or March. We drew down 40 million in a couple of weeks, which is a big learning experience for us, right? We'd never seen a shock in that way, and we've never had to trade a liquid market to get out of something like that as well.
Yeah, exactly. So, it's not like you can just go, okay, fine, call somewhere up and get out. This is something you have to manage.
That was kind of sleepless months almost. I think when the markets have evolved, when the markets were good and directional, it would have been a lot easier to manage these positions. Whereas this year has been a cluster of news, right? From tariffs to Trump announcing different things every time, Iran, Russia. There's so many macro drivers.
And then mechanisms breaking down, right? Physical traders pushing one thing up versus the other that gets everything out of historical norms. Like it just feels like
again, recently as well, propane. The classic trade was to price CP long, be long FEI spreads, and the Saudis printed quite high, and there's a big shock of this. CP was printed $50 lower. And that caught the whole market because everything was already historically quite cheap. So again, a lot of these markets are changing fundamentally how people trade it. So the whole easy trades aren't there anymore. It's still there in certain markets, but you have to be, risk management is very important as well, I think, in these markets when there's so much uncertainty, when you're at extreme levels on trades. If you look at our cracks at the moment on gasoline, they're at historical winter highs. Again, whether you want to be long it or short it, you've got to be, again, it's stops and risk management. And that's something we've kind of lacked, or, I
was going to say, like, we can't say we're like being geniuses in risk management, but I think as you say, that any time you have a failure and you learn from it, that, gives you a positive expected value over time. But, to just very easily say, but, your risk management is flawed because you had drawdowns, that's also oversimplifying it, right? Like, you have to look at the lay of the land, what you're trying to do. And one thing that does frustrate me with us versus our competitors and others is, we might have gyrations in our P&L and like what we're trying to do and bad times, good times, whatever, but we have a plan. So as in, like, if we are going to be directionally short gasoline, we're going to have a macro thesis, we're going to deploy it. It's our prerogative, right? And at the end of the day, like, we're not trying to be a steady 8% a year growth business that we can IPO and go cheers, like, isn't it so safe? It's our money. And at the end of the day, we do have a plan. We want to be the traders, be on the front foot, switch from a passive trader to very much on the front foot, providing liquidity, but providing the messaging to the market, providing like, very strong stance on how it's going. And that is very, very difficult, especially in a market like this is, like it's been. So the learning, what I'm trying to say is, if we don't learn, that's the bad thing.
But I think from all the experiences, we've had great experiences and we've had a few not so great experiences. So it's kind of learning when you're doing well as well. Could you have done things better? Could you have run things longer? Could you have
and you get people
scaled
say,
up?
Why didn't you think about this? Why didn't you think about that? There's a lot of hindsight. It's been very interesting to get third parties in to critique your trading. And what do people do when you're losing money? Why are you losing money? Or that's losing money, and they emphasize you're losing money. It's like, but it's not really about after the fact, isn't it? What are you going to do? What is really going on under the hood? And then there's these theories about, yeah, but are you guys trading to counterflow? Are you doing this? Are you doing that? It's like, look, you try and build this liquidity model and build it to what we have. It's a beast to manage, and that's what we're trying to calibrate right now, basically.
Yeah, and I think we've had a decent year this year, but again, it could have been better. It could have been a lot worse. When in end of Q1, usually Q1s are stellar quarter, and with Trump and all the news that happened, mid Q1, we were down quite a bit as a firm, and then we did really well to recover. So I think we cut the risk, managed it, and then when the market was turning, we added on the risk. And again, we've had a bit of a lull where, again, the propane move and the gasoline move, it's caught us a little bit. But again, it's how you recover and what learnings have you taken from it. And I think all our traders we have now are pretty good traders as well, right? Okay, whether they've made money or drawn down, they're pretty disciplined, they're very communicative.
I think it's an exceptional team. Like if I compare it year on year, I was moments last year very frustrated because I didn't see the method in some of the approaches. But this year you can't say that.
But I think we have a strong trading team.
But it's also the network, right? Like again, it's all well and good saying, I'm just going to start a firm, hire a bunch of good traders. And that was basically the model when we started and other traders, other competitors. But now it's like, what are you doing about the back end of the curve?
Yeah.
What are you doing about the front? What are you doing about, increasingly digital trading? And that I'm incredibly proud of but the results won't show it this year. I think this is a future thing as Axis builds out and all that kind of stuff.
Yeah, I think this year has been a lot of investing in people, hiring people. We spent the latter part of last year and the first half of this year, going through all our legal disputes and, hiring a great exceptional team. And even when they started out in Dubai, the first couple of months was quite tough for them, right? Because they have been out of the market for 18 months. Things have changed. As I said, there's 10 market makers now quoting 2 ways down the curve. And, the last 2 months, these guys have done exceptionally well and kind of found their own niche and found their own way of trading. So yeah, I think, we've invested, again, it's key investing in the right people, right? We spent so much time and effort hiring these people for a reason, and we knew, okay, it's not going to be easy from day one. And like, as you said, it's an investment and it's already starting to, yield its rewards 3-4 months in, and it's just going to get better and better and better, I think, as time goes.
And I think the rewards from taking your licks and learning from last year and certain things, and I think I've got to commend the team, and they're developing as humans as well, right? We're all personally developing, and I am seeing that with the pretty much the whole trading floor, that they're very keen to personally develop, which, to be honest with you, there were some people last year I didn't think that was true. I think they kind of felt like they were the finished article and there was bigger and grander things to do. I think here it's a great compliment to have people come in and go, I can't believe how much nicer it is. There's no politics. We're just cracking on, and I get left alone, but can still interact. It's all these nice things. I think we're starting to get that, the calibration of the culture, if you like, really, really kind of quite nice. So that's the big win out of this.
Yeah.
But on the flip side, the challenge is, if the markets and conditions have been hard for us, they've been hard for other people. The CEOs of the trade houses recently came out and said it's been really, really tough and hard to predict. But the margins have got higher, and I've made no secret about the costs being extortionate in this market. That also squeezes trading margins, and I think that
we pay 100 million plus in costs, trading costs a year, which is
makes us
ridiculous.
A big customer of the market. But the point is that I would say this year what has changed is it's kind of squeezed out competitors or businesses that actually clearly haven't got a plan for the future, and that's, I wouldn't say I wish like bad on them, of course, but as in like it's good from my point of view that the model looks sustainable as we are deploying it, whereas others are starting to die out. They haven't really got a plan. Like you say, you might need to take a bit more risk. You might need to do this and that because liquidity is harder to provide and whatever. But they don't seem to have a plan, some of these other companies, and they're starting to fall away. That's quite interesting.
Yeah, I think we're very well placed in, a lot of us have been doing this for nearly 10 years. We've hired a good group of people. We've been well, we've kept a lot of our money back in the business as well, right? So we're well capitalized. And again, a lot of people came into this market in 23 thinking, with the whole Russian market and, with all the Russian headlines and what happened during the war, it was a lot easier to make money. Don't get me wrong. It was probably
A lot of funds came in to chase that money. That is what you're
looking
saying,
back,
yeah.
I think we could have made a lot more now thinking.
If
But
it was now,
if it
the
was
develop-
now,
but there will be another time.
yeah,
right?
it'll happen again. But
Yeah.
at that time, our traders traded exceptionally well. They learned a lot, and all the other entrants, such as the funds and the other new market makers, kind of came in at the not the wrong time, but if at all, they kind of added to the problem as well, right?
I agree with that.
Funds came, and we've had a very whippy crude market this year as well. I think finally we've seen a proper break to the downside, but in general, it's been whippy, and there's been stop outs on all angles. So I think we are well placed. I think our competition is dying. You've seen a lot of people pulling out. So I think we are exceptionally well placed with our technology, with our people, with our training
But
program.
why do you think it is? It's just a lack of, I put it down to a lack of plan, but how do you see it?
Yeah, I think, you need a plan. You need different iterations. And I feel like we've done over the last 8 years all kinds of iterations, from, being purely market making. When you started, every night I used to get a call from Johnny saying, "Oh, Greg's holding 200 CFDs overnight. Can you ask him to reduce it?"
Yeah.
To us now holding thousands and thousands. Pricing thousands a day. And again, the whole propane blowout taught us a lot. On gasoline, we've had great times and some not so great times. Last year, this year, we've learned. So I think we've been active on trying different things, experimenting, with all the technology, all the retail, all the direct trading and relationships. We've kind of got everything. The platform is kind of now perfect almost, right? So I think we're well positioned for the rest of the year and next year. And again, if there's going to be an exceptional market move where crude dumps, to low 50s, or there's some kind of macro event, I think we are so well placed to maximize that. Because we've learned to be relative value traders, where you can trade when it goes to extremes, and then you also learned, okay, when it goes to extremes, there could be new extremes for reasons, and we've kind of got that right and wrong. So I think, looking back, we've kind of been through it all. We've been through easy market conditions to tight market conditions, but we've kind of know when to be active, when not to be active. So I think with our processes and plans in place, I think we are kind of on for a very good ride. And again, having two entities is phenomenal as well, because you almost have two trading houses working under you, which is great as well.
I think expanding on the future, like obviously I hope what you're saying is correct, but we can't deny as well that the market is evolving. So we've always tried to stay on top of that, but at the same time, we did come into this with people saying your job won't exist, right? And or same thing people say to brokers, you won't exist, the market evolves, whatever. If anything, it's been proven the opposite, right? I mean, certainly like the Jane Streets of this world, the Citadels, these guys are like mega businesses as market makers. But that aside, we have to acknowledge that, the technology innovations in markets, tokenization, crypto, etc., like how incredibly sophisticated they're getting. It is finally starting to find its way to energy, albeit still like very, very different markets.
Yeah.
We are obviously trying to manage that transition and be on the top of that, but it has been interesting, isn't it? Like there doesn't seem to be a way in for these kind of more technologically driven market makers as much as they probably would have thought. We know that they've tried and maybe failed, but they'll still be there, they'll still be knocking, right? But again, it's like, how are you feeling about those next 5 years?
Yeah, it's interesting, because I think if you look at markets like Dubai, I think you or Factory were telling me the other day where like 10 million lots of the front spread traded, and 90% of that was on the screen, right? But I guess Dubai is pretty linked to crude, right? So you can, it's easy for algos to automate and auto-generate markets. Whereas when you look at markets like gasoline, naphtha, if you look at the ice screen now, it's populated with two ways down the curve. I'm not sure who's doing that. But at the same time, it's for 1 kb, or, nothing trades on it. I'd say, 0.001% of daily volumes go through there, if at all. So
yeah, the screen trading has an element, but it is interesting to see like you say, Dubai's screen is incredibly liquid, but the broker market is still making record volumes. So the OTC is still huge. So it just helps markets grow, if anything. And we go hiring Billy. Billy's market is futures trading.
Yeah.
But he does block futures with brokers. Yeah. Like that's the majority of his market. So it's like, it doesn't seem like they're going to go anywhere. The market will just evolve. It doesn't necessarily mean things stop or start. It's just evolutions, right? But I think one thing that's been proven is you have to have so much domain knowledge, right? You have to have so much understanding of not just the physical, but the mechanisms of the physical and how it interacts with the benchmark price. And this year has been very hard for people because of the distortion between what's going on in the physical and the benchmark. So imagine that for an algorithm, right? It's just pretty
there's
difficult.
too many niche points, where things work for a while and then it doesn't work, and identifying when it doesn't work is significantly important, and that's where experience or what's happening in the market. So I think the screen helps to grow the market and the volumes, and it gets outside people to look at it. Certain people don't have access to brokers.
But that's what I was trying to lead into Flux, right?
Yeah.
So that's really our thing. So visibility through giving you a platform that has the market numbers, which is straight from our trading floor.
Yeah.
And then our digital trading, we're not just going to throw that out there like to support another platform for the sake of it, right?
Yeah.
But we will do our best to present our liquidity in digital form to our clients, because that benefits us, right? I mean, we can start to show people access, show people visibility to get them more engaged with us, get them more engaged in the market. It doesn't necessarily mean that's going to become a hyper liquid screen. It just means it's an extension of our liquidity out to the market, right?
Yeah, it's like it's the same as someone calling us up and asking for a two-way. It's like direct trading, but having it on a screen just makes so much more sense. And if someone can click a button and trade it, that definitely makes sense. And eventually maybe we partner with some venue, so that we have distribution to the entire market from every single user. But again, the time is not right, or the partners aren't right. So when that comes about, I think it makes sense. But right now, it's a good way to market our services, our liquidity, build relationships with clients, and we started it 3-4 years ago. And
what I really like where it is now is the Flux business can be called one business now, and all the things in that business. But really, it's like a bit like say New York and Billy joining in Onyx and fitting together. It's a bit like that with Flux. It's like finally now you can see it on basically a screen and a unified service. You can see how it fits into Onyx. It's the way to get access to everything, all our trading, basically, our liquidity, which is directly the liquidity in the market. So that's as simple as a message as I can define it. Like Flux is just giving everyone that access directly to that, not just via a bank, via this, via that. It's like, no, just come to Flux, and whoever you are in the world, institution or tiny person, you'll get direct access. And I think now that people can visibly see that, even internally, people are starting to get it. Like you say, they're like, shit, this retail flow, like that was actually pretty decent. Like this is cool. You can see it growing. You can see how our model is benefiting people, and hopefully that will just grow and grow and grow and evolve the whole business, really.
Yeah.
So I think what's worth touching on as well is like maybe taking a little bit of a backward step, but the competition again and some of the legal issues we've had and recruitment in general. Like you said, like hedge funds have been out there for the last 3 years hiring basically anyone seemingly half decent.
Yeah.
And then you've got the market making talent, which, from our pursuits, we've kind of seen just how tight this market is, right? There are not that many, and we've pretty much got captive share on those market makers, right? But the money spent to get that, the legal cases we had with Dare, and then the general recruitment out there, it's very, very competitive and tight. So what has been your take on that? Bear in mind, obviously, when we left Mandara 10 years ago, and that was kind of how we felt. We had the world was our oyster a little bit now. Now it's not so much like that. It's like, where are you going to get trained? And these contracts are massively long, and like it's just a very different landscape, isn't it? Like, how do you see that evolving?
I think still the best talent you generate for market making personnel who focus purely on the curve and try to extract value from the curve and position based on what the curve is doing. I still think most of the success we've had comes organically. You hire graduates, you train them, and the only people who've succeeded have been trained under us or the top tier ex-Mandara personnel, right? There were a cohort of 6 to 8 people, and anyone who's done well in the market making industry has trained under those people, whereas people who start their own shops or do different things and try and get into it haven't succeeded in any way or form, right?
It's just become too...
It's too competitive.
competitive.
You need that formula and that structure and to be trained organically, and you need leeway and good management as well, right? We recently lost someone who left propane last year, and he moved somewhere else, and we said, we have a very good nurtured culture. We will guide you. We are okay. We will manage draw. We all in it together, the infrastructure. And we had this whole long conversation, and this person leaves, and exactly what we told him happens, and then he comes back to us and mentions, he's, as a friend, he's like, yeah, this happened, and I was like, yeah, we told you this was going to happen. So
I guess a lot of employers do that, right? They say, oh, it's never good anywhere else, this is the best. But in our case, I guess we put a lot of thought and work behind.
A lot of thought and work. And again, I think it's important, from this whole legal, disputes we've had, retaining staff, we've lost good staff, we've gained some good staff. It's very rare we hire externally market makers from competitions until recently. And I think having stronger contracts is definitely important, because at the end of the day, what's the point in us training people to go and trade elsewhere? On gasoline now I have, 2 or 3, actually every gasoline trader out there has worked under me. And I'm like, I've trained, not every gasoline trader, but trader in the market making angle has been one of our juniors. So, why train these people to go and compete with us? You have to be brutal on the contracts, and we've tightened our contracts as well. And it has to be fair as well.
But that's what the legal case taught us. We didn't think these things would hold up.
Yeah.
And then it turns out they do. Right? A 1-year non-compete can hold up. And then I think the way we've managed that is to be fair, like you say, and say, look, think of this like a footballer's contract, right? You're here for us for an extended period of time, and you get paid for that. It's not like we're going to say you're out in the ether not getting paid, which is kind of where it was going a little bit with other contracts from competitors. So, stick to a period of time where we get to invest in you, you get to invest in us, and we go from there. It can't be any other way. And this isn't exactly new, right? This is every company that has a growth trajectory starts to eventually think this way, right?
Yeah, I think even, the trading houses, I think it's quite public. Even Traffic Euro recently increased their non-competes from
3 to 6,
6 months to a year, or 3 months to 6 months. And again, when we had ex-board members, they always mentioned you have to be careful, places like, other trading houses are constantly looking for good paper traders, and you guys are training the best. And if you don't have good contracts in place, they're just going to poach your people, which is kind of what happened.
But key is in market makers being integrated into trade houses a little bit. That's becoming a bit of a theme, which 10 years ago they would have laughed, right?
Yeah.
You guys don't know what you're doing, like we're the way to get trained. And now it's like exactly as you say, the market is becoming more paper driven, financial market driven. They're definitely starting to see how they integrate that. But there's no substitute for, if you are a market maker, you want to be in a market making shop. It's very difficult to be in like a hedge fund, for example, and then suddenly try and make these outsized returns from chopping in and out. And the same thing in a trade house. It's just different models, different mentalities, which leads me to say, you've already mentioned it, but this whole building with people you want to be here and who also want to be here, and getting those right people has been a challenge at times. But I feel now you get a sense, there's a lot of camaraderie, which is, I really, really love that. That's one of my favorite things in life, is to have camaraderie and people you go to war with. And I do feel like we've achieved that. Maybe not finally is the wrong word, but with dips from very big highs, you get to see who people really are. And we've had to let go of people. We've also had people leave us. And it's one of those things where it's very nice to see that what we've got left is people who, you look to your left, look to your right, and they genuinely are here to fight, which I think is the biggest win out of all this. But
I agree. I think we've touch wood, we haven't had anyone who's been with us for a while and grown with us as a family ever leave, right? We've let go of a few people, mutually or non-mutually, but everyone who's kind of been a part of the journey for more than 3-4 years, are still embedded, and they've still fought for us, and they put their bodies on the line, right? Jasper is a good example, who's taking a bit of time off, and hopefully will be with us in a different role. Maybe not trading, but more, because again, we've given him a lot, he's given us a lot, and it'll be awesome. We continue the journey together.
Agreed. Yeah.
But a lot of these people have put their body on the line, and sacrificed a lot for us, and we've sacrificed a lot for them as well. So,
but that's what I mean about coming together when the dust has settled to some extent, or even if it hasn't, and knowing that what people are enjoying is being together. That's a win.
Yeah. So it's a great culture. And you're starting to get a few of the next generation of those people coming through as well now. The likes of Toddies, Albans, kind of the next gen of like loyalists are kind of driving through as well, and it's been a while.
It's very interesting to see that integration of the new generation.
Yeah.
It's never really any different, really. Like they remind me of us when we were like 10 years ago. They all just very hungry, aspiring traders. But again, it's the guys I think we have. They want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. It's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business.
Yeah, and I think this year has been a great gelling process. And also we've in terms of desks that haven't worked out, right? We had a power and gas Zug desk which didn't work out.
Yeah.
Whereas we have other power and gas desks that are doing well. We had the systematic book which was run by someone else as well, that didn't work out. And you have to make, and we had cross barrel, we had 3 desks that probably lost 10 million each in the last year or two, which is, and we've kind of, you have to eventually stop those,
and treat them like investments, build investments, whatever. Yeah.
Eventually you have to draw the line. And again, why I feel so good is I feel like now everyone we have has great track records. They haven't had a losing year. Not ever, but generally they haven't had losing years. Steady P&L. So I feel like the team is kind of spot on, and we're constantly looking for new personnel as well. Humayun was a recent addition who's doing quite well. Liege is constantly looking to hire, and Axis has settled in very nicely. And I guess our next one is to see how the US guys settle, right? We have Billy, then we have Scott who trades.
I've been amazed to see the talent out there already. Maybe not surprised, but just it's really cool to see how many people are out there when you start opening up your doors. They're like, we've heard about you guys, you want to get involved. It's exciting. I can't wait to get stuck.
And I think it'll just open up. There's a lot of people there who want to do EBOB and don't know how to do EBOB, right? It just gives you a gateway into clientele there who might have wanted to do something but didn't do it. I think it's quite exciting. That's kind of our next integration project.
And again, I think probably the final thing would be, we've definitely focused on oil always. And we've ridden these waves of pessimism about the industry, low prices, super high prices, renewables, all the kind of thing. But I think we very much take the stance that oil is going to be around for a long time, and particularly the Eastern markets are starting to develop. They're starting to want access to this market, and that's kind of where we're going with the Access model, Access model, not Axis model, and that's going to be really interesting to see. But having said all that, power and gas is actually pretty much where oil was probably 10, 15 years ago. And that's quite exciting for us too, right? And we will be there. We're just taking it steady, right? There's no point just jumping in and becoming we've
got Vinay out there trading some. We have John here, so we've already made in
and the US, right? There's going to be a lot to do, and it will bolt on nicely. And I guess the one thing I want us to keep doing is anytime there's an investment, it's how does it integrate into what we've built, not just another investment that might make money. That's a business of businesses, right, or a fund of funds. I've never really liked that model. It's very it's too siloed. I like the idea of, if we go into power and gas, like we have Stuart out in Zug still, right? He's an excellent gas analyst, and Octavio with him. And that's the right thing to do, is to maintain intelligence, even though you're not too big in power and gas yet, but you want to really understand it as best you can, and you build that way and make sure they're still interacting with the old team. And yes, there's not always going to be synergies, but they've got to feel the concept of what we've built so we can build it steadily in power and gas.
Yeah.
I'm excited to do that.
And we've got Akshay as well, who's now recently moved to set up US Power as well, if I'm not mistaken. So yeah, I think that's gonna see a lot of growth in the next year to 2 years, because you know, oil we've kind of grown and not saturated, but we're pretty good at what we do.
Yeah.
And now we have access, who are pretty good at what they do. So they have a bit more growth and they have a few more gaps to fill. Again, you know, we help them with it, but they're a independent entity, but we of course help with hiring and management and strategy as well if they need it. But apart from that, I think for the company, the big push going forward is into the US, power, gas, you know, carbon, that whole space. You know, certain parts of it is about 20 years before oil as well. So I think that can be very interesting in terms of opportunities. Because again, you know, when we started oil 10, 15 years ago, there weren't many players doing what we were doing. You know, the market was so inefficient. And if you look back 25 years ago, when Alf and all the bank traders were doing it, it was, you know, even less efficient, right? So if you can find some of these markets to get into, the opportunities are...
Ride that development wave.
Yeah, abundant, right?
Yeah. Cool. Well, thanks so much. We'll be back to do this again, I'm sure, in the next year or something like that.
All right. Thank you.
So there's a difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of like stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. Like that's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, you know, good win-loss. When you win more than what you lose. I mean, you know, when you have good metrics, by all means maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money, let me go and buy some flat price.
Bakary, thanks for doing this. I know you hate this kind of stuff, but
Very uncomfortable, but gonna have to deal with it.
We'll just start with a quick fire round. You know, probably quite a lot of people do know you in the Dubai market. That's where you trade. That's where you traded for about 10 years now. But you know, as it is with the industry, like there's all these niches, right? So summarizing it, your career been how long in oil trading?
Since 2015, end of 2015, so that takes us right about the 10-year mark.
Yeah, and always been Dubai crude really in oil.
So when I started off, I did the usual kind of rotations.
Yeah.
It took me a bit to find my niche.
Mhm.
So I traded a little bit of fuel, a little bit of brief period in naphtha, distillates, but I always kind of found my way back to Dubai.
You started with me, right?
Yeah.
Yeah, it's good
Yeah.
times. And you always used to get shit for not marking your curve at the back. It was just not really your style. Chimming in and out.
Don't need it.
So I guess before we get into like more the detail, just summarizing, like how would you, and I know this has evolved, but if you had to very quickly summarize your trading philosophy.
So in terms of how I trade, so I trade, especially now, predominantly systematically.
Mhm.
So all of my trading is very process-based. That wasn't always the case. Let's say 10 years ago, 5 years ago, there was a lot more room for discretionary trading in the market, for day trading in general. As the market has evolved, I've also kind of moved a little bit towards slightly longer term, more signal-based trading. So I'd probably say I trade medium term momentum with a variety of signals based on flows. So, you know, just understanding why and how people trade to hedge different kinds of risk, different kinds of books, and that helps me, kind of guides me through the ebb and flow of the market on a day-to-day basis.
So very much trading as a trader rather than like, you know, always been about oil and oil specifics. You were at JP Morgan before, right?
Yes, so I started my career at JP Morgan, actually with their credit trading team in London. So I did that for 3 years. That was my first job.
Mm-hmm.
And then eventually moved on. So that was very much a classic bank derivatives market making role. Yeah, and then 3 years later I moved on to Mandara.
Cool. So first, when did you first realize you want to be a trader?
Well, at university, I was doing my bachelor's in economics and management. Mm-hmm. So I was remotely interested in understanding economies and businesses. Mm-hmm. I've always liked playing games, video games, board games, anything like that. So in my mind back then, the job that would combine those three things seemed to be trading.
Grad scheme thing.
Yeah, so the process back then, the if you wanted to go into trading, you applied to internships, the summer internships. So I did that, applied everywhere, got into JP, did that in the summer of my second year, got the offer to come back after I graduated for the full-time grad scheme. And yeah, that was the start really.
Okay, so favorite trading book?
Ooh. Probably the one that had the most impact is a book called Mastering the Trade by this guy called John Carter, I think.
Got it over
John
there.
Carter.
Yeah.
Do you have it?
I think so.
Yeah,
Yeah.
it's a very good book. I really like it.
Quite niche, industry specific.
It's got nothing to do with oil. It was.
Sorry, what did I say? Trading industry.
Yeah, for sure. I mean, the reason why is some of the ways in which it talks about coming up with trading strategies, I learned from that. Even though it's completely about, I think the guy mainly traded S&Ps and things like that. And none of the strategies that he used are even remotely applicable to oil. The method, the way that he thought about coming up with strategies was very useful.
And so where are you most at home? And like which asset class are you most at home in? From like analyzing, feeling like you know what's going on?
I really like oil. To be honest, my time at credit, frankly, I didn't really understand much there. But oil is a lot
more tangible.
A lot more tangible, and I feel like I get the market a lot more.
Okay. Favorite trading film?
I don't even know about films. What's the series that came out? Internship?
Industry? Yeah.
Industry. Yeah.
Did you watch that?
I did watch it. I think honestly, in terms of describing and portraying the grad scheme, the internship kind of vibes, it's quite accurate.
Okay.
Apart from all the rowdy stuff.
Yeah. You sure? Okay.
At least I didn't do it.
Yeah. What's your most memorable market event that you've had, been a part of?
Oh, it has to be the start of probably the Russian-Ukrainian war.
Really? Okay. So kind of later on.
COVID before that, but I'd say they were, well, maybe COVID just because apart from the market moves, there was also infrastructural change. We all moved to working from home, and one of those two. Yeah.
And if you weren't a trader, what do you think you'd do?
I don't know. It's a very tough question.
I guess economics something still, right? So you enjoyed that.
I don't know. I think probably. It's hard to say because I like it would have to be something a bit more dynamic. Like
wrestling?
Who knows?
Because you're a passionate wrestler from my memory back in the day.
I trained jiu-jitsu.
Was it? No, but when we first at Mandara, you were into wrestling, though.
I did, yes, but now
we had
I
a few spars on the trading floor, if you remember.
Yeah. Maybe, who knows? I think I'm a bit too old.
And if you're aware of any nicknames, or what would you, if there was a trader nickname, do you know what it would be? No idea, right? The Stoic, something like that. Okay, so just last one. So if it was day trading or swing trading, what would you consider yourself?
Swing trading.
Swing trading, yeah, great. Thank you. All right, cool. So, yeah, I'd like to get more into, as you said, the JP Morgan credit time. And I think it's come up in conversations with us quite a lot. And I think for people listening, everyone has their different starts in oil. And I think it's kind of unusual, actually, given how niche this industry is, for people to come from the outside into oil. I think that's actually more of a rarity than a standard process. But do you think that macro element, it sounds like you say you're really into oil, but did that still guide your thinking as you entered, and still to this day you feel like you have to have a good grasp of the macroeconomics to guide yourself in oil?
So at first, yes, but that was a very incorrect way of thinking. Okay. I thought I had in terms of my grasp of macro was completely useless. Okay. So I think the time at JP Morgan was very good at teaching you, first of all, the basics of derivatives trading, the different types of products, more importantly, the concept of taking risk, warehousing it, and managing it. Because when you work there, or in fact for any big investment bank as a market maker, you're constantly showing prices. You're constantly having to make markets for your clients. You can't just one day say, oh, I don't understand what's going on. I'm just going to take it easy today and get my bearings, which is actually a luxury that I have now. So that teaches you a lot, and it's a lot of very painful lessons that you learn. But if you're able to think about and to analyze how how your decision making takes place in those different difficult moments, then there's a lot of learnings you can have. So for me, it's mainly the benefits came from understanding how to manage risk, how not to manage risk, the overall workflow, like the business of trading, the broader business of trading. You can learn a lot as well from that environment. It's a very good school.
I was going to say that. I mean, your learnings are really interesting, and we've actually talked, what we're trying to do at Onyx and what we were doing at Mandara before that, and what JP Morgan were doing. It does guide your trading, isn't it? Because like you're saying, when you were in the seat at JP Morgan, I guess the decision from management or what you were there to do was facilitate the franchise. That was the highest priority, right? And kind of money making was almost second.
If you were taking down all the flow and you weren't necessarily making a whole lot of money, as a junior guy for sure you'd be probably a superstar. Of course, the more senior you got, you also have to make money as well. But the way you would do that is through market making.
Yeah, and then pivoted to Mandara and even Onyx, as you say now. It's like you're right. It's that luxury of saying, actually, we're kind of proprietary traders. We can go to trade and pick what we want to do. It found its way to being a market-making operation, because that's where a lot of our trading and our risk profile was, until it became like a skill set and a franchise move to be doing that day in, day out, which is very much what you had the ultimate hold on in Dubai crude, because it's one curve, it's very difficult to market make. I did it myself for a long time, was figuring out after costs, I'm literally like break even here, it's a pain. And so to figure out how to reliably provide liquidity whilst also making money is actually a very difficult thing to do. And the evolution of that market has become like, well, actually, there's no real market making, or market making or providing liquidity is a different thing now. It's like you're there to take risk OTC if needed, but chopping in and out is a screen-based thing now, right?
Very much so. And I mean, the funny thing is, when I was at JP, I hated market making. So
Okay.
in fact, that was, for me, my biggest challenge of my time at JP was the fact that I hated market making. It was completely foreign to my personality because I was, like back then, I was quite introverted. To some extent, I am still today, but I can manage it better now. But as a market maker, there's a lot of different stakeholders that you have to build relationships with, you have to manage. It's always noisy, it's chaotic. You can't just sit down.
I'm slightly laughing because I remember, like, I don't know, like 6 months in, you were a bit of a character, right? Yeah, I know you're introverted, but you're also like confident, right? And we do still a lot of pit trading. So
Yes.
just games like betting on IMDb ratings or whatever it was. And we were just encouraged to get in a room and just train, I guess. And then you were very much like, I'm going to make a market. I'm here at here. And I remember everyone tried to buy you and you were just like, so to everyone. Do you remember that?
Yes,
It's
yes.
hilarious. Like,
But that's, I mean, the games is one side when you're actually doing it. Like, I didn't like it so much that I convinced myself by kind of the second year that I'm never going to do market making. But the funny thing is, when I started trading Dubai at Mandara, I almost built like a market making business voluntarily. So I think
because you could see there was an edge in it, essentially.
because there was a demand for it, but largely because you could find a process and a methodology to run risk, but then you could trade that risk, those positions around as a market maker. Now, market making there wasn't the same thing. You weren't constantly showing two ways or anything. You were just providing and taking liquidity at different points in time when that was required. You weren't constantly on the market, showing two ways.
That's a big thing for us as well, isn't it? It's like, can you show me a two-way? And I always used to hate that question. Like, no, I'll show you, like, if I can counter. These days, and again,
That's the norm.
That's the norm, yeah. Show me a two-way. Okay, fine, here it is.
That's how it used to be, like, that's a very classic question when you're a trader at a bank as well. And you have to, you then have to guess, okay, what are they going to do? Skew the market based on that, skew the market based on what your own position is and what you want to do.
Where you're comfortable, yeah.
It becomes a slightly different. But the problem is, when you're doing that all day long, you don't really have that much time or space to zoom out and to think about, well, what is the market actually doing? Which position do I actually want to have? You're stuck in that loop of taking risk off the back of what you see is going on, which is fine depending on which market you're trading. But a lot of the time, you really need that space to zoom out and to build your trading strategies, to build how you want to actually run risk. If there was no market, if you didn't know who's doing what do you want to do? That was quite hard.
That's a great segue into my next question, which is 2024 and certainly 2025, I think unilaterally has been considered difficult trading conditions. Yet you've had a good year and you've never really had a bad year, let's be honest, but it's one of those things where the numbers would probably make it seem like you've got some like system going on and you're just like, yeah. But there's a lot of iterations and evolutions, more importantly. And I think that must come into your philosophy and approach to trading, right? Always be reinventing, or at least trying to have a kind of anti-fragile approach to trading, which kind of comes back to the first bit that you just said. It's like, what do you want to do? And if you can't start there, then you're at the mercy of the market, really, of which there are a lot of traders who are essentially at the mercy of the market beta or the market paying the bid offer or whatever, right?
Very much so. I mean, you're right, because And that's the most difficult part. You know, the market will, in my memory, for however long I've been trading Dubai, it changes at least once a year, maybe several times a year, the whole paradigm of what's driving the market, even how the market trades. I'm not talking about things where how the screen has become dominant and all those new algorithms that are running on the screen. That's a whole separate discussion. But the market will always change with varying frequency, and while my core methodology of trading hasn't changed, I've had to constantly reshape it and adapt it to the new market. And you absolutely have to, because otherwise you'll be left behind.
So are you thinking ahead for that, or are you just looking at maximizing what you have at the time, and when it stops working, you kind of start again?
Yeah, I'd love to be able to think ahead, but I can't. So when what I have is working, I try to maximize that, and then you inevitably hit a rough patch. And that's always a very tricky part, because let's say you have a set of strategies, and in the back test, they perform, but they will inevitably have, they don't always make money, right? They're going to make money, there's going to be a period where they lose money or they plateau, and you're going to have some sort of hopefully positive equity curve with a bit of volatility. It's always hard to know whether your rough patch now is within the normal parameters of the system, or your strategies are becoming obsolete. So usually, you know, there's something that you expect within the backtest. When you're approaching the limits to that, that's when you start thinking, okay, are we in a changing paradigm? Do we need to start kind of thinking about how to change this? It's always very tricky, but generally I will typically hit a patch where, okay, it's just not going right. Maybe I'm not losing money, but I'm plateauing. And then you have to then make a conscious decision. Okay, does that mean the way I think about the market is no longer valid? If so, let's iterate, let's think what we can change.
What's really interesting there for me, again, is the kind of general, I think, way people trade and apply themselves versus the way I think you do it quite differently is you are looking at your system, your, what do you call them, the parameters first, and you're saying, this is my VARs, my drawdown, this is what I think the market can give me with these strategies, and that's where I'm going to maximize. You're not one of those traders that goes, well, if I can make 5, I can make 50, I can make 500. If you don't mind saying, you've been approached by the bigger firms who've said, you know, come and like scale, you know, how can you make, I don't know, 100 million? And you're like, well, that's actually changing everything. That changes everything I do, and, you know?
Yeah, because there is some scalability, well, there is a scalability of any okay. The more short-term a strategy is, the harder it is to scale it, because it depends on faster movements. The longer term your strategy is, the more scalable it should, in theory, become, but also the more P&L volatility you have to be prepared to warehouse. So there's always that trade-off. So yes, if somebody tells me, okay, can you 10 up your risk now? Sure, but that's going to bring about more problems with getting in and out of positions. That's going to, in fact, probably I don't think I can 10x the position. I could probably triple it. Beyond that, the metrics start, well, even by then, the metrics probably start to deteriorate. But there's always that sweet spot, that balance, where it's not just saying, oh, I'm going to, you know, increase the size. No, your metrics are going to deteriorate.
Well, I think that's where you deserve credit, because basically you haven't allowed yourself to get away with it and run away with it. Like, again, you said COVID and 22 to 23 kind of time, great market conditions in the sense of a lot of beta and market moves, and generally people were making money. And we've seen it ourselves in our own trading floor. Sometimes that allows people to believe that they've got this limitless approach to them. They're not really factoring in the what do you call it, the restrictions that the market might give you down the line. So I think your ability to not get too high with the highs is something you deserve credit for. But I think also that is kind of unusual, because you're, I don't know, mid-30s, whatever. You're not that new to it, but at the same time, it's not like you've been decades and decades and you've always been like this. So I think there's an element of natural maturity there. But is that something you think you've consciously, is that something that's in your personality to be like, well, look, let's not get too ahead of ourselves. There could be downtime, there could be bad times around the corner type thing.
To some extent. I also, the way that I look at trading is not, it's very, very remote from gambling. So for me, the way I look at trading is, like, I'm not sure if a game is the right word for that. More like there's a business and you're executing your business plan. And in your business plan, what is it? It's your trading strategies. It's the risk framework around that. I don't then all of a sudden go and put on random discretion. I might, if there's a good opportunity, I might put a discretionary trade on with the right risk controls over it. But generally, the work I do is in building the strategies, and then it's fairly easy. I just execute them. So if the parameters of the strategy dictate a certain optimal size, then that's what I trade. Now, it would be amazing to come up with strategies that allow you to put on bigger size, maybe move out a little bit towards the longer end of your horizon that you hold a position for. It would be amazing. But it's also not so easy to do. So you're constantly trying to come up with things that would allow you to do that. So my restriction is not in saying, oh, I restrict myself. It's more that you trade what you've come up with, what you've backtested, what makes sense, and you trade it in the optimal size. Hopefully you come up with something that allows you to scale up, maybe another strategy. If you could do that, great, amazing. But if you can't, that doesn't mean that you should say, oh, I really want to make, some big numbers. Let me just push my current strategy beyond the optimal size, hoping that it makes more money, because that doesn't make sense from a business standpoint.
You're seeing yourself as a business. And ultimately, if you were to, okay, why haven't you been as tempted, or have you been tempted to try and join some of these firms, I guess, with huge risk appetite, wanting to see you make 200-300 million? Or has it just been something that
you can do if there is an appropriate strategy? So,
but if someone forced you to, look, mate, I just don't care what happens, I want you to try and make that money, you would then say, look, that's gambling.
I think at this stage, maybe at that point I would start thinking, who knows where the creative process takes you. Maybe there would be strategies that would pop into my mind. I don't know what would happen. But as of right now, I'd probably say, yeah, sure, of course I can try, but we're going beyond kind of strategic trading. We're going towards the realm of gambling.
Which doesn't really interest you?
No. I don't view trading that way.
And is that, what I'm trying to get at is that you're saying it's very logical, but you gotta admit, like, there's a lot of people who fall foul to the ego side of things, which you haven't. So what is going on there? Is that something consciously you've been aware of, or?
Yes, I mean, to be honest, I'll give you an example. When I started off, I wasn't like this. When I started off, probably during my time at JP Morgan, I was constantly falling to. Look, a simple thing would be you're getting hit or lifted in something, and then you run that position because you're hoping it goes in your favor. Without any rationale, without any real reason, you don't take a step back to think, okay, but do we actually want that position? What is your actual kind of view? Is the trade that you've just been lifted in something, do you want to be short there or not? Do you want to be short in general? Do you want to be short at that price over a short time horizon? None of that thinking would be there. It would just be, I got lifted, let's try and buy it back a little bit lower. And then, of course, it proceeds to go above, and you're sat there thinking, well, this market making is not for me. I hate it. I'm an amazing trader, but the market making is terrible. Whereas, in fact, you're a terrible trader, right? You're just.
But in that example, if it was taken now, and someone was like, "Look, I just need you to fill me in something like 5,000 or something big," and you didn't want to sell, but you needed to show an offer, you would still take a positive expected value approach to that, right?
No, now it's different. Now I will show you, like, okay, but probably 5 years later, 5 to 6 years later after that. No, I will show you a price on whatever you want, and it will be the right, in my mind, the right price. So there will always be a correct price for your volume. It might not be the price you like, but it's a price that I like and I'm comfortable with.
Yeah, but that's interesting, isn't it? Because like you're saying, do I want this risk? Essentially, no. But is there a price that actually this gets into realms of is acceptable?
Yes.
But then if you lose money on that, what do you are you thinking? If I get left on this, these are my outs, these are my hedges, this is my potential drawdown.
Exactly. So you transact at a price that there has to be a reason why you think that's a valid price. It's not just that you take a price out of the sky. So you must think, okay, if I can't get it, I mean, if it's a huge deal, you're not going to be able to get out straight away. You must believe that if you warehouse that deal, there's a way that you can hedge that in some proxy way until an offsetting risk presents itself that you can de-risk.
But in a scenario where you're quite keen to be long, let's just say, and you're forced to be short quite a bit of size, is there just a scenario where you say, look, I just don't want to do it? And that is the ultimate fail-safe.
So for me right now, yeah, of course, all the time.
Yeah.
Back then,
no.
Not really.
Okay.
Because when you have clients rather than counterparties, you do have an obligation to provide a price.
But then what about the obligation you have to your business, which is I want to be the guy people go to so I can get those trades. Sometimes it might not work out, but I want someone to make the call.
So the obligation to your business is to be long-term profitable for the business. Being the guy that people come to is part of long-term profitability, but if it comes at the expense of you pissing away money here and there and not being able to recover it meaningfully in any way, then I think you are not working in favor of your business. So you have to be a little bit thoughtful here. Everyone will, at any point in time, there's 10 guys lined up willing to trade something super tight just to get the deal. That's not really what this is about, right? If you have a process how you're able to quote, tight prices, that's separate. But a lot of the time you will have people who will come in and they just want to get the deal done. Okay, great. How long are you going to be able to do that? Right? So I've done this for a little bit and I've seen people come and go. And the process repeats itself. So you need to think long-term, or you need to be long-term profitable. If you are in the realm of liquidity provision, you need to probably be a type of counterparty that is long-term reliable for either sizable liquidity or liquidity when things are difficult. Because when times are easy, again, there's going to be a lot of people prepared to offer liquidity. When times get tough, that's not the case. That's where you can provide value to the market by showing thoughtful prices and right prices. That's how I would think about it.
Makes a lot of sense. So what do you think, getting on like the lessons learned, when you have a particularly hard time, do you find enjoyment in basically reflecting and saying, okay, there's something for me to calibrate, or do you allow kind of a bit of, do you ever get into that fear thinking of like, is this all never going to work again? Or is there an underlying confidence that you'll find something always? Or do you ever struggle with these kind of things?
Always.
Okay.
Like, I'm not a fan of this like fashionable, I love being challenged. I hate being challenged. What am I, a masochist? No. Like, I want life to be easy. Okay. So, yes, it's always hard when you, as we mentioned before, when you are in that tricky period where you're either drawing or you've not been making money for a while, and you're thinking, what does that mean? Does that mean my system was wrong, or does that mean we're still within the acceptable parameters? That can become quite tough, because you always have these thoughts. Okay, well, that's it then. This is finished. But you have to. If you need to take a step back, whether that means take a few days off or just go on holiday to clear your mind, come back, maybe look at things from fresh, do that. If you need to stop trading, go read a book, go just do something that maybe shifts your perspective, go do that. But there has to be a way for you to maybe like find inspiration to find a way out.
But you have an underlying confidence that in bleak uncertainty there will be something that reveals itself at some point.
I think confidence is I think confidence comes from doing something over and over. So luckily, I'm happy that I've been able to do it every year for a number of years. Maybe next year, maybe in 5 years, I won't be able to do that anymore. But for now, I've done it a number of years, 7, 10 years, and so far it has worked.
But if you wanted an easy life, you could have done easier things.
No, but this is an easy thing. This is a very, you mean other jobs?
Well, you said I don't like to be challenged, whatever, but you've taken, like, the Dubai curve is horrible. Like,
yes.
No one ever wanted to trade that. Like, being a crude market maker, which has obviously always been my thing, you just like, that market is shit. Like, why would you want that challenge? But you took it on, right?
True. I think the reasoning there was because everything else was already taken. And I'm like, okay, I want to trade
but you
something.
got to go on gasoline and things like
Yeah,
that.
but then there were guys already in line.
Okay.
And I was like, I want to trade something on my own.
Okay.
The only thing is, Dubai was never even a separate desk.
Yeah.
So I went and said, okay, this little curve, split it for me. I'm going to trade it.
Yeah.
Okay, that's interesting, but that's a slightly, it's not really a challenge when you have nothing and you're starting from zero.
But I think what you're saying, aren't you, is that if you're talking about your values, you do value independence then quite highly.
Yes.
Yeah. So that supersedes your want to have an easy life, right?
Yes, my best time, again, and for instance, if I compare my time at a bank versus at a proprietary trading company, it's like night and day. At a bank, you are part of a team. There's structures. You have to deal with salespeople, with your MD, with your immediate boss, with different other traders, and you have to do stuff. Whereas in a prop trading company, you don't.
No.
They give you that leeway to breathe and to find your niche.
Yeah, I don't know. I mean, again, I think there's things that sometimes work against, and obviously everyone has this, like you want this, but then that, and you kind of have to compromise to the position where you're comfortable with what you have.
Sure.
Because I would say, from what you're saying, you're independent and you want to be left alone, and to some degree that's true, but you've always trained traders. You've probably got one of the best training records, and you must have some enjoyment from that.
Yeah, that doesn't bother me though, because if I had to, what would bother me is if I was, so I'll give you an example. In the however many years I've been here, since 22, like over 3 years, you've never once come to me and said, oh, what's this risk on the book you got? Neither you nor Omar. I do what I do. No one's ever even asked me a question. Right? That approach. Now, again, you must have your reasons for that. There must be some kind of reason for that. But that's more what I'm talking about. I'm not against, training people or collaborating, sharing knowledge. That's slightly different. It's more about I am responsible for my own performance, and I like that to be the case.
Well, I guess I was just trying to take it. There's another part of this, which is, I think you do like to be part of a team as well, right? And you do like to train, and there's something in your career you've valued as well.
Yes, but I like to be responsible for my own performance.
Yeah.
That's the thing. I don't like to be in a situation where my performance also depends on someone else in part.
And in turn, that means, of course, you believe in the meritocracy angle, right? I mean, there's probably infuriating for people like yourself, which I don't think there's that many on a percentage basis, but who then get treated like they're in some pool. It's like, you get the benefits of being independent as well as the downsides. So when you suddenly change that and say, oh, we're going to rope you in with this collective thing, it's like, but then that's not how that's not the deal I signed up to. And I imagine that's something that has been important here and probably your previous place as well, and then maybe other places couldn't offer, and it's something we maybe need to, certainly I love working with those people, and it's just, I'm kind of talking out loud because I want to protect that mindset, because the alternative is you get born into a franchise and you have to really believe in the franchise first and whatever else, but you're kind of taking handouts.
No, but there are some areas of the business that do require a team approach, right? So that's a little bit different. But you also, if you're going to be going into that area, you need to almost have the mindset where you're happy with that, right? Like obviously you take like a very introverted kind of secluded person, you drop them in there, that might be a bit problematic.
Yeah.
But it depends. Like for a trader, you could do fine on your own, unless, again, you're in such an operation that really requires a multiple, many people on the team to be able to push the operation forward. So it really depends what kind of business you're in.
So I think moving now to more specifics in oil trading, I guess something that I think you must have mentioned to me before in the past is we've been part of this evolution of the market moving from a very physical dominated mentality to more flow driven financial, and that only seems to be going one way, and it's pivoted from us being kind of bit part players to very much in the mix of what's driving prices. But I guess because you've gone from that journey, you did need to, and I guess you still respect the physical pricing and what people are capable of doing, but you've never had the physical. So that is a weird dichotomy, isn't it? So how would you explain why that's been comfortable? I think that's surprising to people, by the way. How can you guys be proprietary trading, especially in the spot market of Dubai crude? Like, there's so much going on there that requires inside information, flow information that, well, people would think that, but clearly you've been able to get information more second, even third hand, and still been able to filter it into your derivative trading strategy and make it work, which I think is surprising to people.
I think it's almost like there's different games being played. So what players who have access to physical, the game they play is wildly different from what you would do as a derivatives only player, right? So if you have access to physical, that access, your ability to market barrels and to buy and sell barrels gives you information. It gives you real information on supply demand for any given cycle, not just supply demand balances. Okay, it gives you real information. It allows you to take paper positions that you can then, you leverage your physical capabilities to make something work. Okay, that's something that we can't do. And that's not really a game that a derivatives only place can ever play. Sure, you can put different pieces of the puzzle together and you can figure out, okay, most likely this is what is going on, so we can position. You can do that, yes. But again, your ability to manage that will be limited because most of those things tend to happen, for instance, as we know, in some of the very prompt contracts. And the liquidity there, if you look at BAML, is not going to be, if you're wrong, unlike a physical shop, you won't be able to get out. So you need to be careful about the risk reward there. That, however, you have the whole rest of the curve, which is, yes, when it becomes prompt, becomes set by physical, but there's a lot of time until then. And so that's where I have personally focused my efforts, right? So there's a niche kind of medium-term horizon where there isn't that much competition. Well, people express views there, but there's not that much competition in the sense of somebody doing a trade does not prevent me from doing that trade. Whereas if you're trading the front, it does.
So you're almost trying to take the benefits of what physical pricing can do to the derivative market whilst not being too invested in it and herd trading it, whilst also doing exactly the same with the derivative market. Or
sometimes, the other parts of the curve can be disconnected from physical, and they can be driven by their own
but that's what I'm saying, you're trying to take the best of both worlds.
Yes, you try. I mean, really, you try and take whatever comes your way, but you try to be mindful of where your real edge is.
So how much do you think about the actual players that you're trading against? Do you worry about their psychology, think about their psychology, or you try and stay away from that?
Back in the day, so probably 2018 until probably 2024, that used to be quite important. The reason is simply to understand, so look, let's say I trade quite systematically now, so I barely even day trade. Back then it was different because even if you were a systematic trader, first of all, liquidity wasn't so granular that you could meaningfully test strategies against, or let's say you get a signal, does it mean you can get in at that price or not? So back then you had to work intraday quite significantly to be able to just get in and out of positions. And if you are going to trade intraday, you have to understand who is doing what to get a good picture of the different liquidity pockets. If you are a buyer, What do? Do you go and start lifting offers? Well, then you're going to push the market away, by 20 cents by the time you're done. But you might know that there's a particular counterparty that comes in the afternoon to do a hedge. And you're going to wait until they do, and when they do, you're going to trade with them at value. And that way, you're going to execute into the position that you want, that you had a signal on, I don't know, in the morning. That's why it was very important. Now, the dynamic of the market has changed to the extent, well, there's a lot more going on the screen. You still need, in a healthy market, to be clued up and to be aware of what's going on OTC, because more often than not, people execute large orders OTC, right? So you still need to know that. But I think it's much less so now.
Well, that was my next question. So yeah, Dubai is overnight almost, seemingly. Sometimes you think like it's very screen driven, but you still have a broker market, you still have OTC trading. And a lot of these guys are playing the screen versus the OTC, and there's always that element to it. So the next couple years, not even that far out, is it going to, well, how do you see it playing out, the dynamics?
I think probably, look, the trend, it's an interesting question. So a little while ago, we probably always thought that everything would eventually go to the screen, much like Brent futures did back in the day when they moved from the floor to the electronic trading. But electronic trading also has some downsides. When you start, electronic trading makes the market a lot faster and more volatile, and we've seen that. If you have people making markets in an algorithmic way, if you have a lot of high-frequency traders, for instance, making markets on the screen, any move can get augmented, and moves in one direction or another can cascade without a whole lot of trading happening in between.
And make you think something's going on. And
it might make you think whatever, but the market, without much going on, the market can gap around a lot. You have our own version of the flash crash or something like this, and that now happens fairly frequently. At some point, and I mean you have this probably if you look at equities, right, which were electronic for a while. You do have things like the emergence of or increasing popularization of dark pools, where people are like, well, hang on a second, I want to get a big block done, so I'm going to go into this dark pool and I'm going to try to get it done quietly if possible. I don't know whether at some point people will get tired of the increasing volatility, and they might say, well, okay, that's fine for small size or whatever, but if we want to actually execute big size with reducing the footprint, or actually, with getting a meaningful price, maybe you'll see a move back to some sort of hybrid model where some of the bigger tickets are executed still direct or through.
But I think that is still. I mean, we were hiring a trader in the US who all his trading is block futures. There's still a big enough OTC market.
While there is a screen?
It's the Brent futures, it's RBOB and all that. Right. And it's exactly what you're saying. It's like, rather than be part of that noise, I'm going to get a reliable person who could be roundabout there and no footprint. And you can see the value in that, but you need to then know you can rely on that person, and I guess they make their own assumptions of that. Yeah. But I see a logic, and so I think that's, maybe something not to be afraid of, in the sense like there is a liquidity dynamic even from broker perspective that will probably retain for quite some time.
Yes, and I mean, in any case, you do need to, you can't really see the future, but you can only take it as it comes, and you have to adapt to that. So if the market is becoming more, faster, maybe you need to slow down.
Yeah.
Right? You need to slow down your own decision making, and rather than taking data at such granular levels, maybe you just look at the market on a day-to-day basis. There's many things that you can try to counteract that.
And as you get towards the kind of middle of your career, if you like, do you see yourself doing this for a lot longer, or are you getting a bit tired of certain things, or how do you see it playing out?
As long as I can retain some sort of edge, I think I enjoy the job, and I enjoy trading as an activity. I think when the time comes that I can no longer figure it out, well, then that's a different conversation.
But, you talked about this concept of having a business and not wanting to gamble, and then you've got a family now, right? So it must, how did that evolve your thinking? I guess probably pushed you even more into the sustainability side of business in trading.
Not really. In fact, the interesting thing is my breakout year was probably the year my son was born. Almost, immediately after that, whatever you call that. But I don't think about that because that can probably add a lot of pressure.
Okay.
And I think the job's it has its own stresses. You don't need to put more on
Easier
yourself.
said than done, though, no?
Yes, but you just kind of have to have this laissez-faire attitude where, look, you try to come up, you do the best you can to come up with ways to make money, to come up with edges, to come up with strategies. There's not much more you can do beyond that, so don't kind of stress yourself out. Because the more you do, the more you'll be tempted to start gambling.
Yeah.
And that's definitely not what you want to do. So.
And you obviously don't need to name names or anything like that, but you've seen that, right? You've seen the extremes of these things. On the one hand, you can get into a gambler mindset without even realizing it. I guess you've seen people do that.
Well, I've done that myself at the start,
yeah.
when I didn't have any strategy, when I didn't have any systems or processes.
And what's the polar opposite to that for people trying to get good at trading or whatever? Is an element of but you do need to want to take risk. I mean, are there people where you've seen you'll just never quite be the traders?
So there's a difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. That's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, good win-loss. When you win more than what you lose. I mean, when you have good metrics, by all means, maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money, let me go and buy some flat price. That's not really.
But someone who's struggling to get their way in, and is there an element of maybe it's just not suited to you because you can't handle the whims of trading?
I think if you are struggling, are you talking about emotionally, psychologically struggling?
Mean you've seen a lot of grads, you've seen a lot of people who probably are trader level, but they struggle. And
it depends on what they struggle with. So if they're struggling to find an edge, the cure is to keep trying to do it. If you're struggling with, you don't like taking risk, for example, usually, and you're stressed out by it or you feel anxious, usually, from my experience, the problem of that kind of anxiety comes from indecisiveness, so not knowing how to make the decision. So if you're sit there and you're thinking, okay, do I buy, do I sell? That's a problem. So to address that, you need to systematize how you make the decision to trade or not to trade, and if to trade, what to trade. And the only way how you can do that is you come up with some sort of methodology which is going to be consistent over many iterations, different market moves. It's going to, if the same set of conditions apply, you always make the same decision, right? So if you have a system, a process, which helps you make that decision, you almost eliminate any need to make decisions on a discretionary basis, right? So that will take away that stress, right? So when you follow a strategy, you don't stress out. You can lose money, but you then take a look at the backtest and you're like, okay, that's within the anticipated range of possibilities. So you don't stress out. You are going to stress out if all of a sudden you're taken outside the realm of what you thought. But then that becomes an operational question. You're like, okay, well, why is that happening? Is there a mistake? Is there a fault with the backtest? Then it becomes a question of, okay, let's work through this. But the most stressful bit is where you don't even have a process.
Yeah. You're trying to fight against.
You're just trying to, okay, let me read around, let me build a view. And then you're like, you come up with this amazing view in your mind that makes sense, and you put a trade on and the level looks great, and then it goes in your face. And you're like, okay, well, now what? The trade makes sense, my rationale. So am I wrong? Is there something I don't know? That becomes difficult to unravel, and that creates a lot of stress.
So I guess does that lead to what your main advice would be then, is try and find a system?
Yeah, and a system doesn't mean that you have to be like a very kind of quantitative I mean, look, I can't program in Python, I don't know, but a system simply means that you have rules which dictate how to interpret whatever data input you're putting into that process, and it spits out a decision. Trade or no trade? If trade, what do? Do you buy or sell? Then you have a system on your risk management, which tells you how to size the position. Imagine if you do those two things, then there's nothing left for you to decide.
So don't make it overly complicated beyond that, right?
Exactly. I mean, yeah, you can take it as complicated as you can, but usually you need to have some sort of decision-making process.
Bakri, thank you. That was great.
You're welcome. Thank you very much.
Welcome back to Trading Corner. What a few crazy months we've had. Happy to be back. I have with me a new host, Ragath. So Ragath has been in the market for a while, predominantly across the products. Do you want to just give a quick background, what you've been trading, etc.?
I mean, I've been trading products mostly for the last 13, 14 years. A lot of focus on the heavier side of the barrel, so fuel, and then to some extent lights, previously and more recently. So pretty much a products specialist, I would say.
Perfect. So great compliment to me. We haven't done this for a couple of months, and we've had some insane moves across all products.
Crazy,
to be honest.
Yeah.
Most recently, obviously, we've had this huge leg up from the news coming out about additional sanctions on Russian crudes. And we've had the knock-on effects. So we're just going to probably focus on that today.
Okay.
So reminding about a week or so, we're in a totally different environment.
Completely, yeah.
So just touching on crude initially, I think, all year we've had this chat about the markets are overextended on crude. We're going to get huge, big builds and gluts into Q1, Q2 of 26. And as we came off the back of summer, I think we didn't really see that gasoline strength we were really, we're used to seeing over the summer.
Yeah.
So that didn't help the market. We had, really a lot of supply problems for crude, locally in dated Brent. Again, that did not feed into the benchmark. So sentiment was probably at an all-time low. And then you look at the positioning contracts, like all these CTAs and the big funds, a lot of them were positioned to kind of max short.
Correct,
So
yeah.
it was a bit of a perfect storm the last week when all this news came out, right?
Yeah.
But the most interesting thing I think we saw was how the crack rolls performed. I mean, coming into maintenance anyway, the products were doing well, right?
And a little bit tighter.
Yeah, and it felt like all the weakness was in crude, to be honest.
Correct.
So as we had this position flip, a lot of shorts were covering in time spreads. There was a big short deck play on this year, I think, from a lot of the funds. So we had all of that short covering come in, TFL short covering come in, Brent to buy, you name it. The product still performed.
Correct, and I think it's because you're seeing short covering on the product side as well.
That's crazy to me.
Yeah.
Like all these spreads, the cracks, they were pretty high, right?
Correct.
And you're still seeing short covering.
Yeah, and I think it's tapered off now in the last couple of days.
Yeah.
But certainly middle of last week when initially the news came out, the market was not just positioned short crude, but also short a lot of back-end products. Essentially a similar reflection of the short crude trade.
So what? Yeah, exactly. I was just about to ask you
Yeah.
that. Why do you think that was? Was it because a lot of banks, etc., they were all coming and buying the back end flat price given where how much crude is sold off?
Correct. Yeah, and I think you're seeing end user banks on behalf of end users just coming in to buy back end flat price across all products at what we haven't seen back end flat price or even flat price in products since almost 2020 at these outright prices. So it didn't surprise me at all that there's back-end hedging coming in from the consumer side. And I think on the trade side, everyone has bought into this general surplus, which is not just on the crude side, but also giving an opportunity for traders to reflect it on the product side. So alongside all the short covering that you had in crude, I think you had equal amounts of short covering on the product side, certainly over the last 3 days, especially with the uncertainty about sanctions. But we have seen threats of sanctions in Russia time and time again over the last 2 years.
So why do you think it's different now?
I think the market's been, to be honest, to some extent desensitized over it. I think they don't necessarily believe that the surplus or the barrels that are going to come off the market, quote unquote, due to sanctions are actually going to come off the market. So there's a lot of wait and see.
Yeah. I mean, you're just talking about volumes.
Yeah.
So the news came out Wednesday evening, and immediately screen-led, albeit, but huge volumes going through on the Brent spreads, flat price. We came in the next day, and in my market, the DFLs, so much volume trading. I don't think I truly appreciated how short the market really was.
Correct. Yeah.
And everyone was buying. Don't get me wrong, there was a bit of profit taking from a couple of the trade houses. They were selling kind of NovDeck, so structure rather than outright.
Yeah.
And you know, one or two people did get very lucky. You know, the market was definitely caught by surprise.
Yeah.
And there were one or two longs who were kind of waiting in the background, and they did come in and take profit. But Thursday, huge amounts of volume. Friday, also huge volumes.
Huge volumes.
I think what happened was, Thursday, people were like, how real is this, you know, this sanction news? Is it really going to impact the physical market? Most importantly, what the hell are Reliance doing?
Correct.
That's the main thing, right? Like, are they going to sack off all this Russian
India's
oil?
the major question mark, isn't it?
They are the
Yes.
swing right now. So whether they continue taking Russian crude, and, you know, I do have a few relationships here and there with the market. Before that news came out, they definitely were still taking Russian barrels.
Yeah.
So they have to be government mandated in this
Correct.
aspect. It's totally out of their control. So I assume there have now been conversations. You know, we had the news Wednesday night, give the market 24 hours. Friday, more short covering came in. So I think there was a lot of conversations with physical desks, etc. on Thursday. And we've come in today, and for me anyway, the volumes have really dropped off.
They have.
Massively.
Certainly,
so
yeah.
it feels like the volatility has really, you know, chilled out a little bit.
And I think it will for the rest of this week until Thursday and Friday, also because we've got quite a lot of data coming out this week.
Yeah.
So we've got rate decisions, which are a fairly big macro event coming out from at the end of the week. We've got Trump scheduled to speak with Xi Jinping on Thursday, and tariffs have obviously been a massive driver of what's been going on. So
Yeah.
I think the drop in volumes is no surprise, because I think a lot of people are waiting to see what happens, whether it's out of India and if there's going to be any news coming out on whether they're actually going to drop not buy Russian barrels, which would surprise me.
Yeah.
It would surprise me.
And also the Russian barrels they currently have. What happens with those? Are they going to have to, you know, chuck them back onto the market and replace all those spot ones?
Yeah.
There's a lot like kind of at play, right? It's a very dynamic market at the minute, and it's going to be very news sensitive.
Correct.
But anyway, just let's maybe talk about what will happen if
Sure. Yeah.
if you know, all this Russian oil is
Stopped.
stopped. I mean,
if you mean if India and China stop buying Russian oil completely,
yeah. What do you reckon?
you know, that's going to be. I think we're going to have a leg up on the market, right? We're also coming out of refinery maintenance shortly,
Yeah.
right? So the weakness that 5 million barrels of capacity again coming online, potentially more crude buying. So we could move up, which is why I think you're seeing so much short covering in the market.
Yeah.
I don't know.
I think
it's a difficult one because
Yeah.
previously when we've had Russian barrels, the barrels have found a home somewhere, right? And we've had a short-term dislocation, which has created a price spike, and then the flows have rearranged, and then there's been plenty of oil coming back to the market. So I'm curious to see what you think on crude.
Yeah, let's go back 2 weeks now. All these sanctions that were hitting the Chinese ports.
Yeah.
So that was a big bearish kind of stimulus to the market because you had, for example, Unipec, etc. They had all this oil that they had to get rid of.
Yeah.
And so from the dated side, we did see a lot of selling in the front because of this. Like all of that oil has to be rerouted.
Yeah.
Now you've kind of got the opposite problem. But what will be quite interesting as well is, Russian oil is a very sour barrel.
Correct.
And so this is where the products also come in. It's most likely that will be displaced either by TI Midland, which is very light sweet,
Yeah.
or with OPEC barrels. So OPEC did come out, I think it was on Thursday, and say they do have the potential to plug that gap.
Correct.
Either way, I think TI will be displaced in a lot of different regions. I think it, with Dated or Brent where it currently is, very attractive for TI to be loading here. If India, China have to take a new barrel, it's going to be TI as well. It is the most competitively priced at the minute. So that might mean, quite a big knock-on for all these product slates that are coming out.
Yes, massively.
So we could get some, naphtha
big
versus
change in
fuel.
yeah, big change in light versus heavy margins essentially. Right.
Exactly.
Yeah.
Are we seeing any of that yet?
I mean, I think products at the moment they're actually trading on a very product specific basis, right? So just taking a step back to the positioning and change that we saw from the headlines coming last week and this almost regime shift in crude from 60 to 65. A lot of the traders that have been long product structure are, I think, letting them run, and the short covering has been where the traders have been short most, right? Which is probably fuel and naphtha, for example, right? So naphtha's moved up, aggressive short covering on naphtha spreads. Fuel has been pretty tight, and if anything, if there's fewer sour barrels on the market because of what we're talking about, then fuel could continue to see strength. It's just been, So I think products are trading at the moment quite each product specific. There's nothing, a lot of the traditional differentials that we look at, like fuel versus naphtha or gasoline versus naphtha, they're finding new regimes.
This is what happens when you have short covering.
Correct.
No one looks at what relationship's holding with what. They're
Correct.
just like, let me just cover what I need to cover.
Yeah.
Eventually, the market will kind of get back to rebalancing. It's going to force refiners to do some switching. Even the ARB movements with this huge rally in freight. It will just take time for that to start rebalancing.
Correct.
Right now, people just want flat books, right? They don't want to lose any more money. It's been a really tough year for the market.
And you have to some extent on the product side, you have to talk about gas oil because that has been a big key driver of a lot of things.
Well,
the massive part of the light margin.
Yeah.
And you've seen a massive move up in gas oil again today, and we were tight in the summer, and we're coming
seasonally, right?
Yeah, and seasonally we're coming into a, in theory, more tighter market, and we didn't see the summer bills that we were expected to see in gas oil. So gas oil could really make a big difference on the margin, and so any marginal crude barrel buying from the TI, which is, as you said, the most competitive price grade, can be absorbed, right? Because of how strong the light margin is.
How do you think people are positioned in gas oil?
I think there's a lot of length.
Yeah.
There's a lot of length, and there's been a lot of noise.
Yeah. What's quite interesting? Talking about things blowing out of ranges, etc.
Yeah.
People love contrarian trading at highs.
Yeah. I know.
So this idea of the gas to heat or the gas to whatever.
Yeah,
it's super high. Like, okay,
So
but we're in a different environment. Like, it doesn't matter.
I know.
Like, things can totally blow through, any kind of extreme. Like, it's
we've been seeing that, and we've been seeing that on a weekly basis almost over the last 3 months. And so to assume that that's not going to continue happening, I think is crazy.
Yeah.
And I think you got to be careful about these differentials, which is why I'm saying that actually products are almost trading as products rather than as differentials, and that's what's causing the blowouts. Is people are focused on, we're at the end of the year. A lot of people are unwinding books. People have had tough years. Those that have good years are probably protecting their P&Ls.
Yeah.
So I think there's a lot of, I need to do this, and that's what I'm going to do. And you're seeing a lot of that in the market.
So for products, what kind of environment do you think we're in right now? Do you think we're in momentum trading, contrarian? Like, how do you think the market's going to kind of play out over the next couple of weeks?
That's a difficult question because I mean, going back to what I said about products trading as independent products, I don't want to give you a blanket statement on products are going to do this.
Yeah.
I think that you'll see that there is a lot of momentum trading, and there's a lot of crude trading. So a lot of products are actually being driven off what's going on with crude at the moment, rather than vice versa. I think in the front, we're rolling into a new month, and so there's going to be some new physical interest coming in, with pricing coming at the end of the week and start of next week. But I think while we have this kind of environment, and people are still looking to buy product spreads, and so I think crack rolls certainly can continue to perform.
Yeah. It kind of fits with the narrative all year as well, right?
Correct.
Like,
yeah, exactly.
The market does want to be short somewhere, and they don't want to be short products. So it makes sense that they put it into crude.
Exactly.
But when you get these stop outs, That's why I find it quite interesting that the products have done that much more than crude, even on this covering in crude. Because I thought the market was already long product cracks.
Correct.
Product crack rolls.
Crack rolls, yeah. But I think you'll find that just crude is such a big market, much deeper than products, and so I think on a liquidity basis, you've got to consider that as well, right?
Yeah. Also, you have these funds that trade, Brent spreads against, I don't know, like T-bills or whatever. Like it's such random stuff. So you have that extra positioning that can go into the futures.
Yeah. And it's the most liquid. So people are, from a fund perspective, you're obviously going to trade what you can trade.
Yeah.
Right.
And that's easy access.
Exactly.
And you can stop out quick.
Exactly.
Yeah.
Correct. And if you look at across the product spectrum, that's probably, let's exclude the futures product cracks like RBOB and gas oil, heating oil. But on the rest of the products, that's probably prompt cracks and crude spreads.
Yeah.
Right. And so
it's true.
So often you'll get more aggressive moves on the product side than you will on the crude side. And so if people still believe in this bearish crude narrative, which is, I don't know, you tell me, you're the crude expert, but it's there's, you can argue both sides even, it sounds like, right? It's super uncertain at the moment.
Yeah, for sure. I mean, it will definitely be interesting going into the rest of the year on the crude side. I think, as I said, I think the Indian demand, if they do start switching out, the market's going to be very sensitive to that.
Yes.
If this turns out to be resolved, let's say, I think we can head straight back to $60, $61 on that price very easily.
Correct.
I think into next year, the market is still seeing a lot of builds. How long are we going to go unresolved over this Russia-Ukraine stuff? We've been threatening to resolve it all year. I don't think we're going to be in this environment for like another 2-3 years. I don't.
For sure.
I don't think that is the reality, but the market has stopped out so many times this year. I think it's been really tricky.
It's been exhausted.
It's been totally exhausted.
Correct.
Like who's won? All the end users. The producers haven't even won, right? I mean, maybe if they did their hedging over the summer.
Like when we were at $70 or something like that.
Exactly. The money has gone to end users, which is, sometimes it does need to happen. They can't be ripped all the time. But I think the trading environment has had a really tough time. Yeah. And so what we might see is actually just a total drop in volatility coming into November and December. But I think a lot of sensitivity to headlines.
I think you'll see. I think you might get a reduction in crude volatility.
Yeah.
A lot of sensitivity headlines. I agree, but I think what you're saying is probably what the market believes, and it's very nuanced about what you're saying about whether the world and the market believes that this situation is going to get resolved. And I think that from what we're seeing on the product side, certainly, and what you're telling me on the crude side, the market has more faith in crude selling off to 60 than it does,
Even, I mean, it's a huge potential supply disruption from the market.
Correct.
And we rallied $4. Like, it's not huge.
It's not huge, yeah.
And the market is short. So it does still feel like there are potentially some shorts there.
Correct.
That haven't covered. They're able to wear $4, right? So yeah, it will be interesting. The physical diffs, on the other hand, we were in maintenance, coming out of it now. So the crude diffs were pretty low. We were at -26 last week. The forward curve has implied we're moving back up to 70 cents by next week. So we need to see the physical demand start to come in now. As you said, we're going into new trading months. Where is the appetite going to come from?
Yeah.
So yeah, very much eyes on that. It's when the market's like this and structure on the forward curve is as it is, typically how I like to position is kind of short the pricing rolls and long the middle. When I say back though, I'm talking about north. Yeah, exactly. Like it's still fairly prompt. Like back end October is pricing this week, right? So I'd probably go long mid to back end north, long prompt deck, and short this week, short next week potentially, because we really need a huge leg up in the physical diff. It could get there. We could see a lot of cargoes being bid. There's one trade house who took a lot of NOV, who could potentially come in. I assume they are quite well positioned. So let's see if they defend anything. But until
And I think you're sorry. Finish until.
I was just saying, until we get some clarity over what India are going to do and whether the European refiners, typically they do this wait and hold and come in and buy last minute when they come out of maintenance, whether they have covered yet or not. That's going to be super important.
It is going to be, yeah. And I think that'll also drive a lot of products because I think on the product side, what you'll see is a continual performance of crack rolls because I think you still have it certainly feels like you still have prompt product demand.
Yeah.
You've got prompt light demand. I mean, gas oil and gasoline are as healthy as ever.
Yeah.
And I don't really expect a gas oil sell-off to come anytime particularly soon. I think we're at prices where there can be an enormous amount of volatility.
Yeah.
But equally, I think the thing to watch out for is next year, so Cal 2026 product crack rolls, because I think if the market believes what I think we all believe is that eventually we will get some sort of resolution, whether it's not just to certainly from India as to what the rhetoric will be with Russian barrels. Conflict resolution, I'm not sure. Whenever it happens, we'll all
fingers
find
crossed,
out.
but yeah.
There was some positive news over the weekend about the U.S.-China talks that are coming up this week, and a lot of that, a lot of these shock headlines have shocked the crude market to the upside, and so similarly on the product side, I think any resolution will push the crude to the downside, and I think you'll see product crack rolls perform as a result. So I think that's the main thing to watch out for.
Perfect. So on that note, quick trade idea. I think everyone knows what it is.
Long product crack rolls.
Anyone in particular, or any kind of structure? Prompts, back end.
I think actually back end crack rolls. I think
like a refinery margin or something.
Yeah, correct. Like in Q1, not so far back, but certainly kind of Q1, Q2.
Q2 refining
Q1
margin.
regions, yeah.
Okay, nice.
Exactly.
And for me, I'm going to go long TI Brent boxes. The main reason is if we do get any kind of displacement of Russian oil, in my opinion, it's going to come from this TI. So really, TI versus any other benchmark should have some upside.
Yeah.
Cool. Well, we'll catch up in a couple of weeks and see how we get on. Thanks.
Thank you.
Hello and welcome to today's European market on close, where we see little to no activity in the North Sea window. It was basically, as we can see here in the image, PetroIneos bidding Midland for 19th to 23rd November at 105. It was slightly lower than yesterday's bid by Exxon on similar days. In addition, we saw Fortis. It was bid by Vitol at 15th to 17th November at parity to dated Brent. Now, on the sell side still remains on the sidelines. In addition, we saw no Johan Sverdrup as usual, which has been on this week's start. Now, let's dive into price action, where we saw following this morning's sell-off, which was according to both physical and paper traders, a profit-taking. Brent remains relatively in the mid to low 64s range, as we can see here on the chart. It came strongly down since the market open, where we're trading at the mid to high 65s. We're just trading at the mid to low 64s right now. And a similar story as occurred now in the Brent spreads. Last evening, as we can see here on the chart, we're trading at 80 cents. Now we're just 20 cents lower, around 59 to 60 cents. And the same story has been repeated also to the Brent spread for January to February, where it's down now to around 40 cents. Now elsewhere in CFDs, on the physical window in the North Sea, CFDs have come down significantly over the last compared to yesterday's trading session, pretty much, as we can see. Basically, week 1 and week 2 have been hit hard, whereas the bull week remains relatively stable. Now, elsewhere, regarding the Kuwait refinery that we had the news yesterday, it's unclear whether the refinery continues to export or not as of now, but it's a developing story, and we're going to keep you updated in the officials' LinkedIn pages, YouTube channels, and obviously on flux-news. That's it for today. Thank you very much, and see you on tomorrow's Singapore Market on Close.